Is it fine now?
Yes.
Okay. So let me flaunt my degrees. Okay. On a lighter note. So a brief background about me. I'm born brought up in Jaipur. Did my CA in Jaipur. I moved to Delhi in initial years. I did my CA in 2003. I moved to Delhi for 2 years of horticulture, 2 years of post qualification practice. Then I moved to Mumbai PwC, where I worked for 4 years in audit function. Then I moved to Middle East, Bahrain, KPMG, and I worked in investment bank there. There I get a chance to brush up with little bit on valuations and IFRS. And they say Lord ke Dhadda ghar ko hai. So 2.5 years back, I moved back to Jaipur. And luckily at that time, it was a God's bliss that we got two new courses, or at least three sectors in India: IFRS, the equivalent to Ind AS, valuation, and insolvency. So for any professional who is out of tax, who leaves India, he cannot be good at income tax, because after 10 years you do not touch the law, it becomes difficult to again take it up. But these new fields which have come, these are very promising field for any professional at any age point of time, whether you are just a 3-year-old practicing CA or 20-year-old practicing CA. These opportunities are huge, humongous, and it is just a starting tip. The way government is taking this seriously, it is expected that next 1 or 2 years, the proposed law, if that passed, it's a huge opportunity for professionals. So now the new field has come in for all, and the best part of the new field is those who are early movers will always get advantage. The field is just evolving; it's just new. 2018 is the starting point. Still, so many changes are happening. As of now, we cover only Companies Act and IGC. In future, it is expected to cover all acts in India, which would be one of the best things which can happen. If we talk as of yesterday, the total number of registered valuers we have is 3,183 across all asset classes. For SFA, we have 1161, land and building 1681, plant and machinery 341, which are very rare in number. And that is the challenge in IBC assignments, to form partnership or to form associates with plant and machinery. And majority P&M are based in south side. For the simple reason, the maximum engineering colleges are in south part of India. So that's why major PM values are you find in south. Now, there is one rule in IBVI. Either a person can practice as an individual registered valuer, or he can practice as a firm, that is called registered valuer entity. You cannot do double practice. That means, unlike CA, like those who are CA from CA background, if you are CA, you can open your individual proprietorship, and you can also be a partner of a partnership firm. And in both the places, you can sign independently at different entity. Here, it is mandatory. Either you need to choose you want to practice as an individual, or you want to practice as a firm. So majority of people as of now are practicing on individual mode. As of now, we have only 22 firms which has been registered. Now you can have a firm or LLP or a company, whatever you want. Three formats are there. You can make a firm of all three classes together: securities, land, plant and machine together, or you can make a firm only of SFA. Suppose we are a chartered accountant firm of three partners, and all three become registered valuers. Even in that case, I need to make a separate firm, get registered with IBVI, and then only I can work under a firm category. I cannot say my 3CA firm who is existing registered with ICI can continue to issue valuation certificates under that entity, because you are registered under ICI, and now under RVE, you need to register with IBVI. Why the number is so less, why people are preferring more on individuals, we'll just go through the rules. Once you go through the rules, we'll understand what is the one hitch which is causing a lot of people to prefer practice individually. Now comes something not so exciting, but which is a fact. If we compare the facts, the data of passing percentage of SFA exam, so this data is published by IBBI every quarter in their magazine. So if you see every quarter, so they published from March to March 19 first year, because that was the year when exam was just started. And then every quarter they are published till March 20. They have not published for April, May, June quarter because the quarter is just ended. And there are very few exams happened in June. Very few, not more than 50 people would have participated in June exam. So number is less in June. The scary part to see here is the passing percentage is 15%. So this is not to demotivate you, but this is to give you a fact check that where people make mistakes in passing the exam. So if you ask me, I'll give you my background. I did valuation exam training in May 2018 by ICARU, first time that happened in India. And then I cleared in 2 attempts. In first attempt, I secured 59.5 marks, almost near to the finish line, but I failed at 59.5. In second attempt, I secured 76% approximately. RB is 1100 something and pass is 1363. How possible? That will come to know, Atulji. So that is what I showed you. Figure was registered with IBBI. What the figure we are seeing is the people who have passed exam at NISM. So there's a difference between passing and being registered. And what is the difference that we will see just 15-20 minutes later. So coming to the fact why the results are low, for the simple reason this exam is a negative marking. And those who are IP professionals in the group, they will very well appreciate the fact there's a difference between 60 and 59.75. You're over attempting to answer a question which you are doubtful, you're not very sure, can always lead to negative marking. And I've seen many participants getting stuck at 59.75, many participants, because somewhere your error goes wrong. Having said that, can I have a poll of people who are very new to valuations or just not know valuations, or they just did course first time? Anyone? Just so that I'll get an idea of what experience we have. One is new, you are new to valuation. Okay. Now, the fact is, people who are new to valuation or beginners in valuation, or they don't know nothing about valuation, their probability of passing the exam is much higher and faster than the people who are experts in valuation. Now, it may sound a bizarre statement, or it may look like that I am trying to just make a statement to boost you up and all. But the simple fact is, and I'm sure Vijayji will also agree, and all other people, and once you clear also you will agree. So when we did our valuation course, we had 150 people in our batch, 150 people. We have all partners of Big Four, all directors of Big Four, and all who's and who's of valuation, who has actual valuation knowledge. And there are people like me who are amateurs, just started touching valuations. I think there's one mic probably which is okay. Now what happened? Freshers cleared exam in first or second attempts maximum. I think there's one mic probably if somebody can take care. And people who are freshers, they cleared exam in first or second attempt. And people who are working in valuation from last 10, 15, 20 years, it took them almost 4 to 5 attempts to clear. Now, this actually does not make sense. But this is Chetanji or whoever is a co-host, if Vijayji is not here, if anybody is a co-host, if he can mute other. I'm sure I would love you all to speak whenever required. If you have any questions, please feel free to unmute and speak. But it just take care of other colleagues. Why the people who are actually experts in valuation was not able to clear this exam? And again, I cannot name some valuers. There are some valuers who are doing 30 years of valuation experience. It took them 6 attempts to pass, but whereas people who are just fresher, it took the first attempt to pass. For a simple reason, if you see the syllabus is not only valuation oriented. Syllabus includes other laws, general laws, income tax, IBC, economics. There are so many other things. which a normal practitioner will be aware. So we'll go through some questions and we will also go through what the kind of questions they are asking. So for example, a simple question will come, what is the rate of TDS or rate of surcharge? Now, if you are a practicing chartered accountant working in income tax, for you it may be easy, even though it is not easy for you, because now everything is remembered by your software or your system, whatever you use it. But in case you are actually aware, then it is good for you. But those who are never dealing in income tax, for them a simple question is how much income tax rate is on foreign companies may also be look a very tough question. So these are certain things which actually bothers. But having said that, one thing I can guarantee, any professional who has actually done good 3 years of articleship and actually working in different areas, you all can get minimum 50 to 55 marks without even studying. Even if you go tomorrow to give exam, 50 marks you can easily get it even without studying. The problem comes is to cross the bridge between 50 to 60. And for those 50 10 marks, this 8 days training will be actually helpful, because we all are professionals, we all are dealing with all subjects, so we have fair idea. But how the income tax exams are asking, what are the actually questions they are drilling, that we will check shortly. And if you do not believe that people, so there is one gentleman, 64-year-old chartered accountant in Coimbatore, when I took a session. He cleared exam in first attempt, though he did not have FM in his background. He was not very clear on FM, because remember, when he did in CA in 1970s or 80s, at that time FM was not there in syllabus. FM came into 1994, but still he cleared in first attempt because his knowledge of other laws, income tax, simple things were very good, so that it would be easy for him. Another company secretary, just 4 to 5 years of CS, did not know anything about valuation, because those who are company secretaries are not much accustomed to valuation, because they always work in compliance but not more in valuation. But still, because his company law and his other things were very clear, he secured. Now the last thing which I want you to pay emphasis, and most important, this gentleman cleared exam with 80 marks in first attempt. Now, but read what is the most important thing. But I must say, many questions were absurd. Now, why somebody is saying like this, many questions were absurd? Because in exam, actually the question will come which we have never ever thought of. They may ask as simple question as you think it can be. And you will say, this is the question they should not ask in such exam. But that's the fact. The questions are coming which are very absurd, for which no textbook can give you answers. Something you would have read in 11th, 12th, or foundation of CA, CS, or whatever profession. That question, if comes up, so either our base should be very strong or our guesswork should be very strong. Besides studies, your general awareness and ability to guess also counts. So there are a lot of things which will come from newspapers, in the sense something will come on what happens on CRR, what happens on GDP. That simple thing will come from newspaper, what happens on various returns. So now let's see where the actual problem is. Let's attempt one question. These are all questions which have came in exam. What is the nature of share application account? Nominal account, real account, personal, none of the above. Your options. You can chat, you can type answers in chat. Now this is the which we call absurd questions. A, B, C, D. See, A and D can never be the answer. A and D can never be the answer, for a simple reason. Every account will have some nature. It can be nominal, real, personal, but D cannot be the answer. And why A cannot be the answer? For a simple reason, A cannot be answered because nominal is only for income and expenditure accounts. So nominal account will not be for nominal will not be for share application account. So choice lies between B and C. So A and D are completely ruled out. Now this is the way they are asking questions. So people at times get confused. People get generally confused between A, B, C, or D, whatever options. question may look simple to some of the people and may look tough to some of the people. The correct answer is personal account. Now there are certain so they will ask another questions related to these exams. For example, what is the peculiar feature of nominal account? So when you will get the answers, you'll definitely get to know what is the answer. But the question would be, for example, so this question will also come, what is peculiar feature of nominal account? So one of the correct answer was, they do not have carry forward balances, because all P&L items get consumed in the P&L and no carry forward is of P&L items. So exam questions may be very basics, but we need to be clear on the facts. Another question which looks simple but confuses: redeemable preference shares issued by a company to be shown in balance sheet as A, B, C, D. Again, D cannot be answered because it has to be shown somewhere. So we are getting mix between B, C, B, C. Somebody saying either it's equity or either it's a liability. It can be any of them. Now, what is the correct answer? Correct answer is liability. Now, why liability is correct answer and why not equity is the correct answer? Because since inception, when we were started studying, we always have been understand that preference share is always an equity. That's what we have been knowing from day one. Then what is the problem here in this question? Now I'm sure we all are aware that now Indies have come in, and in Indies, the classic distinction happened in preference share is, if it is a redeemable preference share, that means you need to redeem it after 5, 10, 20 years, whatever the time period. It becomes a liability on a company to pay. In equity shares, there is no requirement to repay. So there is no equity element in, there is no loan element in equity shares. But in preference shares, it is when it is made there that it has to be redeemed, that becomes a liability. Now, we don't know that IBA is asking this question, or as a participant, how should I know that IBA is asking question as per Indian GAAP or as per Ind AS? Because if I follow Indian GAAP, the answer will again be equity if I follow Indian GAAP. But why the correct answer is liability, and why we should assume that IBA is asking for Ind AS only? Because in your syllabus they have Ind AS as a part of your syllabus. So now they are asking only questions on Ind AS material and Ind AS GAAP. So there is a certain shift of thought process. So in exam, if this question is coming redeemable preference shares, then it should be liability. If the question comes compulsory convertible preference share, in that case your answer should be equity. So my suggestion would be, if you can take a pen paper along with you, or so you can just start noting down the fine points. So it may help you in exam. So once you start revising, it may help you. So I'll again repeat: if it is a redeemable preference share, it should be a liability. But if the option comes in exam that it is a compulsory convertible preference shares, then the answer changes to equity. Okay, so that is a few of the questions. We'll go through so many MCQs today, tomorrow, and day after, whenever next session I have. So don't worry about exams and MCQs. Try to get clarity on fundamental concepts, then we will get clear exam for you. This is a syllabus. I am sure you all would have been aware of syllabus. Though, if you have a look at your syllabus, start seeing from the top. So you have economics, theoretical, 3 marks. You have financial statement analysis, 6 marks. Again, theoretical. So they will ask you what is turnover ratio, what is debtors receivable turnover ratio. So basics, fundamental. What happens if your ratio is more, if industry ratio is less? So again, it's a very theoretical topic. Professional ethics. If you get a chance, anybody get a chance to go through the valuation rules I gave yesterday, if possible? If you have gone, it's very good. If you have not gone, then also no problem. We'll go through it today. It covers minimum 4 marks. So that 4 marks is a low-hanging fruit, which you can just need to prepare easily, and it should be in your hand. Again, general laws. that general laws 18 marks can be a very good for those people whose fundamental FMs are difficult. So if you are not very clear on FM, if you think calculation bothers you, then this general law may help you a lot. Another would be Indes. Now Indes is of 5 marks and you have 4 Indes. Indes, they don't expect you to go into technical complicated nature, but they want basic fundamentals of Indes. So there are 4 or 5 Indes that we need to go through. Overview of valuation and valuation approaches is typically which will happen in the evening part today. These are by another faculties, registered valuer and CA Rajiv Bhargava. This is again a theoretical topic. There is no practical questions coming in, so it's all theory. By now you will see almost 50 plus is all theory as of now. Now valuation application, and again judicial pronouncement is a case law of 2 marks, again fully theory. Now coming to valuation application and case studies. So this is where at times you will struggle and at times you need to actually work hard on these, because here actually some case laws and mathematical calculation involved. Any fair idea how much practical calculation will come in exam when you actually need to use computer and calculator to work out between out of 100 marks paper? If you can see, how much you think can be, but number wise, that this much number will come approximately numericals and this much will come theoretical, given the understanding of syllabus you have in front of you? Vague number, if you think that this much will be covered in calculation, this much can be covered in theory in exam. Somebody need to answer by even by words or by chat or by, so get an idea. And I'm just, I know you don't have an idea because you're not given exam, but given the syllabus in front of you, what do you think now if you're giving an evaluation exam, how much percentage? Okay, the best estimate till now is 20 to 25% maximum will be 20 to 25 maximum will be practical. 75 between 80 to 75 to 80 would be purely theory. So even on the valuation, equity valuation concepts also, they will ask theory. For example, option valuations. So for example, you have Black and Scholes model, right? Black-Scholes and other models. They will not ask you to compute Black and Scholes formula. They will just ask basic question. What is a basic question can be? So there are two models, Black-Scholes model, Black and Scholes model, and Black-Scholes and Merton model, right? So that is the two models. So in exam, a simple question can come: what is not there in Black-Scholes? So we need to have a Black-Scholes and Merton model. So if that kind of basic things are coming, even if you're not good at theory, not good at practical, if you are good at theory, it will be sufficient for you to get a clarity on exams. So go to theories very carefully, and those who are not very clear on options or certain fundamental topics of equity valuation or financial valuation concepts, there is a website called Investopedia. That website is a very general website. It will give you all formulas. It will give you all concepts in a very plain, lucid language. So at least you will get a fair idea of what is particular topic. So it will actually help you. So whenever you are in doubt, you can refer that website. So let's understand basic structure of valuation and how it started and the rules. So 2017. In Investopedia, you can Google from. So once you go to Investopedia, suppose options. So options should be good. You should see from Investopedia options and certain strategies. For example, your Porter model, your BCG matrix, that will be covered tomorrow evening. But so there are certain topics where you are not very clear. That Investopedia, you search on Investopedia, you'll be able to get very good clarity. So in October 2017, this valuation rules came. Though this it came in 2013. So if you see companies at 2013, it is Investopedia. I think Deepak ji has spelled that name in the chat, the same name, Investopedia. INVESTOPEDIA. 2013, in Companies Act, the valuation was amended, and it was there in 2013 Companies Act. It took almost 4 years to MCA to get this rule in place. One of the reasons this actually came early was we need to thank IBBI. Had IBBI would not have pushed, this valuation would not have come 2017. It should have come 2021 later on. And why? Any idea? Anyone can think of why it took 4 years at least from government? So in 2013 Rules Act, when the Act was passed, Companies Act 2013, they in the section 2 in the Companies Act it was added, yes, registered valuer is required. Why it took 4 years to get the rules passed? Any thought? I am sure again we are just discussing, and nobody knows the correct answer. But has any thought why it should have taken 4 years to and fro to government? Can think of any idea? If somebody like to speak, I'll be happy to speak. No, apart from Indian system, there is very peculiar things were happening. Very peculiar tussle was happening. Now, what was happening was, first when the draft came, first draft, MCA. That's a good point, Ashutosh. Now, what was happening when the first 2013 draft came? MCA taken only CA and ICMA, cost accountants, in a valuation field. So they say only CA and CMA do, because CMAs are also allowed in RBI and FEMA regulations. So they only included CMA. Then Company Secretary Institute also chipped in, and we should also be allowed to do the valuation. Then MCA and ICI took long years, long battle for them to get in. Then MBAs and other fraternity also chipped in, and we should also allow MBAs also. So it was 4 years, 3 years it took to and fro. Then IBBA was introduced in 2016. And the basic essence of IBBA says we can only work if you get a registered valuer in place. Without having a valuer fraternity, IBBA cannot function, because role of valuer is he need to value the assets and tell to the committee this is the value of your asset. So you need a valuer mandatory. So because of that, it was pushed and it was passed immediately in 2017. So IBBA as of now is our government, as our executing authority, as our regulator, but it is a temporary regulator. Why it is a temporary regulator? Because a new bill has come in place where instead of IBBI, another institute will come, that is National Institute of Valuers, and they will govern the valuation profession later on. As of now, IBBA governs all RVOs, and all RVOs along with registered valuers. So first line of defense is always registered valuer organizations. They control RVs. As a RV, we never communicate directly to IBBI. We always go to RVOs and then we go to IBBI. So that is our basic framework. IBBI has made 3 asset classes as of now: securities, plant and machinery, and land and building. So these are the 3 asset classes where members can register. Generally, CA, CS, ICWA, MBAs can register only in SFA. If somebody has done BSc and other degrees, he can register under plant and machinery and land and building also, if he have that qualification of graduation and experience. That can be done. Now, if you got a fair idea of these 3 asset classes, so which looks simple: SFA, plant and machinery, and land and building. Now, who will value inventory? And why this particular question is coming? Normal company valuation, it's fine. But when you are doing a valuation of IBBI, insolvency cases, inventory should be valued by which asset class? So one answer is P&M. Anybody else other view? So you are giving business to plant and machinery people. Okay. Now what if the inventories of, it's a real estate company, in inventory is land? So the answer would change to land and building. I'm sure logically it will change, right? So if the inventory is of nature of a land and building, it will go to land and building. If the inventory nature is of technical plant and machinery, it will go to technical plant and machinery. Agreed. and if the inventory is of traded goods, regular, just for example, you are buying, let's say, regular shirts. So it's a park using shirts, 300 rupees cost. So it's a regular traded goods. It can be by SFA. Now, why this issue comes all the times? Because in IBC, if you have to value inventory, the regulation says you need to physically visit the place, verify, then only you can value. Otherwise, you can do valuation at a desk job valuation. So I can still sit in my office of IBC case without even going to client site. I can do a valuation of a securities and financial assets. But the moment I take inventory in my scope, I need to physically visit it. And without visiting, you cannot do the valuation report. That is very sincere and serious crime in IBA if you ever do a valuation without visiting for inventory. Now, what will happen in case you have, let's say, painting? So you have late MF Hussein's painting. I'm sure we are aware of late Maqbool Fida Hussain is one of the renowned painters of India. So you have a painting of MF Hussain. Which asset class will value now? So this question was asked to Mr. Sahu. Mr. Sahu is the chairperson of IBBI in one of the seminars by one of the valuer. That sir, there's a building, there is a painting on a in a building. How should it be valued and who should value it? You cannot expect regulator to know all the answers or regulator to get to give all the answers at front. So Mr. Sahu made a very funny remark. So he said, Mr. Valuer, first you need to see where the painting is situated. So if the painting is fixed on the wall, you value accordingly to the capture the value in the building value. If the painting is made on the floor, you value under the land category. So he was trying to escape from the answer. Now, what actually IBA views is always so these are the only three asset classes defined. There can be many more asset classes which cannot be defined. For example, a jewelry company, wherever you are doing a valuation of a IBC of a jewelry company. So diamonds are not our forte, SFA. So you need to get an expert opinion. So you will always hire an expert, get his opinion, and make a report accordingly. So that's the general understanding. Now, what has changed from last pre-valuation rules and post-valuation rules? Now we are doing a valuation, let's say, and I take a help of gold jewelry expert, and based on his opinion, I included in my report. Now, suppose later on we came to know that his opinion is incorrect for whatever reason. Who will be liable? Registered valuer, that is me, liable, or I will be excluded, saying that this is, I can give a caveat that I am not responsible for opinion on gold because that is not my area. I am only relying on the gold valuer, so nothing should come to me. Or I and gold valuer jointly responsible. What do you think can be your view? Sir, reasonable is such a risky word, reasonable, that we'll discuss reasonable tomorrow. What is reasonability? Now, what is the IBBI's view? That now it should be joint liability. IBBI valuer cannot escape. He cannot give a disclaimer that I am not responsible. So IBBI will be held responsible, and in turn he can make a other valuer also responsible. But the prime responsibility will be of IBBI because he is issuing a report. Earlier we used to give caveats, but now giving caveat will not help you. So that is one point we need to be very clear. As of now, we have 14 RVOs approved by IBBI. If you see the table till 2018, there were 11 RVOs. No RVO opened in 2019. Coincidentally, in 2020, only in lockdown period, we got 3 RVOs approved. 12, 13, 14, they just got approved in lockdown period. So IBBI was working in lockdown period. Responsible. Isn't supposed to be blind. If blindly following, then so you are 100% sure. If you are blindly following, then 100% you are responsible. But suppose you have done a due diligence. Suppose you have checked his experience. He had a credential. He is registered with the income tax department. But so credential is all fine. So you have tested your due diligence also. But then that guy has done a fraudulent, has done a calculation error or some errors, something he missed. Even then also, even though mistake is on the part of your valuation professional, which is not your domain area, but still once you are taking your report, you take the full responsibility. Does not sound logical, but that's the way the rules have been framed. So we have 14 RVOs. Earlier in exam they used to ask questions, how many RVOs we have registered. In your exam, suppose if the question comes, how many RVOs you have, how much you should answer? What should be your answer? If anybody can write number 11.
तो हमारे आरवीओ का नाम ही नहीं आएगा सुमित जी।
इसलिए नहीं आएगा, वही मैं बताना चाह रहा हूँ कि लोग पढ़ के तो चले जाएंगे, फिर 14 लिख देंगे, फिर मुझे बोलेंगे सुमित ने गलत बता दिया। उनको तो पता नहीं चलेगा गलत बताया, बट गलत है। इसका रीजन क्यों गलत है? Why 14 is not the answer and why 11 should be the answer? Your syllabus says anything which came into effect after 29th of February 2020 should not be considered for you. So this happened in May and June. I think June, Vijay, right? June. Vijay,
June.
Right. So because for your syllabus, any changes happened in any regulation up to 29th of February is applicable. So for your, that answer would be 11. Now this question, these are actually absurd questions, because if you read actually are updated and you answer 14, because in option you will have a 14 option, in the option also A, B, C, D, and your back
एक मेरे को एक अपडेट देना था कल शाम को हमारे आरवीओ का नाम भी एग्जामिनेशन लिस्ट के अंदर आ गया है।
Now people can register on NSM also. Yes, वो मैं इनको कल बताता on the screen. तो ठीक है, that is good. That's a good thing. So just for remember, for exam purpose, it is 11 RVOs. If it comes, how many RVOs we have? Now, if you can see the asset classes, generally all RVOs have taken land and building, plant and machinery, SFA registration. There are few RVOs who have only taken either SFA or land and building and plant and machinery only, not all three. What it matters to us? How does it matters? See, it matters one to RVO that who are registered for all three asset classes, they can do all three trainings. But how it matters to me as a professional, as a registered valuer, it matters to me as a registered valuer. Suppose tomorrow I want to form a firm of a RVE, including three asset class. So I want to have a land and building also, a plant and machinery also, and SFA also in my partnership. If that is what I want, in that case, I can only register with those RVOs who have all three asset classes. Otherwise, I cannot register with CEV, ICI, Association of CAV, other RVOs who have taken only one or two asset classes. So that is one of the distinction we need to keep in mind when we become registered valuer in future. Every RVO has to be a Section 8 company mandatory now. Earlier, when the rules came in 2017, then the rule was anybody which is having a trust, NGO, cooperative society can form a RVO. Later on, it was made mandatory now that anybody who wants to make a RVO has to be a Section 8 company. So tomorrow, let's say anybody from us wants to open a RVO, considering that this is a education field he want to enter into. Anybody can form an RPO. It has to be Section 8 company. You need to have minimum directors, has to be maximum independent directors on board. There are 4 committees which are mandatory. An exam question comes on what is mandatory committee, what is optional committee. We'll go through in the rules also what are mandatory and optional. These all come from the valuation rules. So 4 committees are mandatory and 1 is optional as per regulation. Directors has to be resident and the chairman has to be independent director always. That's the IBBA requirement. And each RVO has to follow this mandatory. You have no choice. So IBBA has given a code of conduct for registered valuers and for RVOs itself. The job of a RVO would be to conduct 50 hours education training, So first, a member registered with RVO. So like you all registered with RVO, you will complete 50 hours training. Then you conduct an exam by IBBI, which is done on NISM platform. You clear the exam. After clearing the exam also, there is no guarantee that you may get registered. Why there is no guarantee? Because the IBBI screening process is very tough. So suppose there are certain reasons if which IBBI creates a question mark on my character, my integrity, my credentials, they may withhold. We'll discuss that points in rules when it is coming to rules. So once you clear exam, then you need to file forms to IBBI online. It may take another 1 to 2 months to get registered with IBBI. Then your name comes on the portal. Once your names comes on the portal, after that, there will be 1 day COP training to be conducted as mentioned by IBBI. So IBBI has made compulsory that passing an exam, getting registered is just like a CA taking your membership. Getting a COP training for 1 day is just like taking certificate of practice. So once you clear the exam, register, you need to again come back to RVO for a 1 day training. That is one. After that, every year, as of now, the rule is you need to take 16 hours of CPE, continuing education program. Every year, 16 hours. That 16 hours you can take from any RVO, wherever you find comfort. At if it is once the physical starts, let's say physical event started happening, once the things get sorted. So suppose you are in Chennai and at the time any other RVO is conducting program in Chennai, you are freely allowed to attend that training, whatever the fees that program charges, and then you will get a credit of 16 hours. That is one. Now the need of valuation is arriving and the area is becoming vast and vast. Almost all transactions need a valuation, whether it be a formal valuation or informal valuation, M&A, investments in and out, either you're getting money in India or outside India, whatever funds you raise, whenever you're doing sales of business, so valuation is there. Regulatory, all regulation requires valuation. As of now, there is no sync in all regulations. All acts have a different requirement. So for example, a definition of fair value may different as per Companies Act and will different as per Income Tax Act Rule 11 UA and will be different as per FEMA regulations. So we cannot have a reconciliation of the values. It all depends on. Coincidentally, as of now, only Companies Act, IBC, and some portion of SEBI mandatory registered valuers are required. Rest others are optional as of now. In certain court cases, the court is asking to fix the alimony amount to do a valuation by a IBBI registered valuer also. Though not a good area of practice, but still. In India's valuation is again done by, supposed to be done by a registered valuer. Those who have clients who are following Ind AS or those who are dealing with companies having Ind AS, there are two rules, two sets of thoughts prevailing in the market. One rule says valuation for Ind AS should be done by any chartered accountant or management. One rule says, one school of thought says it should be done by registered valuer only. ICA has issued a clarification few days back, but again, that is again their opinion. You can take, you may not take. Their opinion is it should be done by a registered valuer because financial comes under Companies Act and Companies Act has to follow registered valuer. Now, why there is a difference and what is the actual issue here? Suppose you are having a index company, which is your client, and it has 5 unquoted investments in A, B, C, D, E, 5 companies. Now, as per Ind AS, every year you need to get it fair valued. So if you are getting it fair valued and you are getting it valued from a registered valuer, we will not do it for free. We will charge some fees. So let's say we are charging some fees for it. The client has an issue in paying this fees because client says, why should I pay a fee of valuation for a compliance transaction? Because there is no actual buy and sell happening. It is just for reporting purpose. You want me to do a valuation. So why should I get it done from an expert? Let me do myself or let my chartered accountant or auditor do it. So wherever generally the rule is or generally the practice followed is wherever the auditors are big four, So wherever they can push, they push the client to get a valuation done from a registered valuer. Wherever the auditors are not big four, or wherever the auditors are big four but the client is very adamant, the valuation is done by internal chartered accountant or management. We expect the dust to settle in 6 months or 1 year time when the new bill comes in, because we expect a huge opportunity in Ind AS assignments, because there are almost 20 to 25,000 companies following Ind AS minimum. I'm saying that's a bare minimum number, and whoever has investments, we need to get a valuation. So it's a huge opportunity. Ind AS, we need to take care. So John Keynes, who was one of the noted valuation, said, Vijay, I think there's one mic if you can keep off. He mentions that why valuation is needed. They say it is better to be roughly right than to be precisely wrong. Your valuation report always serves as a benchmark for negotiation purpose. Practically, based on our valuation, transaction does not happen. Our report gives a benchmark to see the upper side or the lower side, and that's where the valuation is required. Even if not officially, a lot of people get a valuation done. After the rules come in place, a lot of confusion happened, because before 2017 there were no rules, so everybody was free to do whatever they want. After this, a big issue happened. And what is the issue happened here? So many rules, getting professionals also confused and client definitely confused. What was the confusion that was starting? Suppose I'm issuing, there is a private limited company, we are issuing shares, and the company is, let's say, 10 years old company. We want to issue shares as per DCF methodology. So according to you, how many valuations I'll require as per Companies Act and Income Tax Act, and from how many people? Any idea? So there is a private limited company, we are issuing shares as per DCF, as per Income Tax Act and as per Companies Act. How many valuation reports we need, and from whom? Any basic idea? So we need 2 valuation reports, which you have rightly mentioned. Now imagine, for a same transaction, if you are a client, C will not be there, Atulji. I will come to that. Now, my just simple question to you all would be, imagine you are a client. Would you like to pay to 2 different professionals for one transaction? So I'm issuing only one share. For one share, I'm getting a report under Companies Act from a registered valuer. For the same transaction, I'm getting a valuation done from a merchant banker under Income Tax Act. And I'm sure we all know merchant bankers are bomb expensive, and that is a good thing to be expensive. So for us professionals, for us to be expensive. But the problem is client does not like it, because client finds it to be an unnecessary compliance issue. As of now, in Income Tax Act, CA can do valuation where DCF method is not involved. If there is no DCF, then any chartered accountant can do. But where there is no, there is only DCF, it has to be only done by the merchant banker. This problem may get resolved once the new bill gets passed. In the new bill, they have taken care of these kind of problems, because it is causing a lot of issue. Under FEMA, yes, a CA can do. Now, what will happen in case you are issuing a shares to a non-resident? Suppose if I'm issuing a share to non-resident, in that case, income tax, I don't need to issue a report, because any share issued at premium to non-resident is exempted. It is out of purview of income tax. But in case of FEMA, it can be done by either a chartered accountant or a merchant banker. So now what is the problem is actually coming here? Yes, he can be. C under FEMA, or also can be RV or MB. RV is not there under FEMA as of now. In the regulations, it is not RV as of now. It is CA or MB as per the regulations. But yes, RBI Bangalore and RBI Hyderabad are asking RV reports also along with CA. Now, what is this things that actually put in issue? So those registered valuers who are company secretaries or ICMA or MBAs, or who are not CAs, they are at a disadvantageous position. So which is not a level playing field. So that is the reason. Just a second, sir. Is it fine now? Vimalji, it is visible now? Just a second. Oops. Wait. Just give me a minute. Okay, thank you. I hope audible and clear now. Okay. So now for FEMA, so now because of this issue was happening that client prefers only CA generally for who are registered valuers so that his report can come into other places. So other professionals have gone to IBBI and raised this issue, and now they are actually considering that issue. So a new bill has come. We'll discuss that new bill very shortly. That will try to settle. Now the valuation rules is very important. I have given you a copy yesterday. If you can download it and open it after 10-15 minutes, we will go through the rules. So just open, keep that rules ready. Now from 1st February 2019, mandatory any valuation, most of the valuation has to be done by a registered valuer. Specifically share issue valuation. Voice and video is still not sync. Let me check. Just a second. It seems a network issue. It seems, though we are using 4G, still a network issue. If the voice is coming clear, then bear with voice and slide. That should be sufficient, I think. Okay. So from 2019 onwards, it is mandatory that any valuation should be done by a registered valuer. Though it was mandatory from 1st October 2018, but then there are only 40 registered valuers in India. So they realized 40 registered valuers pan India cannot work. So IBBI started getting more exams frequently, and now the number got increased. So from October 2018, it was 40. Now it is, as of now, it is 1161 as of now registered, though the pass has 1300. And why there is a difference in passing people and number of registered, we'll discuss shortly. Now, section 247 is the mother section which governs the Companies Act, which governs the valuation section in Companies Act. That is the only section in Companies Act that talks about valuation. Before we go to understand section 247, what can be answer of this? This question generally comes in exam. And if anybody had read section 247 earlier or have fair idea, can attempt this question. Anybody with A or C? If all are with B, so only we have Chetan and Vimal ji with A. ROC की कोई value नहीं है. Nobody is scared of ROC. Chalo, at least Raghunathan ji followed me. So this is called trap. You push people so they will fall. Again, on a lighter note. Now note down, if you can note down. So this question comes regularly because in Companies Act there are few questions and this is the only section of valuation. So this section we need to read. The correct answer is A, audit committee. And why audit committee is the correct answer and why not board? So I'm sure we can always come to the argument there is a private limited company which does not have audit committee, then yes, the answer goes to the board. What does the question says? Question says who ordinarily appoints registered valuer? Generally, I'm sure we all are aware, generally in Companies Act, audit committee always recommends and the board approves it. Nowhere audit committee is superior to the board, generally, nowhere. This is the only exception in section 247 where audit committee approves. Here audit committee is not recommending. Here audit committee approves. So suppose there is a company, private or public or listed, which has a audit committees in place, which has. So if it has an audit committee in place, then it will be an audit committee who will be appointing the registered valuer. They will not nominate it to the board and decide accordingly. So that will be the audit committee. So the section says if there is no audit committee, then you go to the board. So in exam, if the question comes all four, what is the correct answer? Then the correct answer goes to the audit committee, because that is the first power. So they say first audit committee should appoint. If there is no audit committee, then it should go to the board. So we need to take care of this question. So section 247 is a very simple rule, and note it down. You need to read 247 before. Yes, then it will be board. Absolutely. If there is no audit committee, then it would be the board. But the first would be the power goes to the first audit committee. In absentia of audit committee, it will go to the board. That is no doubt on that. So if we go to the section 247, which is the only section, you need to first read section 247 thoroughly, because an exam question will definitely come at least minimum 1 mark from 247 itself. So that's a very small section, but we need to read the section. What does section 247 talks about? And it's a very open-ended section. It says whenever a valuation is required in respect of property, stock, shares, debentures, security, goodwill, or any other, or net worth. So any other asset is a big word. That means generally whatever you do valuation of assets, it should be by a registered valuer, or net worth or a liability under a provision of this act should be valued by a registered valuer, whichever as per the regulations of IBBI approved and all, and appointed by the audit committee, or in its absence by the board of directors of that company. Now, so this is the stretch of the section. So we need to understand first power is of audit committee. In its absence, it goes to the board. Now, IBBI has done a review of a lot of valuation reports also, where they have issued a report under section 247 saying that the management has appointed us. So IBBI objected that report, though it's a technical understanding issue. It is not. Auditor cannot do evaluation. If Atulji, if your question is can auditor do valuation, so answer is auditor cannot do evaluation. Coming to the management may appoint you for evaluation, but technically that is incorrect, because section does not give power to management. Either you get an authorization from board, that the board authorizes management to appoint a valuer. That is fine. That authorization is fine. But if you don't have that, IBBI has a issue. So generally, whenever you make an engagement, ensure that in engagement you write that the board has appointed us along with management, something like that. Now, rules also talks about what should a valuer do. So valuer should be impartial, true, fair valuation, which you all understand. You should do due diligence, make valuation as per the rules prescribed. Now the last part is interesting part, and it is very confusing part, and there is no clarity as on date by any of the regulator, which is a clear clarity. Just read part D if possible. If it is visible on your screen, read part D. So what does part D suggest? Part D suggests that a valuer cannot do a valuation of any assets or of a company where he has a direct or indirect interest within 3 years during or after the valuation of assets, which means 3 years prior and 3 years post. You should not have any interest with the company. Few things are which are very clear. Stat auditor, tax auditor, GST auditor, company secretary, compliance auditor cannot do a valuation of that entity, because it is considered to have indirect interest, because your remuneration is linked to that, and that is very clear. If you see the first draft rule said he should not be interested before or after the engagements. That means Adi Kal se Anant Kal tak, he cannot engage with the company. So a lot of people objected and say, suppose I have done a valuation of a company last 5 years back. Now the company wants me to appoint as a registered as an auditor. You should allow me because my independence is not impaired after a certain period of time. Then government changed the rules, and now the final rule is 3 years before and 3 years after you cannot do a valuation. Now, a lot of questions have been asked to a lot of RVOs and IBBI. Suppose I am filing a GST return only of a company, and I am charging, let's say, only 2,000 rupees per month. Total, I am charging 24,000 rupees maximum for a year. Now the company has come to me and say, get me a valuation done for a client or for that company, and the valuation fees may be 50,000, maybe 1 lakh, whatever it may be. Can I do it? Yes or no? What is your view? And again, as I said, this is a very tricky portion. IBBI has and RVOs have a lot of confusion and there is no clarity. Now, what is the thought process? So if you go and ask this question to IBBI, they will not give you a straight answer, yes or no. They will say one thing: check whether your independence is impaired or not. So that is the only question answer they will give. So I need to check whether am I independent or not. For example, my total fees, let's say, I'm giving a hypothetical numbers. My total fees for my personal revenue is, let's say, 2 lakh rupees, let's say, and I'm charging 25,000 from the GST services. So that is almost more than 10%. So am I independent? Answer would be no. Suppose my fees would be 50 lakh rupees is my total fees during my revenue from all companies, and I'm just charging 25,000 from that company. Am I independent? My answer would be yes, I am independent, because that amount is not impairing my independence. So this question cannot be answered in black and white. We need to see what is your actual independence issue. Try to follow whatever the Companies Act independence is saying. If you follow that, majorly you'll be out, you'll be through. So an exam question comes, how many previous earlier and how many years later he cannot be connected? So answer is 3 years. What are the penalties involved? So penalties are, if you have contravened this provision of this section of 247, and so intention of was not to defraud, it is a genuine error, penalty can be up to from 25,000 rupees to 1 lakh rupees. That is only fine, penalty fine, which is still reasonable, no jail term. But if your intention is to defraud, then the penalty goes up to from 1 lakh to 5 lakh rupees and imprisonment up to 5 lakh rupees. There are more punishments yet. It is not the end of the punishments. Now, if it is proved that yes, you have deciding authority for which IBBI is a deciding authority as of now. Yes, IBBI is as of now, for the timing is IBBI. Later on, the new authority will be National Institute of Values later on. So wherever you're convicted under subsection 3, another penalties fall on you is that you need to refund all the remuneration you received. You need to pay for the damages which the company or any other person has caused. Now this is called class suit. Suppose I have given a valuation of report of a company and 100 people read that report and acted on that report and made losses in stock market or anywhere transaction, they can sue me. So these sections are typically tough. So read section 247 thoroughly before going for exam. Also read section 448 and 469. These are for more damages. We'll come to where it is. Even you have not read section 448 and 469, any idea what can be the maximum jail term for this section for valuation? Suppose I have done a valuation of a minority shareholders. I collided with the management. So I majority given me higher fees or they given me cash that give a wrong report more. So this, if I add Chetan's number and Manonij's number, that will be the answer. So if it is proven that you have collided with the management, fraudulently did a wrong valuation, maximum term is 10 years. Where you will get this, which section talks about 10 years? Once you go to 448 section 448 will say go to section 447. Section 447 will say if you have been any covered under this fraudulent provision, it will be 10 years penalty. So that's the maximum penalty ever. So that's why just read 448 and 469, and how it is linked to rules also, that will show you shortly. Now the basic question comes on MCQ of 247 basic questions. First, who appoints RV? Registered valuer is appointed by whom? Second, under which chapter number section 247 comes? If you would have read first slide thoroughly, again I'm sure I've intentionally skipped that line. I have not read that line. If you can recall, I'll give you 4 options: chapter 15, chapter 16, chapter 17, chapter 18. Which chapter number, under which chapter number of Companies Act section 247 is written? I've given you 4 options: 15, 16, 17, 18. Do not Google, just answer any number. And these are all actually we call absurd questions. So they are asking you to memorize under which chapter number that section 247 is coming. You have to give any answer: 15, 16, 17, 18. There are 4 chapter numbers I've given you. So we got 1 answer, we got second answer, 2 more options are left. So there are so many chapters in Manoniji, there are so many chapters in Companies Act. I just randomly have chosen. So the write down. So the correct answer is chapter 17. Correct answer is chapter 17. Write it down by hands. Numeric Roman, write in Romans, because in exam answer comes in Roman, so people get confused. 17, 18. If you write 17 numerical and Roman also. So X, V, and double two. So that will be able to recall in exams. So it is Roman. Yes, exactly. Rajkumar ji has mentioned. So note this down. It is chapter 17, and where it is covered, if you see, it is written in the section first slide itself. The chapter the Companies Act has introduced under chapter 17, because they are asking such illogical questions also, which a professional need not remember, but to pass exam we need to do something which is still required. RV cannot be associated for companies. How many long we discussed? 3 years before and 3 years after. Option may also come. Yes, here, that's why I'm saying here feel free to answer. Here you have the opportunity to go wrong. So just answer. And why you should always answer here? You will actually come to know your gut feeling gives you what answers at times. And a lot of people gut feelings are always correct, because in exam at times akkad bakkad bombay also helps in. Now coming to in a multiple choice question, it always helps in actually. In exam there will be one option in this question: RV cannot be associated for how long? One option also comes never and never before, never again, because in the first rule it was written like this. So if you are searching from Google, do not reading from act or latest material, you will get a wrong notion on Google search. Penalties for non-compliance, so just read penalties. Where the intention is not to defraud, then limit is 25 to 1 lakh rupees. Where the default is, then you will go under so many sections. Then you will go under first defraud, because you are not following the section of it is not unintentional you did. So unintention is you made an error. So I made a typo error, that is okay. So instead of adding something plus minus I did it, then it is fine. But knowing that there is a section which prohibits you to take that position and you have taken, it will go into jail term also. Along with jail term, it will go for or. Okay. So better give to one of your partners. Do not take audit. And actually, a lot of people have started segregating, because talk about big firms, who are doing so many things. So any big 4 or any big 10 firms in India would be doing consultancy also, will be doing tax advisory. So they started making another separate firms so that segregation can be shown. So that basics we need to remember. 247. What is valuation? Generally, Companies Act does not define what is valuation. Neither the rules define what is valuation. It is a general understanding. Valuation is a process of determining the economic worth of an asset or liability under certain assumptions and limiting conditions subject to the data available for the valuation date. So that is the broad understanding. Now, what we are saying here, that valuation is always, we are trying to find the economic worth of asset or liability based on certain assumptions. So we take some assumptions. For example, if you're doing DCF, you take an assumption that the growth will happen at 5%, 2%, or whatever percent terminal value. Limiting conditions, you are only doing what the client has given you. So if the client has given you projections, can you change the projections or you make the projections? Answer is no. Projections are always given by client. So it is a limiting condition. Because audit is always a limiting, financial statements are always have a limiting condition. Projections will always have deemed limiting conditions. Subject to data available. So you will value only what is available to you. You are not a magician who can find out from the inner side of management. And on the valuation date. So my question is, suppose you are doing a valuation of land or building, whatever you have done. Suppose you are asset class and the valuation date is 31st of March 2020. You issued a report for 31st March 2020 and next day fire occurs. The whole building gets dumped. Is there any responsibility for you to put an addendum report, any addendum clause or update the report? Yes, no, maybe. Do you have as a registered valuer, do you have a responsibility to update? Yes, no, maybe. So two people are saying yes, one is saying no, another is saying no. Ithi Agrawal ji is not responding. Rajkumar ji is saying yes. Every time you didn't require to generate, we will cover the student aspect shortly. I'll just cover it up. So before going to Udin, my prime question is, do I have a responsibility to update? Yes or no? That is most important. Do I have a responsibility? Suppose I have issued a report today and that asset get destroyed tomorrow. What is Manonit ji's view? So what does the IVS says, International Valuation Standard says, and what is the expectation from a valuer? There is no expectation from a valuer to update the report or issue the addendum. If anything happens after your report date, you are not responsible. So suppose I have issued a report today and tomorrow anything happens, I am not responsible at all. Even if the entire value goes for a zero, it is not your responsibility. You are not supposed to do that. It is because it is said you are giving your opinion as on valuation date. After that date, it is not your responsibility. Once, for example, those would have given a valuation report as of 31st January or 31st or 28th of February. Later on, because of COVID impact, the entire report gone for a toss. So I don't need to update the values now, because if somebody is taking my report of January and February and investing now, he cannot go to court and say Sumit has given a valuation in January or February 100 rupees. Now in March or April, the value has come to 10 rupees. So my responsibility is up to February only. So then that is your responsibility is limited. What is the term value? Value will always discuss. You will always, once you become professional, value will always be there. Value was not defined in the standards as of now. IVS is International Valuation Standards issued by IVSC. That will be covered later in one of the sessions. The value refers to judgment of valuer of the estimated amount consistent with one of the base of value. You need to read IVS for professional and for your exam purpose also, because IVS they are asking. We'll come to what is IVS and all. So by this definition of value, is value a fact or an opinion? Once we say the word value, it is a fact or it's an opinion? So value is never a fact. It is always an opinion of a valuer. You in court of law, nobody can sue that itna to mujhe milna hi chahiye tha. Sumit has given this kind of report. It is always your opinion. So you have taken an opinion, but that opinion you have taken considering the standards. So if the standard says I can look into this factor, I have looked into this factor, then I have taken a call. I cannot take an opinion without referring standards. So I need to follow what is under the standards of IVS, then we'll go. And what is valuation? So that was defined in again in IVS 2020, and IVS 2020 is applicable for you because this started on 1st February 2020, the new IVS. So it is under your syllabus period. It refers to the act or process of determining estimate value of assets or liability by applying IVS. So that is a part of valuation, just for understanding. Is valuation art or science? This debate goes so many times. So one set of school says it should be a science because there are methods fixed. One school says it is an art because though the methods are fixed, how to use the judgment depends on the art. And when we were in college, there was always a question, is accounting as art or science? And our professor used to tell, if your trial balance tallies automatically, it is science. If you get your trial balance tallied by your smartness, it is an art. So that was on a lighter note. So it is always says that, and the Professor Damodaran, I am sure by now you should be aware, at least heard who is Professor Damodaran. Professor Ashwat Damodaran is one of the most highly recognized professional across the globe in valuation field. He's actually, his words are considered as a God's words. He issues every year he issues a lot of data which world over people use for valuation purposes. He teaches in New York Stern University. He mentions that valuation is neither an science nor an art. It is a craft. That means it is a skill which one can learn by doing more and more. The one who does it more gets better at it. And how true it is. I cleared in 2018. I still remember the first valuation which I have done. And if I compare now, it was total messed up. But at the time, there was no practicing available. People were not sharing much reports. So whatever I did, I thought it was right. But over the period, when you deal with experts, when you deal with professional peers, you improve in the period. And now in 2 years, you have so much of data available in the market and in the internet, you can get a lot of improving opportunities. IBA itself accepts valuation is a process of determining the value of assets liability of a company, and it's an ambiguous concept. So in one of the committee of experts have issued a report, and they say valuation is an ambiguous concept, as there can be different values depending on different context and different purpose that can always be taken care of. So there is a classic example, a classic cartoon came in one of the newspapers. 12 analysts came up with 12 different valuations of the same company. The only thing they had common was $500 per hour fees charging rate. So for one valuation of one company, if there are 5 valuers, they can all give a 5 different value and all can be correct. So court has admitted in various cases that different values are also fine. What we need to see is, have you taken assumptions reasonable or not? And that is what we need to defend whenever you become registered valuers. When we go for the class of case studies, case laws which have come on valuation, we'll come to know what actually need to take care. Always comes a debate, price is equals to value or value equals to price. Warren Buffett has given a classic example. He says price is what you pay, value is what you get. Also note down few things. One thing, price is an exit price. When I say exit price, in India is 113, this question comes, what is price? So it is assumed price is exit price as per India is 113. Fair value is also considered exit price. When we say fair value, what do you mean by fair value? That I will be able to exit at this price. Transaction price cannot be considered fair value always. Suppose if I have bought something at 100 rupees, that is my transaction price. That may not be considered as fair value, because if I want to sell it off, I may not be able to sell it 100. So if I'm able to sell it at 90, so that is exit price, that is considered fair value. That is Ind AS 113. So remember that fair value is exit price as per Ind AS 113. Value versus price, the key thing you need to understand, for a purchaser, it should be entry price, fine. Deepakji, for purchaser, it would be entry price, but it would be just transaction price. But for a purchaser, fair value cannot be the entry price. why fair value for a purchaser, why fair value cannot be the entry price. So if I bought, suppose that's something, if I bought a asset at 100 rupees, so I'm a purchaser, I bought at 100 rupees, that is my transaction price. But can I sell that asset at 100 rupees now? That is the question we need to see. So suppose if I am using that asset, it is depreciated, so 100 cannot be my fair value when I'm doing a balance sheet date analysis. But if it is a suppose it's an inventory, there I can be able to sell it 100 rupees plus, then 100 would be my fair value. At least bare minimum fair value would be entry price. So it should be always, when can you exit? Khareed liya, that is fine, we bought it, it's fine, but when I want to exit, can I exit? That is a point we need to consider. Price is always precise because you actually pay for it. Value is always judgmental, and value cannot be precise. You give a range or you give an opinion. There are two views in giving a value. People can give a range that the fair value may range between 10 to 20 rupees, or may give exact number, the fair value may range 16 rupees. Both are fine with standards. I'll leave this. So what is IVSC? So there is a standards called IVSC, International Valuation Standard Council. That is a global body in NGO who issues valuation standards every 3 to 5 years. They update the standards. Globally, their standards are followed globally. In India, what standards are followed, that we will see very shortly. Whenever you want to take a break, do let me know. It's fine whenever, because we are ahead till 1:30. So whenever you want to take a break, let me know of beforehand. There is one view which says valuation is also what people are willing to pay. What does that mean? Valuation is also determined by the person who is buying it. So it, for example, it may happen, a consultant may say this value of this land may be only, let's say, 1 crore rupees. But the person who is buying may have a more value to it, because either it might be his factory is nearby to his adjoining land, or he may make better use of the land than just fair value of the land. So valuation is what people are willing to pay. The classic example is our startups. If you have seen startups valuation, anybody who's done startup valuation will agree to it. The numbers can change very frequent. So if you see the example of Flipkart, May 14, the valuation was 2.6 billion. July 14, within 3 months time, the valuation reached to 7.1 billion. Almost in 3 months, almost three times, more than three times high. Go to December, again 6 months, the valuation 11.5 billion. July 15 billion. July 16, the valuation went almost half, because there was a news that the promoter are fighting among themselves, so valuation went down. In August, again valuation go up because a new investor came in, so valuation again rose. So see, within a month, from 8.8 to 11.55, it is almost 50% up. The valuation is going high. Now, again in 2 months later, valuation almost went half. Any idea what happened in November 2016? I'm sure we all, nobody can forget what happened in November 2016. So Mitro has come in, and demonetization has hit startup industries badly, and that too companies which are selling on cash on delivery. So because of them, their valuation almost zero, in almost half in just a month. So somebody's loss was somebody's else gain. See the Paytm valuation: June 16, 2.3 billion. September, in 2 months, 4.8 billion. And because of demonetization, they had 7 billion valuation just jump, because when demonetization came, everybody was using the Paytms and currency. August valuation was 10 billion. Now, if you see the financials of Flipkart, and these all data are public data, all available on Google and publicly available. If you see 2017 valuation of balance sheet of Flipkart, their loss was 245 crores, and their valuation was $7.6 billion in 2017. In 2018, their balance sheet book loss of their P&L, I'm just talking only P&L number. This 2063 crore was their P&L for that year of 2018. Any idea how much would have been the valuation in 2018? Rough estimate, any vague assumptions, any vague numbers, what you think can be? If you have 2017 data, If you go to 2018, it would have gone up, gone down. If it would have gone up, how much? If it would have gone down, then how much? Awake numbers. I know nobody would be aware, but still. So Atulji's would be, it should have been gone to $4 billion. That is his view. Anybody else has a view? Chetanji, what is your view? Any number? I'm just trying to look for guesswork, because given the data, and there can be nothing right or wrong, it's just 4 or 50 billion. So he's going from North Pole to South Pole. He's covered both. So Chetanji is 8 and Rajkumarji is 10. The actual valuation came was $20 billion. So the higher the loss gone, the valuation increased, and this caused a lot of ruckus in the financial market. They thought that valuers are doing any job without having senses, so that raised a lot of criticism. But if you see 2017 Paytm, loss was 890 crore. 2018 financials, loss was 1500 crore plus, almost double. 2019 financial, loss was 4000 crore for 1 year. That is only 1 year loss we are talking. Their valuation increased from $10 billion to $16 billion. So the valuation has gone very high, bizarre, very high. Then Harsh Goenka tweeted at that time. So he tweeted once, he says, if I travel in Ola and stay in Oyo and pay by my Paytm, I will increase losses of all the three companies. Still trying to understand the premise. More the losses, higher the capitalizations. Perhaps I'm too old world. Now, what can be the logics of having so much of valuation, so much of high valuation? So now what Warren Buffett says, now we need to understand accounting numbers are just the beginning and not the end of the valuation. Just because we say something is into loss, we cannot say valuation is zero. We need to see story behind it. Now, what is the issue here? Issue here is the valuation are increasing on two reasons. One of the common, which one is logical reason and one is illogical reason. The logical reason is they are going on the base of number of users and customers. Customer acquisition is one of the actual asset. So if I have 1 lakh customer on my portfolio, on my platform, so in future I may earn on that. So that is one of the logics which may happen, may not happen. Again, there is no certainty. Chetan, you have Ola and Uber both app in your mobile? Chetan, you have Ola and Uber both app in your mobile? Only Ola. Generally, people have Ola, Uber both generally. So maybe that you are a good customer for a company, only for a loyal customer. Generally, people like me have both apps in my mobile. Generally, we keep Ola and Uber also. So when you are standing at airport or station and you need to go home, generally people compare both the prices. They say they take on two things. One, how much is the price differential coming, and which cab is coming first. That's what the choice we make all. So there is no guarantee that even by being on a platform. Let me see if I can mute the another which more. So there is no guarantee that even if you are a customer, you may give business. There is probability. So that is one reason of valuation high, that the more number of customers you have, the more you may have future profits. It probably. But there is one second theorem which is called illogical theorem. That illogical theorem says, they call it a bigger fool theory concept. What is a bigger fool theory concept? That means a person buys a stock at a higher price thinking that there will be a fool bigger than him who will buy at a higher price from me. The problem in the chain becomes when you are the last fool on the table and then nobody is left to buy. So people just buy on a assumption that if you start buying, for example, I'm sure Paytm, you all are aware, it's an unquoted company and we have seen the balance sheet. It is still losses. Till date, they have not made a single penny money. So if you want to buy a Paytm share today in the gray market, the price is approximately 21,000 rupees per share. So I thought, let me buy one Paytm share and become a shareholder. At least I can attend its AGM and I can understand what Alibaba and what their thought process is. Let just to try to find out. Then I come to know there is a term that minimum you need to buy 10 shares, then only you can buy a unquoted shares of Paytm. So 2,10,000 was supposed to be very high amount for taking a risk, because that's not the experience I wanted at this cost. So I left it. But the point is still in the market, people are willing to buy despite they know the company is into losses, because they think that someday after 1, 2, 3 years, company may turn into profit and somebody may buy at a higher price. They may success, may not success, only the time will tell. But this sentiment keeps the market selling. So that is the valuation which may not be directly coming towards. So now we got a legal recognition. As we all know, by 2019, we are a registered valuer. It's a regulated profession. We need to follow rules and regulations. Whatever RVO is saying, opportunities are so much in Companies Act that you can always go through. This is not for exam purpose, just for your practical purpose once you become RV. So when you send your emails to client, or so you can advise them, for all these sections, we need to have a mandatory registered valuer. So it can be for your marketing purpose, just for understanding. Index mandatory. So many opportunities in Index. Once you become registered valuer, try to grab Index companies or Index consultants. You might get opportunities there. IBC. Who are IBC professionals here? We have IBC professionals with us. A CA can do. So we have Rajkumar ji. Okay, very good. Anybody else from Rajkumar ji? Because tomorrow we will cover IBC, and then tomorrow Rajkumar ji will help me. Because those who don't know IBC, for them it is a tough. Those who know IBC, it is for easy for them. In CA, as of now, for example, buyback. So buyback a CA can do. There is no issue. So Ithiji, you are also IP professional. Okay. So in buyback, a CA can do a certificate. In capital reduction, a CA can do a certificate. In right issue, there is no valuation certificate required in right issue. But if the board wants any calculation, generally there is a MNC board, they may want a calculation that can be done by a chartered accountant, because in right issue you don't need a valuation certificate. So that can be done by in Companies Act. For all others, wherever a new share of fresh issues happening, preferential allotment, private placement, mandatory, it has to be a registered valuer. Now, once we all become registered valuers, one of the assignments you will get is from Rajkumar ji and Iti ji. Why? Because major chunk of assignments are coming from IBC. And why it is coming IBC? As per IBC, mandatory RP needs to appoint 2 registered valuers. So at least 2 brothers will get 2 professional brothers, sisters will get an assignment. Now you tell me, unfortunately, Chetanji, I do not practice IP, unfortunately. And why I don't do practice IP, I will tell you tomorrow why I don't practice IP consciously. Now, so I told you there are 3 asset classes, right? Land and building, plant and machinery, and SFA.
Break
So IPs should not answer, other people should answer. Now, do I need to appoint 6 valuers if I am a RP, if I am a resolution professional? Do I need to appoint 6 valuers or 2 valuers? If you understand the definition, as per the definition given. So there was a gray area earlier. There was a gray area. The gray area people used to appoint only 2 valuers. That was the gray area earlier. Later on, IBBI clarified, and now it is mandatory that there has to be either 6 valuers, different valuers, or they can appoint 2 entities if each entity has 3 different asset classes. So mandatory 6 valuer has to be there, or 2 entity. That is the way. So that we need to take care of, that it has to be 6. So in exam answer comes 2 or 6, answer should be 6, because for each asset class there should be. Suppose there is no asset class, so a company does not have a land and building, then it has to be 4 only. But if assuming they have all, so as per section it is 6 valuers. Now you all will agree, Chetan and Atulji probably, and those who are not IPs, they should answer, because if IPs are then also same IB cannot do a valuation. So suppose I am an IP, I cannot do valuation for my own case, because you become an interested party. I can appoint another valuer is also IB, same you cannot do. So these 6 should be different asset class RVs. Yes, 2 from each asset class. So for land and building, it should be 2 RVs. For plant and machinery, 2, and for SFA, there should be 2 RVs, Deepakji. So 2 from each asset class it has to be. It does not matter RVs from which RVO. So RVO is immaterial now. RV is only, we are only concerned with RV. Why 4 if no land and building? Then 2 from plant and machinery and 2 from SFA. So if there is suppose no land and building, so I need to appoint 2 for plant and machineries and 2 for SFA, securities financial assets, like debtors, cash, inventory, and advances for that. Okay. Now we all understand 2 people cannot think same generally. If 2 people are thinking same generally, then something is wrong in the thought process of any one person. So it is because a sensible mind will always generally have a different views of opinion. I'm not IP working. Good, Itiji. I think you'll be able to, once you can, 10 years should be a criteria that is barring you maybe becoming IP. It's a good area to work if you love law. If somebody loves laws, go into IP if you love law. There is a difference between liking law and loving law. If you love law, IP is the best profession for you now. Now we agree that 2 professionals cannot think together. This cannot same. At least they will not be on the same page always. There has to be some difference. So if 2 people have been appointed, and so the value will come same or value will be different. So RP has appointed 2 valuers. Generally value will be different. If the value comes same, your committee of creditor will take you to task. If suppose coincidentally, it's a very rare coincidence, two committee, two values totally different given a same value, COC will take you for a task because they say you have not done independent value. You both would have sat in the same room, discussed the report and drafted accordingly. Generally, it is thought that 2 people cannot think same generally. So whenever you are issuing a valuation report under the IBC, you need to be careful and should not discuss because the numbers are coming same, the line is coming same, it should have a different. Now my question is which Itiji will not answer and Rajkumarji will not answer because they know it. So if the 2 values are different, ideally what the IBC should, what the IBA says, so you appointed 2 valuers and there is a significant difference in valuation came, then he has to appoint third valuer, right? So suppose one value, you appointed 2 valuers, one has given a report of 100 crore value, second has given a report of 300 crore value. So that is 2 values they have given. Now it is seen that there is a significant difference, almost double the report difference. So the difference is significant. You appoint a third valuer. Now the third valuer has given a report of 400 crores. Now what do you think RP should take a value? So there are 3 reports now. Original valuer, 2 values given 100 crore and 300 crore. Third valuer has given a 400 crore rupees reports. What should you do? So you take 300 or average of what, Deepakji or Chetanji? Average of what? Average of all 3. Just note this down, note it down, and because these kind of questions comes regularly in exams. 1, how many values we need to appoint? 6. What happens when there is a significant difference? If there is a significant difference, you don't need to take average of 2. You need to appoint a third valuer. What happens when you appoint third valuer? You need to take average of any 2 closest value. You will not take an average of all 3 reports. You will take an average of any 2 closest value. So out of 100, 300, 400, 2 closest value would be 400 and 300. So the average value would be 350 crores, 400 and plus 300. That should the average you should take. So note this, at least note it down because these kind of small question comes because this is related to valuation and they ask this kind of questions. You may ask a question to me, what is a significant difference? That word significant difference is not defined in the IBC. It is a judgmental. Generally, the judgment is 20% up and down is considered fair. Okay. Anything above 20% is a benchmark. There is no written rule of this. It is a practice followed by industry. Rajkumar ji, if you can throw some light, what you follow? If you have done any case where there is a difference in valuation, generally.
Sir, I have recently qualified in June only. I have got registered in June.
Acha,
So,
okay. So you just need to got it. Fine. What ETG has mentioned. So generally 15 to 20% is a range. Generally, there is no. If you ask me, show me where it is written. Nowhere it is written. But this is what has been followed in one of the judgment of IBC of IBBI of last maybe in January and February. There was a difference of 25% between two land and building values. IBBI says it is reasonable difference. It is not a significant difference. So generally people consider 20% benchmark. Depends on case to case, you can take up to 25%, but you cannot say 40%, 50% is a reasonable difference. That is a significant difference. So that is the reason whenever you issue a report, before issuing a signed report, you always share it to RP, and then RP will say, your this number is coming very out. So then you need to relook at the report. So just take care of these things. Mandatory valuation, Companies Act, IBC, and in SEBI, real estate investment infrastructure funds and InvIT funds, in SEBI they mentioned registered valuer. For other cases, income tax, RBI, banks, not mandatory. But a very good news for valuers is recently SBI and SBI, Canara Bank, and IDBI Bank and few banks have started floating tenders, floating empanelment forms, where they are taking on board registered valuers of land and building, PNM and SFA also for doing asset valuation. So that can be another good set of area of work from banking sector, because they started now. There were a lot of non-registered valuers lobby have gone into High Court and Supreme Court against those cases. But for us, at least now, the good thing is the bank has started empaneling, and they just started last month. So it is expected the work may start flowing in next 2-3 months later, but it's a good sign for professionals to work in. Now, just 2 minutes we'll take on this slide. Mandatory. Yes, it is mandatory. Deepakji, it is mandatory if it is issuing shares at premium, mandatory a report from CA or from a merchant banker. And if it is FEMA, it is for issue to NRI, absolutely mandatory. Now, the new draft bill has came in April 2020, recently in the lockdown period. So they issued a one draft values bill. Now, what the bill is talking about, and I always say it is a journey from one section to full act. So in Companies Act, we have only one section 247 for valuation. Now they are making one bill, one act only for valuation. So entire act is only for valuation. Now this is like one state, one rate, GST like. So this act will say, now whatever acts we are having in India will use only registered valuer. So this is a very good change, because what they have written in the framework, they have written that once the framework of the new bill gets passed, in the framework they have written, once just a second. In the framework they have written, once the new bill gets passed, they will start with Companies Act and IBC. The new committee, the National Institute of Valuer, has to ensure that all other acts should come in. For example, and they mentioned the name in the draft, that Banking Act, Income Tax Act, SURFACE, FEMA, SEBI, Black Money Act, LLP, they should include registered valuer mandatory, and then only registered valuer should do evaluation. Then merchant bankers and CAs will be removed, and they will include only one category, which will be good for industry as a whole and professionals as a whole, those who are taking this profession. As of now, they missed to include GST in it. So when they mentioned, they did not mention GST. But what we understand from our seniors, that GST committee chairman is a part of valuation committee of this new draft bill. So it has to be included later, or sooner or later. So GST will also be there wherever the valuation issues will be there. So it will be a huge opportunity coming next 2-3 years later, which I foresee, because the draft has recently came. The comment date was 28th of May. That has been over. So a lot of people have given a lot of comments against the draft, which they suggested changes. We expect 6 months minimum, government minimum 6 months to 1 year to get this draft approved. Once this draft gets approved, you all will, those who are already registered valuers, will be converted into the new valuation automatically. Suppose tomorrow that draft gets approved and the new act comes in, and IBBI power ceases and this committee takes over. So they have a provision. Those who have done 50 hours of training and have not given exam or have not qualified the exam yet, they will be given 3 years time to pass the exam from the passing of the new act. So you have sufficient time, so don't need to worry on what will happen if the act comes. So that should not be you're bothered. Yes, because the auditor is correct. You have mentioned a correct point. Auditor is allowed mandatory in SEBI and FEMA that get a certificate on NAV based. But this Companies Act, RBI does not follow Companies Act, so they have a different act. So that's why we are having a different answers to this. That is the logic. We are having a different view. So that's why I also said in the first part that alls are not synced. They're having a different contradictory in all different acts. It becomes an issue. For a Companies Act, you're getting a registered valuer. Income Tax Act, you're getting a CA, merchant banker. FEMA, you are getting a CA or merchant banker, and they have a different value. The value definition is also not same, because if you go to income tax, the value is different. If you go to FEMA, the value is different. So conceptually, it is different. So it will take another 1 year to get all things aligned. It is just a beginning. A few things we need to remember in the valuation basics for a conceptually purpose, and in exam, some things can come as a twist. What is valuation date? The valuation date is always the date for which you are valuing the asset. So suppose if I'm issuing a company shares of a company, I can take 31st March 20 as a base, 30th January as a base, 1st April as a base, whatever the company says me. So this valuation date is always decided by the client. So client will say, come and tell you that do a valuation of my company at this particular date. So that is not your choice or not your call. It is always client's call. So that is valuation date. Report date, we understand the day we are issuing the report. And this report date can be anytime. So suppose I am doing it today. If somebody asks me to do a valuation of 1st January 2019, so almost 1.5 years back, I can still do a valuation. I can issue a report date today. If that makes him happy for any compliance purpose, I have no issue. Nor the standard says that you cannot do a valuation of 2-year-old value date. So valuation date and value report date, there can be any differences, but for sure it cannot be before. So I cannot say my valuation report date is 1st of July and valuation date is 1st of August 20. I cannot give a future valuation. That I cannot do that because I do not have a ball gazing feature. There are two premises you need to take care of doing a valuation. The premises are, do we assume it's a going concern or liquidation? Your entire value will change if the premises change. So in case of IBC, if I know the company is in a liquidation, my fair value will be different. And in case of a normal valuation, my fair value will be different. So we need to always see what is the premise. Now, the last point of UDIN. What is the issue of a UDIN? The issue of UDIN is mandatory for those chartered accountants who are holding COP. If you are a CA and holding COP and you are a registered valuer from any RVO, you are from this RVO, CAS, ICW or any other RVO, if you are issuing valuation report under RV itself also, then also you need to issue a UDIN mandatory. A lot of people objected to this question, they objected. So whenever you're issuing any report, which is where are you going? Suppose I'm giving a report to management, and I'm signing as a chartered accountant, and I'm saying that management can only use for internal purpose, then also it is required. So a lot of people objected, and they say that when I'm issuing a report as per RV, I have no link with C Institute. Why should I take a UDIN? But ICI has been, this clarification has came so many times, and in the FAQs now it is covered. Even if you are a registered valuer, taken a COP and a CA, you need to take UDIN mandatory. For this reason, and one of the reasons, any idea why a lot of people objected, a lot of chartered accountants objected for this, where other professionals, what would be the reason where registered valuers or chartered accountant objected for UDIN? Any idea? One of the reason they objected, they say that we are not at a level playing field because we have now 15 days limit. So if somebody comes and say, I need a valuation report dated 1st June, I cannot do that, because now as per my code of conduct, I can only do maximum backdating I can do for 15 days. They was having that is a lot of people complained, but now this ground we cannot make an official ground for complaint. So I cannot say, right, to IBBS or ICI that I would not take UDIN because you will not allow me to do backdating, though that is internally my actual worry or actual cry, but I cannot say this in writing to institute or play this. So but what was but then ICI has made very clear, if you are issuing, you need to issue. If you're issuing for internal purpose, it is not valid for NCLT, because when you're issuing a report, you need to mention in the report itself it should be valid for whom and for what purpose it can be issued. So if I'm issuing that this report is for internal purpose, it will not be valid for NCLT for sure. There are certain cases happened where people issued report for FEMA purpose, and income tax department relied on that report. Later on in tribunal, it got quashed because in the report itself it was written this report can only be used for FEMA purpose, so income tax cannot take on that report. So just remember, there is no need to now discuss more. UDIN has to be followed. Good, bad, we need to take it with a strong pill. So there are three valuation approaches worldwide. Approaches are worldwide, three only. Kal, Aaj Kal. Sounds like a Raj Kapoor old movie. What does it mean? Anybody can explain me this? What do you mean by Kal, Aaj Kal? I know how it is what I have deciphered, but what do you think it can be? Does it mean? Any thought process? Okay. Yes. Past, present, future. Okay. Future earning. So this is actually what you have all mentioned. You missed one only. आज आप किसी ने नहीं बताया अभी तक. So this is what kal is. Kal is no. Future and nav is fine. That is, kal is cost approach. Bita hua kal, that has already been passed. So that is a cost approach you follow. Aaj is a market approach. So today, if I am making Ola or Uber or any other, what market is willing or what transactions are happening at market? So a lot of valuation happens on market multiples also. Whenever a big deals happen, they also use market approach. So suppose if somebody is buying a cement industry or investing in cement industry, they will say last 3 years how much transactions happen in cement industry, where the public data available, and then they value on the Aaj approach. And the aane wala kal approach is future approach, that is income. DCF approach, what will happen in future, what do you estimate it? The most certain method would be the most certain, where there is less judgment, is cost approach, where because you have the numbers as of balance sheet date, audited numbers, so you can mostly rely to a cost approach. The most best method considered is income approach, because it is considered, it is specific only for the company, and the company can get valuations as per company's infrastructure. Market approach may be a good approach, but may not be 100% proof oriented, because you are relying data on the basis of market. Market can vary. For example, I am a small IT company. I cannot compare myself with Infosys, Wipro, TCS, because suppose Infosys have given a good result, I cannot say Infosys ka value 100,000 rupees hai, to mera bhi value 1,000 hona chahiye, because I am also IT company. That logic I cannot take. Standard does not say which method is best, which approach is best. Standard gives equal weightage to all three. It is the valuer's call to choose which method he thinks is suitable, and it is the valuer judgment. Whenever you issue a report, you need to document what method I am taking and why I am taking which method. That is your call, and you need to document. Given a choice, tell me, there is a company which is, let's say, more than 20 years old company, be it a private company or public company, whatever you assume, it's a 20-year-old company. Now, why cost approach is not the best approach and income approach is the best approach for such kind of company? Any vague thought, if you can tell me? Any vague assumptions, vague answers? So what I'm saying is, there is a company, 20-year-old company, you have a balance sheet, cost still may not be the best. Assuming you have taken a market value, assuming I'll again further complicate the question, Chetan. So there is a land and building and you have captured at a fair value. So as of today's date, the land and building fair value is coming. All assets are at fair value, which is actual value you can realize in market, exit price. Then also I'm saying, income approach is still better approach. Why income approach is considered better? Anything you can mention? Exactly. What is the thing which is not there in cost approach and which is there in income approach? That is goodwill. And what is goodwill? So I have run my company for last 20 years. Now, after running 20 years, my company will have at least some goodwill in the market, that if I don't do any future marketing activity, at least 2, 3, 4 years, my company can run at least on the brand name I have created in last 20 years. That will be captured only on your income approach. That cannot be captured under cost approach. So that we need to take care of. So that's why income is considered the best approach. So whenever you do a real valuation, practical valuation, you become registered valuers. And if somebody comes that I am a 20-year, 30-year-old company, you only do for cost approach, do not do that until unless you have compelling reasons to do that. So because normally what happens in case of हमें मेहनत ज्यादा किसमें लगेगी, DCF में लगेगी या cost approach में लगेगी? Which will have more work for valuer? DCF approach obviously. So I cannot say कि NAV का भी उतना ही फीस लगेगा, DCF का भी उतना ही फीस लगेगा. DCF will be expensive because I will charge higher on a DCF approach. Client, to avoid cost, client will come and push you. आप तो cost ले लो. If you take a cost, but then that will not be a cost method. So Deepak sir, what you are saying is right. I can always capture, include goodwill by using super profit basis. I can do that. That's not an issue. But then it will not come under cost approach method, because then you are taking income, you are mixing. Then I'm combining two approaches. That is also fine. I can do that. But pure cost approach will not capture that. Pure cost approach. Combination of two can do that. That is fine. That's acceptable. Client will push you to do cost method. They will push you because they know the effort will be less and fees can also be reduced. Generally not advisable for a running company from last 5-7 years company having a showing continuous profits. Not advisable. Only in exceptions like today when COVID happened, this kind of exceptions you can go for cost approach, saying management is not in a position to give a realistic future projections. Agar management projections nahi de pa raha, then you cannot make a projections on your own. So then you can leave that. This approaches will be covered in the second half today. So whenever you get this slide later, when you study, just note the names of the methods. At times they ask in exam names and say this method goes under which approach. So you need to be careful on that, so that you can read after the second session also. Now we'll start coming to the rules first. We'll first take few slides and then come back to MCQs of rules. Read rule 8 first. Just read up to first. Just read this slide before I discuss. Just take 2 minutes and read the slide. So to give you a gist, what does the rule says? The rule says, and this is rules from Valuation Rules 2017. The rule says a valuer will make valuations as per standards notified by central government. As of now, central government has not notified any standards. So there is no standard given by central government. So it is open. Then they say now till the time central government does not give us notification standard, you follow internationally accepted valuation standards, valuation standard adopted by RVO. As of now, there is only one RVO, that is ICAI RVO, which has adopted standards for securities and financial assets. IOV has adopted for land and building and plant and machinery. So these for respective classes, they have been adopted. So now it is your choice. Should I take IVSC standards, international standard, or should I take any RVO standard? If you are a member of ICAI RVO and a chartered accountant practicing, you need to follow ICAI standards and ICAI RVO standards, because they are made mandatory that all chartered accountants in practice have to follow ICAI standards which is same as RVO standards, and all RVs who are chartered accountants need to follow higher of the stricter of the standards. So that is, just a second, that is we need to take care of. Now, when we say internationally accepted valuation standards, what does it mean? IVSC from UK is also international. Bangladesh, Nepal, Bhutan are also international. Sri Lanka is also international. Europe is also international. So which standard should I take? So there is a huge standards. So there is, yes, Belgium ASC is also there. So there has a huge standards. So they have not crystallized. So IBBI has not said choose which standard. They say internationally accepted valuation standard. So there is internationally, there is no body which says our standard is applicable to all. Unlike IFRS, all countries are adopted. So as of now, what is practically people are doing? Practically people are following IVSC standards, which is generally accepted globally. But if you are doing, let's say, US assignments, you will follow American Society of Appraiser standards. So based on different societies, you follow different standards. So that is one of the benchmarks. Now, which standard is hierarchy, that we need to understand. And this for your practical purpose. The moment central government notifies a standard, that has to be a base standard we need to follow. Till the time standard does not, central government does not nominate, we need to go by what the statute is giving a method. If the statute is giving a method, take that method. If statute is not giving a method, internationally accepted standard, that is IVSC. If you are a member of ICRVO, you need to go follow ICRVO standard. Then whatever you want to take, you can take. That is a globally accepted hierarchy we need to take. Okay, for exam purpose, we need to read IVSC standards and ICI standards both, or we should not read ICI standards? For exam purpose, I'm talking. For this IBBI evaluation exam, should I read ICI evaluation standards or no? In my view, you should not read. Though if you are a book lover and if you want to read, it is your choice. My view would be, for exam purpose, do not read ICI evaluation standards, for a simple reason, because unlike ICI, there are 14 other RVOs and anybody can study with any RVO. So why should a member of ICSI, ICMI, or All India, our RVO, which we are studying, why should I read standard of somebody else RVO? So in the exam, you will never get any question from ICI standards. You will get questions from IVS standards. So valuation standards we need to go through, that you need to little bit updated. So globally, there are so many standards. Whatever is up to you, you can follow. There is there is no guidance or no choice. Preferred is IVSC, that is preferred, and that is most easy standard. Yes, sir. Yes, Deepak ji. If a non-CA gets registered with ICA RVO, that standard you need to follow ICA RVO standards, because there are two different bodies. One is ICA is a different body, and ICA RVO is a different body. Both have adopted same standards, and both have made the rules that any CA, if he does evaluation, he need to follow ICA standards. Any RV who is registered with ICA RVO, he need to follow ICA RVO standards. Both are same standards. So if you are a non-CA, still you need to follow ICA RVO standards. The only non-CA will have a benefit only would be he don't need to generate UDIN. That's the only benefit he has. Okay. Now I'll quickly take few issues. What are the major issues in valuations? These are for theoretical and understanding purpose. There is always bias involved in valuation, always biasness. Anybody who says there is no biasness involved, or I am not commenting on generally, I'm saying on myself only. If I say I am a very thorough professional, I will have no bias opportunity. So Ashwath Damodaran has made a very classic quote, and it's a very apt quote applicable to all people at all professions. And he says, you tell me who paid for the fees of valuation, and I can tell you how much biasness has come into the valuation. What he tries to mean by that, he says, you tell me, has the buyer paid for the valuation or the seller paid for the valuation? So suppose if a buyer has asked you to do a valuation, and be very honest to yourself. So a buyer has asked you to do a valuation. Will you give a higher valuation or a lower valuation? Subconsciously, he's not telling you to do any fudging with the number. Subconsciously, our mind will go to lower valuation, and I am also accepting that I also does that way, subconsciously, not because buyer says me, because we are linked to the buyer is paying me fees. So subconsciously I see that let me take care of his interest, so I try to step into the shoes of buyer and try to become more conservative. And it will be actually vice versa. If the seller is paying you the fees, you will give a higher valuation. It is by default. It's not that we are trying to do a wrong valuation. Your subconscious will try to play you with a judgments that play. So the bias will always come. It can never be ignored. And Ashwat Damodaran says how much best professional you get in on the earth, somewhere he will get hinted, somewhere it will be at least 0.1% biasness will be there, that cannot be avoided. But what makes things worse is you totally are biased, you take everything negative or conservative for a buyer and very positive for a seller. That will disturb your valuation. It is always uncertain, especially DCF is always uncertain. So you need to be very careful, because you do a DCF valuation today, 2 years later, when the IT will ask you, income tax will say, sir, उस time आपने projections दिए थे, every year you will do a sale of 10 crore, 10 crore, 10 crore. Now your sale is only 1 crore, 1 crore, 1 crore. Justify. So as a valuer, you cannot justify, because you have made a projection is given by a client, you did your common sense due diligence. But if something does not turn out, business does not work out, it is not your area, but it is expected from valuer that why he has not taken care. Valuation has become more a black box model, that is Excel works it. Too much information overload. You need to have proper documentation for conclusion. Proper, we'll come to on documentation in the rules part. Last part, which is most important here, is I can take care of all errors. I can take care of your skepticism error. I can take care of your judgment. So suppose if I am your lawyer tomorrow, in any place, I can always defend my report or your report. Anybody reports on any of the other methods. Only the last point I cannot defend. If there is a human error in punching the data, that I cannot defend. And there is a classic example. This report is of a Mumbai-based, one of the big values report, and the numbers all in crores. It's a big report. Just see what is the error in enterprise value. What happened? What if you can find out what error is committed here? Income tax department laid heavy penalty on the company just because of a mistake by a valuer. The valuer did not got any penalty. That's a good part, at least for us to remember. The biggest blunder happened was no, that is fine. Pre money, post money, because he's dividing. The biggest blunder, debt. Exactly. The debt was supposed to be minus, but it's at times you put a coded formula that अगर debt लिखेंगे तो जो भी amount होगा वो minus हो जाएगा, and minus minus become plus. So instead of actually reducing the debt, it actually added the debt. So your valuation is doubled by 42 crore rupees, and that the valuation. So this was treated as an addition, something like that, and a huge issue happened on that valuation. So the client says it is valuer's fault. So the department says no, valuer has done a fault, that is fine. You should have also checked it. अब client logic was article को दिया था उसने punch कर दिया. That kind of logic you cannot go to give an income tax कि बच्चे ने गलती कर दी. Ultimately you are signing. So punching errors we need to be taking care of very much. You want to take a break for 5 minutes? If you want, else we can continue. I am fine. If you want to take, we can take. If you don't want, we can continue with MCQs also. Decide quickly and let me know. Continue is fair. It's better. In the meantime, we can take a 1 minute break. In the sense, anybody want to take water and all, you can take it. In the meantime, I'm uploading the next presentation in a minute. Just give me a minute. And in the meantime, also, if you can open the PDF I sent yesterday for the rules, if possible, open that also. That will help you. So the rules are very theoretical, but again very important for exam. At least 4 to 6 marks comes from the rule. That's the range. If the good luck is running very good, you'll at least get up to 6 marks, else 4 marks at least comes from the rule. How it comes and way it comes, we'll also have a look now. Okay. Did anybody got a chance to go through the rules? If those were IPs, I'm sure they would have gone the rules in the time of IBBA rules. It is almost same as per insolvency rules, almost same. Little bit, just a second. Little bit different from IBC rules. So let us understand few things. Quickly answer. I know. So now we are doing a reverse process. We have not taught the rules yet still we are going to attempt questions. And so why we are doing so? By doing this, we'll come to know if I have not read the rules, subconsciously or by my guesswork, what answer would I have given if I don't read rules thoroughly. So if you make a mistake here, at least you will recall that in exam you will not do that same mistake again. So quickly answers, and I'll need your quick respond quickly to respond. I can bet Rajkumar ji and Iti ji will give the same answer. I can bet. And why I can bet on this? A simple logic I'll tell you. Now first coming to what is the correct answer. So 10 years is for sure not correct answer and 5 years is not the correct answer. Correct answer is 3 years. Why I know Rajkumar ji would have chosen 8 years or if Iti ji would have chosen 8 years, for a simple reason. Because in IBBI insolvency rules, the rules is mentioned that the IP professional will make a record for 8 years. That's the rule there. Just note this down separately. In valuations, in the valuation rules, the rule is that minimum he need to make for 3 years. So 3 years is in valuation. So just this is a classic difference. That's why people get fail in then MCQs. Why it looks like a negative marking. So because when you will attempt the question, you think I know the correct answer. That should be the 8 years. But in fact, the answer is 3 years. So just note this, note it down. You all will get whatever PPTs and I have been shared and anything which I have not also shared, you will get all documents. So don't worry on PPTs. But the only reason I'm asking you to write it down, the moment you start writing it down, it goes to your, it hardwires to your brain. At least you will remember something. अपना लिखा तो at least याद रहेगा. Now attempt.
पाँच
जल्दी छोड़ दूंगा 5 बजे से पहले छोड़ा दूंगा बस.
Oh, sorry.
No worries. No, I understand. I know. This is also same my issue. If I tell my wife I'll finish lectures by 2 o'clock, she says 2 बजे तक. मैंने कहा ठीक है भाई. No, that's on a lighter note. Now coming to my one unsolicited advice would be, whenever you are attempting any MCQ and you do not understand the meaning of that word, generally that would be the answer. But again, you should apply this this logic very carefully. So I said when you don't understand the meaning of a word clearly, that means the correct answer is fourth right. Logically, it seems that ethics, transparent, prudent may sound right answer logically, but the correct answer is fourth right. Why fourth right is correct answer? Because in the rules they've written, a valuation shall maintain integrity by being honest, straightforward, and forthright. We'll also read the rules, but just note down that fourth right should be the correct answer. Quickly answer this one. When I say quickly, means read the question and answer. This question depends on your English. So it's an English test. So those who have been convent educated will be able to answer correct. By this I'm putting people under pressure. Okay. Now you tell me one thing before I tell the answer, and I'm sure you will also tell what is the correct. given the 4 options as a professional, what do you render? I'm expecting any answer. So राजकुमार जी फिर क्या आंसर होना चाहिए? You always render service, you display integrity, you display professionalism, you portray professionalism, you follow ethics. The correct answer is service. So these rules are very confusing in exams if you have not read thoroughly, and that is the only actual issue of MCQ rules of 4 marks. So this 4 marks or 6 marks I consider to be a low hanging fruit. If we read thoroughly, we'll be able to get easily. If we have read lightly, we may not be able to get correct answers. And I will also tell you in the rules why the service, the word where it is written, why it is the correct answer. So if you are not able to follow right now, just bear with me, don't worry. In the rules we'll cover. Answer this. Anybody else? So you all need to answer. Attendance तभी मिलेगा. So we all are clear. C. Achha, Chetanji has given C and Vimalji C. My only one question to Chetanji and Vimalji and Sujitji also, who has given C. Sir, be honest and let me know if something is only expected from you, only expected. Will we do 100% or we will try? Again, please don't be sorry. Again, I'm just asking. Again, it's not. I'm not pinpointing. I'm just asking one fundamental question. You will try. So will IBB expect you to try or IBB expect you to, you should at least do? I'm just think from a regulator point of view, because these rules are made by regulator. The moment regulators say will put hands on try, sir मैंने कोशिश तो बहुत की थी पकड़ने की but नहीं पकड़ पाया, you know that happens. And so try करने की कोशिश करी थी, सही डेटा लेने की कोशिश करी, नहीं मिला, but ठीक है. So is expected cannot be answer C. Now those who are into law field, whenever they make a law, they use the word should or shall. What word they use generally make in law? Shall. So the answer has to be shall continuously. And note one thing, in none of the rules the word is should. And I'm sure Manoni ji has to give the correct answer. Being a lawyer, he has to give a correct answer for this. Just note this down, that whenever any rule comes, any question comes, we're having a should as an answer, it should not be a correct answer, because there is no word should in the rules itself. So it has to be shall always for valuation rules. Now this question looks very confusing. And when this question came to my attempt, I got so confused, because in the first attempt, I told you that I did not pass in first attempt. I secured 59.5. One of the reasons was I have not read the rules correctly, because that was our first time nobody told the importance of rules. In this question, all answers look almost correct. If you read any of the answers, any of the options, you cannot say any it is wrong. All options look correct. When it came to me, I choose the option D. I thought externality means पूरा ब्रह्मांड इसके अंदर आ गया, एक्सटर्नल का इन्फ्लुएंस भी आ गया, फैक्टर भी आ गया, एनवायरनमेंट भी आ गया. सो आई थॉट डी इज द करेक्ट आंसर. दैट्स व्हाट माय थॉट प्रोसेस. दैट वाज अ रॉन्ग आंसर, because when I went back to the home and check, option lies between A or B. That is one of the correct answers. A or B can be the only correct answers. C and D is not the correct answer for sure. Now in A and B, what the valuer should not do, should not be, valuer को क्या नहीं होना चाहिए? He should not be influenced. So influence is the correct answer. So that is the way. I know for me it is very easy to answer because I have read it and passed it. But for you it may sound tough. But एक बार अगर हम rules पढ़ेंगे and we understand, you will be always lied. Influence would be included in factor. Exactly. Correct. Absolutely correct, sir. Agree with your point. But why influence is the right word? Because in the rules they mentioned that yes, exactly. That is a logic, Rajiv, which the regulator is going. Your influence hits your independence. If I'm influenced by you, because external factors is a broader term, so they may have so many other things. But influence is most important term which you need to take care to decide whether you are independent in mind and fact also. This I'm sure nobody will go wrong on this. I'm sure nobody can go wrong. So the rules has very clear, a valuer cannot charge a success fee. A success fee cannot be charged. In the rules it is mentioned, a success fee cannot be charged. Ironically, you can charge abnormally very high fee, you can charge a low fee, that is fine. And since Rajkumarji has done IBB recently, he would be aware, I'm sure, if he got a case. In one of the big valuation assignments, I'm not able to recall the name of the valuation company which was under valuation under IBC. It was a very big company, something related to Bhushan Group, one of the Bhushan Group company, a very big company. A valuer quoted ₹1 as a valuation fee, because you know how does valuation works. And so Rajkumar ji will send a floater to send a floater to email to 5-6 valuers. He said, this is the engagement, you tell me your fee. So I can quote 1 lakh rupees, I can quote 10,000, any fee I can quote. So somebody quoted ₹1 as a fee. No, Manmiji, that Deloitte quoted for restructuring of ILFS. That is for other. I'm talking only for specifically for IBBI valuation assignment. Somebody quoted ₹1 as a valuation fee, and that valuation fee got challenged in NCLT. NCLT question, IBBI question, why you are putting valuation rupee as a 1 fee? Any idea why you think one what would be the IBBI question on ₹1? Why they asked, and what would the value response? What would have been the value response on ₹1? What response value would have given to IBBI that why I charge ₹1? What was his logic? His logic was, sir, in your rules it is not mentioned what is the minimum fees. So you not mentioned what is the minimum fees, so I can charge any fees. By charging ₹1, I want to get the client and I want to build my portfolio. So tomorrow it comes to me that it comes in newspaper that Sumit is valuing Jet Airways with ₹1. So having Jet Airways in my portfolio will eventually increase my goodwill in the market. So tomorrow when any other airlines goes into IBC, it will say, okay, Sumit has valued Jet, he has an exposure of Jet, so I will get my more business. So that was the logic he has given. IBB rejected his logic and say a professional need to be reasonable and need to be sensible. One will not have so success fee here they have not defined, but what it means. And why success fee is the correct answer? Because in the rules they've written, a value should not charge a success fee. So that means you cannot say to a client, I will value, let's say I will give you value 100. If your transaction happens at 100, you give me 20% fees. If your transaction happens at 500, you give me 30% fees. So your fees cannot be linked with the valuation item of valuation. So you cannot say, agar valuation 1 crore nikla to mujhe itna de dena, valuation 10 crore nikla to itna de dena. They say your effort should not be based on your your fees should not be based on the amount it is coming. Okay. So once we go to the rules, we'll see where it is written and why it is written.
Sumaji, but if I go on to that basis, if my fees is based on the amount of the value, does that not mean actually contingent rather than success? Success means the success of the transaction.
Success of the transaction.
But here the fees should not be based on the valuation that I'm arriving at. So if my fees is say a percentage of the valuation, it is in my, I'll be influenced to arrive at a higher valuation, which is not required. Success is something that the other person goes on marketing basis.
What is happening here in other RVOs? Let's say I'll give you a specific example of IOV RVO and few other RVOs who deal into land and building and plant and machinery. So they have issued a guidelines that if the value of the property is coming 1 crore, charge 1% fee. If the value is coming 1 to 10 crore, charge 2% of the fee. So that is considered okay by IBBI, saying that this is the effort they're estimating. So though it is a contingent, and I fully agree with your point, then I will be influenced. It is just like as a chartered accountant, when I am getting a choice of branches, I will prefer those branch which have a higher loan amount, because the more lower loan amount higher, my fees will be higher. So that is indirectly your influence. And if I know that my fees is based on valuation, then I will always try to get a more valuation.
Sumitji, there my work does not get affected. I may choose that branch accordingly. But here, if my valuation is coming to 90 lakh rupees, it will be in my favor to cloud that judgment and arrive at a valuation of 105 lakhs, 1.5 crores, because my fees
fees is linked to that. Yes,
so technically it should, and there is no success word which is involved with this valuation. It is a contingent which is a very
I
prohibited
agree.
thing that should be there.
But unfortunately, when they made the rule, they have not put this clause, contingent. They put success because there are certain M&A transactions they happen where they charge their valuation fees based on success of the transaction. So I am doing your buy and sell transaction. So I take out a value of you and I will say, give me X amount now. And if the valuation happens, if the deal happens, then you give me certain percentage of deal. That have been considered success fees. They say you should not do. And that lot of consultants used to do these kind of valuations, because client will be interested to get a valuation only when the deal is happening. So if I tell a client I will do a valuation but deal does not happen, then client will not be willing to pay. So that's why they put a success factor, which IBB has strictly rejected, that you should have this kind of factor.
Okay.
In my personal opinion, contingent should be also excluded, but other asset classes have strongly defended this. They say that this is the benchmark we need to put. You cannot say that we want to guide our members. It is just like ICI giving an advisory that if the turnover is this much, charge this kind of fees between city side. So that's what they are putting. So personally, my personal view would be I will also include content fee. That's my personal view. But regulation wise, they have put only success fees.
Okay.
Okay. Coming to this question. Generally, chartered accountants prefer D as option generally, which is incorrect. The working paper is not there. So D is incorrect option because that's generally CS choose that option, which is not a right option. Because why it is not right? It rules में नहीं है इसलिए सही नहीं है. Otherwise, so common sense तो वही आना चाहिए. So rules have written contemporaneous. So that's the word they have put. Now they are twisting questions also. Exactly. Yes, Rajkumar. Good, somebody followed my advice. Now they are asking twisting questions also. So now so what will happen once you go to sit an exam? Suppose two people, let's say Rajkumar ji and Sahil goes together to give exam. So they're sitting nearby next to next computer. They will not get the same paper. They will get a different papers always. It's not numerically different. Entire question set will be different. 100% question set will be different. So in one questions bank, they will be having this question that tell me which should be how the record should be maintained written contemporaneous. In the next question, they may have a question, tell us what is written contemporaneous meaning. So once we give you the option, you will understand what is the meaning. So they are also asking what is the meaning of written contemporaneous. And this meaning is given in the rules itself. So what is this meaning? This word means that as a valuer, you are documenting on what basis you have arrived the information, what is the source of your information, where have you taken it, so that when a man of prudent knowledge like you reviews your file, he will come to know from where you have arrived and he can reach to a conclusion. So that's what he has put in. So just take care of these kind of words. Quickly answer this one. For sure, C and D cannot be on a common sense also, C and D cannot be answer. Regulator will not say you have to be honest. It is assumed that whoever all become registered valuers have to be honest. And they will not say be humble, because if you're not humble, the government department will make you humble. So C and D are out of choice. A and B is the only one. If you receive a letter from income tax department, can you ignore to respond, or by default it is assumed you need to respond? So by default, it is assumed I need to respond. So rules will not say, okay, go and respond to regulators. What they can expect you is at least cooperate. Whatever data you have, be humble to him, at least be relevant to him and provide and cooperate. So cooperate is the correct answer. This question, again, from a common sense, even if you're not read the rules, from a common sense, you might get it. At times, common sense is not there. So when this question came into my exam, I choose Supreme Court as option, and a lot of my other colleagues also who choose Supreme Court, because sitting in AC and a comfortable home environment is different while sitting in an examination center where the clock is ticking for 2 hours. So we thought D should be the best answer because it is Supreme Court is the biggest thing. But then we missed a very basic common sense point, and the answer was A. It was a very simple common sense which we missed in exam because we were under tremendous pressure. And the concept was whenever there is an appellate tribunal, a tribunal has to be there before. So it follows the sequence. So this is at times your common sense. If you are alert in exam, things can help you out. I think there are 2 or 3 questions more left before we go to the rules. This generally people will give a wrong answer if you have not read the rules because that will never click you. So the correct answer is undermines, and generally undermines what we never think of, but that's what has been written in the rules, that it should not undermines his independence. So though dictionary wise jeopardize looks much better to me, but the correct answer is undermines. Second last, probably last question. For sure, in this question, D can never be the answer and B can never be the answer. For a simple reason, why B and D cannot be the answer? For a simple reason. First of all, D does not sound a good answer because liquor, we cannot write in rules, do not give liquor. So that does not look good because somebody will ask which kind of liquor, country liquor, IMF liquor. So they want to avoid this kind of, because we professionals ask a lot of questions. So B cannot be also answer. Why B cannot be answer? Though practically kickback happens, and kickback is in all industry. Okay, everywhere industry kickback happens, but kickback is not a parliamentary word. They cannot write in the rules, do not offer kickback. So that does not sound a good word to write it. So B and D are ruled out. Choice lies between A and C. Common sense wise, I will always be inclined to answer to choose option C, common sense wise. But here my common sense will hit me hard. So C is not also the correct answer. I, as a professional, before passing this exam, I always thought financial means only balance sheet. That's what, being a CA, we are hard coded that financial only means balance sheet. So I never chose this answer, and a lot of my other friends who gave exam, they never thought financial is the correct answer. But when we went into the rules again, then it would be word A. So then they say the word would be financial, because in the rules they've said you should not offer any financial. So I could never imagine that financial means cash also, but that's what in UK rules they've written this word like this. So that's why they're using the word financial. So answer is financial. Now let's understand few forms. In exam the question comes on forms also. So form A has to be filled by an individual once you pass the exam. Once you pass the exam, you need to fill form A with a fees of 5,000 rupees non-refundable. So if you can start noting down, the slide will be with you, but if you can start just noting down, so remember, you can start remembering. So form A is for individual, need to be filled, annexure to 5,000 rupees for registered as a individual RV. What is form B for then? What would be for form B then? If you can start, if you can think anything, form B would be related to? No, form B would be if you want to register for a firm corporate LLP. So if for individual, go to form A. For firm structure, go to form B, and you need to pay 10,000 rupees to IBBI non-refundable. Okay, so A and B are clear. What is form C then? Form C would be for? No, LLP, it's a typo. LLP is covered under form B. So form B includes corporate firms. LLP was corporate. LLP is considered under corporate. Company is also come under form B. B includes for company, firm, LLP, any structure would be form B. Form C is not for RVO. For change in RVO. Okay, no, for change in RVO, they have not thought of, when they made this forms that somebody will change in RVO. By change in RVO, I just remember the Munnabai scene. Sir, I want to change the room. What is the process? So they have not formalized the process of change in RVO. We'll come to that also. Form C is for the certificate IBBI issues against form A or form B. So just remember, form C starts for certificate. So form C is certificate. IBBA will give to either for form A or form B. In return of A and B, IBBA will give certificate. Then form D goes for RVO. If somebody wants to register a RVO, form D would be there. Any idea how much fees would be there? So we know fees of 5,000 for 5,000 for individual, 10,000 for this. Form B, I know Vijayji would be knowing this fees very well because he has actually paid it. It is 1 lakh rupees exactly. So for form D to make an RVO, you need to pay a fees of 1 lakh rupees non-refundable to IBBI, and then IBBI will respond in form E, where they will give a certificate to against form D. So C and E are for certificates for A and B and E. Rest A, B, D are forms. To change an RVO, there is no official form. It's just a plain paper application and a 500 rupees fees from changing from one RVO to another RVO. And the process is very easy and there is no harm. So if you want to change to any RVO or any other RVO members wants to join this RVO, it is freely allowed. No objections there. So that is one. This is all the form numbers. Now comes the question of timelines. Within how much time the form should be approved and all. So question generally comes on the rules, form numbers and timelines. First is general timeline. So the general timeline is generally the day I file a form. So today, let's say today I passed MCQ exam of valuation, and today I filled the valuation form A also. Today I filled. Then from my filing date, within 60 days, IBA need to give me a yes or no. So IBA need to give me approval within 60 days. So generally understand 60 days. There might be errors in my form. So maybe I would have filled my data wrongly. I would have filled my percentages wrongly. I would have filled my work detail wrongly. I would have filled my lot of other details wrongly. For any, it can be a typo errors. So in that case, IBBI will give me 21 days to remove the deficiency. So I filled a form today. After 7 days, IBBI find out, okay, Sumit, this is an error in your form. So they will give me a 21 days window to rectify the form. Now tell me, this 21 days should be excluded from 60 days time period or included in 60 days time period? So it is common sense, it should be excluded because mistake is done from your part. You cannot be excluded. So for sure, it has to be excluded from the IBBI 60 days timeline. So 21 days is separate. Now comes the important point. If IBBI does not want to give you membership, then so it may happen you pass the exam, IBBI does not want to give you membership. They say, okay, we don't want to make Sumit as a registered valuer, though even though he has passed MCQ, I don't want Sumit to be a RV. That is IBBI view. If IBBI has decided that they don't want to give you membership, within 45 days of my application, IBBI will send me a notice. So suppose if I filed application on 1st of July, till 15th of August, IBBI will send me a letter and say, Sumit, we received your application, but we do not think we want to give you membership. This is our prima facie view, and they will give me the reasons, why they think that they don't want to give you membership. And then they will give me 15 days opportunity to respond. So IBBI will say, within 45 days, we want not to give you membership, but we want to give you opportunity. You tell me why we should grant you membership in 15 days. That's what IBBI will give me opportunity, because natural principle of justice needs to be followed. At least you need to give a chance to the person impacted. Now, within 15 days, when I respond, now IBBI will finally decide in 30 days after my response is received that should they grant me or should they not grant me. Now, this is the days and timelines you need to remember and understand times and timelines. Now, can you tell me what can be the reasons where I have given the application, I have passed the exam, and IBBI say, no, they don't want to give me membership? Any idea you can think of? Undesirable person, case against you. Exactly. One of the prime reason is default in CIBIL. If somebody has a default in CIBIL, and the default can be for two reasons, genuine reasons and non-genuine reasons. Non-genuine reason means you actually defaulted, you're not paying the bank loan, so that is not a genuine reason. So for that, IBBI will not accept your application. There can
This
be a
happened with
genuine.
me. Sir, this happened with me. I applied for the IP registration. There was a loan which was coming in my CIBIL. It was
Correct.
wrongly reflected.
That's what I was saying. Yes,
Some
that
other
was I was
person has
saying.
taken a loan. And the loan was very small, 35,000 rupees.
Similar also happened with me. Some credit card due was coming in my of 10 or 12 years old before I left India. That dues was coming into my name. That was long back. So IBBI questioned my as IP that why should we grant you? I said that was a dispute. So if there can be a genuine dispute also. So suppose a card has company has fraudulently charged you excess. So they say it will be a free card lifetime. That letter they've given you, and later on they say now we change our policy. We will charge amount to you. So I said cancel my card. Before canceling, they charge you. So why should you pay for something which you don't want? And if there is a genuine, you can prove that I have a document. This is not relevant, and you can justify. Then they will not they will consider your point and they will grant you membership. As sir has rightly mentioned, Rajiv, they will consider your application and then they will do that. Suppose a case is going against you under Income Tax Act, under your CA, CSI, any, not even a case, any inquiry going on. Even though there is inquiry pending, they will not grant you membership. I know you will come with the logic till the guilt is not proved, give me a benefit of doubt. IBBI is not in a mood to give a benefit of doubt. So there was a lawyer who was having a case against his wife, physical violence case, domestic violence case was happening. Who was beating who, I'm not aware, but the case was pending in the court. This lawyer application was rejected by IBBI for a simple reason. He said till the case gets settled, we will not grant you. He said, and his defense was very logical, till the time it is not decided, court has not taken me guilty, you should not reject my application. But then IBBI was very strict. They rejected the application. They say once the case is settled, then only we will consider your application. So if there is any such things, now there is one that is one of the reasons we understand why people cannot register even by passing your exam. That is one. One of the reason which I think Atulji has asked a question or somebody asked a question that the data is showing that 1300 is passed in NISM and only 1161 has registered till date. Why only 1161 has registered and why not 1300 have registered? So there are few reasons. I know 10 to 12 cases are pending just like because of CIBIL and other things in IBBI. That is one. Second, the rule is if you are into a job, so if I am working in any private company or anywhere in a job, I can give exam, pass exam, but I cannot register as a registered valuer till I am into practice or till I leave the job. So if any member is into employment, any person is into employment, he cannot get registered as a RV till he leaves the job. So you have 3 years time from the date of passing exam. So suppose if you have passed today, next up to 3 years, the passing certificate will remain valid. In 3 years, you need to decide, should you leave your job and start a practice and get registered as a registered valuer or no? That 3 years time is up to you to decide. So that is one. Eligibility of member, it's fine. That will go into the rules. Who's a member? He has to be a member of RVO first, then only you can become a member with IBBI. You have to be a passed exam. You should not be a minor. You should not be a bankrupt. That is a basic eligibility. Who cannot become? If you are a non-resident Indian, you cannot become a registered valuer. If you are competent by any court for 6 months crime or moral turpitude, if a 5 years have not been passed, then you cannot become. Just note down one thing. If you have been if anybody goes to a jail for more than 7-year term, lifetime he cannot become a registered valuer as per rules. This is an exception. I will show in the rules. Also note one point. If there is a penalty levied against you under section 271J, so those who are non-CA backgrounds, they may find it difficult to remember. Just remember 271J. So 271J is a very small section in the Income Tax Act which gives power to assessing officer to levy penalty on a chartered accountant if he is found giving a false advice or wrong advice, something like that. So if those very small section, amount is 10,000 rupees fine only, but if some penalty is levied there, he cannot become a registered valuer till next 5 years. So in exam, a question comes, under which section of Income Tax Act a penalty should not be levied, 271 A, B, C, D, so whatever J. So remember 271 J. And he should, if he's not a fit and proper person, he cannot become. So fit and proper is a very vast term. It is not an easy term. It starts with integrity, reputation, character, convictions, orders, competence, including financial solvency. And that is the reason why Vijayji would have asked you all to send your income tax returns. It's not that the RVO wants it, it's IBBI makes mandatory that whoever is becoming a member, they should share their ITR returns and they will check the returns. So it happened in my case. So I was a NRI, and those who are chartered know that NRI do not file any returns. Like generally they have a nil income of India. So my return was filing nil of 16, 17, 18 income tax. So IBBI raised a question that how can we say that you are a competent person because your income tax returns are nil. Then ICA helped in, chipped in between, and ICA RVU informed them that he is a NRI, and as per his bank certificate, he has a FD balance equivalent which you want to have. So IBBI then accepted it. So because they have their checklist. See, income tax return भरा है, so जैसे nil आता है, they will question. भाई nil है मतलब you are not competent, even though you have a FD balance or something like that. So that is not a concern. Valuation standards we discussed. Now, why we need to read valuation? See the last part. Thank you for the tips. The one on reading RV rules really helped. A lot of questions from there. So we need to read rules thoroughly, and why it is important. I'll just again go through the. Give me a second. Yeah, once your form A is probably then Vijayji will ask once the form A has to be filled. Just a second. Okay. Now, if you can see, this is syllabus part. If you can see from your syllabus, this code of conduct, professional code of conduct, that valuation rules is of 4 marks. It is not coming full, I guess. Let me increase. Just a second. So it will cover 4 marks, and questions are generally coming from the rules, whatever we asked, like gift, integrity, remuneration, ethics, competence. So that kind of questions will come from the rules. That is 4 marks is covered here from the rules. Also, if you see, the same rules are covered again in the next syllabus, next point, which talks about here the registered value rules and the valuation rules 2017. So this talks about chapter 17 of 247 what we read, and the valuation rules. So they are covering twice. So that's why generally in exam you may get between 4 to 6 marks. That's the general. Let me share the rules now with you. If you have the rules with you, it is easy. It will be easy for you to go along with me. If you can download, open that WhatsApp or computer, whatever is convenient to you. This file is on your WhatsApp, else I will share also. Just give me a minute. I think something disconnected on my screen. Just give me a minute. Zoom got disconnected, so it is. Let me retry. My Zoom is not working. In the meantime, if you all have, I think my laptop Zoom is trying to recover. In the meantime, if you have the if you have the PDF open with you all, then you have a copy, then we can start from that copy, because I have the copy from the PDF with me in the meantime. So if you all can open that copy in the meantime, I'll try to see if I can get access to that network. Just open that copy, and the first section is, you read the first line, start from section 247 in the rules. Just let me see, I am getting access now. Yeah, I got it. Just give me a minute. I think slide is uploading. First page number from the rules, first on the top line of the rules. The heading will be the company's valuation rules, values and valuation rules. First page, top line. So I think it is taking time to load. In the meantime, let me take you to the rules directly. So if you read the first line, it starts with, in excess of power conferred by section 247. So this rules comes because their mother section is section 247. Yes, there's the same RV rules 2017. Yes, the one which we shared yesterday on WhatsApp group. It would be a 29-page document on the rules. Yeah. So I think now we are getting the screen covered now. Okay. So you need to read section 247. You need to read 448, 15, and 69. These talks about penalties. So 247 talks about powers of valuation professional, how it comes. The rest talks about penalties. Okay, that is one. Now this rules get approved by central government on 18th October 2017. So just note this down also. 18th October 2017, the first rule got approved. Now what is relevant for you to know, and what so you start, agar aap likh sakte hain to likh lijiye what is relevant, because the rule is big. So I'll try to take you the most relevant parts which you need to remember and at least go through exam. So this rules talks about why we should do a valuation, where it is covered. So it is covering all. Authority, here they say, what do you mean by authority? Where the word authority in these rules means IBBI, that is authority. Now what is relevant for you is to go to point number 3 straight away. So from here the question starts coming. That point number 3 is important to read. And in point number 3, what is most important to understand and read? Clause H, we discussed that he should be a resident in India. If it's a non-resident, he cannot become. This is important to read. The one of 6 months, if he has gone to jail, then he need to wait for 5 years. If he has ever been to jail for 7 years, then he can never ever become RV ever. So this I clause we need to read. J clause, section 271J we need to remember. So that would be, you need to remember 271J, we need to remember that if there is a penalty under 271J, he cannot become. Fit and proper, what we need to understand from fit and proper, in exam, they may ask a question like this. When do we consider a person is a fit and proper? When integrity dash character. So the word reputation would be the answer. The options can be reputation, option can be professionalism, and various other things. So we need to remember, as per this regulation, fit and proper means integrity, reputation, character. That is one we need to understand. That is one. Now, if there is so that is of individual. If a company wants to, a partnership firm wants to become a RV, so there are 5 partners. Sort of 5 partners, how many should be RV? So minimum is 3 is the minimum. Minimum 3 partners should be there to become, who should be registered valuers. Then RV can be formed. If there are 5 partner firms and there are only 2 RVs, it cannot form a firm. If there are only 2 partners, then yes, 2 partners can, 2 RV, it can form a firm. That is fine. But there are more than partners, it has to be minimum 3. So 3 is the benchmark. 4 is not relevant for you. 4 ignore. 4 is outdated. So 4 no need to put attention. 5th also not relevant. It just talks about who can become RV, who passes exam and all. So 5th also not relevant for you. What is relevant is clause number 6. That is relevant, and it is the same clause which we discussed, which we checked from form numbers. You remember we discussed form A for individual, 5,000 rupees. Form B for firm, partnership, entity or company with 10,000 rupees. 21 days for deficiency. Then it talks about. It also talks about within how many days. Form C for certificate, and within 60 days. 45 days if they don't want to give you the certificate, then 45 days. So whatever the last 2 slides we discussed, these are all covered in rule 6. We need to remember. Then 15 days option, they will give a 15 days time to applicant, and then after applicant response, it will be 30 days time. So in only exception cases, the timeline goes to 90 days. So generally it is 60 days, but agar IBBA does not want to give you, so 45 days and then 15 days makes 60 days, and then 30 days extra, that is 90 days. That is very rare. It happens at certain point of places, but generally it is 60 days. That is one. Now there's one reason, again, clause 7 not relevant for you. Clause 7 is general, but just for your practical understanding, why the number of partners, people are not preferring to work under partnership and preferring individual for this clause. Read this clause. Just if you can read for a minute, read this clause. And if it is coming small in your screen, double click, double tap on your screen, it will become big. Just read clause J. So now you understand what is the reason why people are hesitant to work into the partnership. For a simple reason, there is a scary clause which says if we are 3 partners and one partner did something wrong, other 2 partners who have actually not done anything wrong can be held liable jointly and severally. So that might be a challenge on the partners. So that is one of the reason. But again, there's liability jointly and severally. That is a reason which a lot of people are scared. And why they're scared? See, if I make a firm only of registered valuers, SFA, I'm fine. Yes, it is for all. It is for all. It is for all LLP companies also. If I make a firm of a CA registered valuers, I can still manage. But if I'm having a firm of plant and machinery, land and building, how can I take liability for those works? So that is a little bit which is causing problem. But my personal take would be, if you want to work for a longer period in a more mature, more professional way, form a RVE. You may form only for your asset class only. You may only form for only SFA, that is also fine. For a longer future, you should do that. For the only reason, just like in insolvency, banks prefer IPEs to be appointed. That's a bank prefer. Similarly, later on, the regulators, the bank will prefer to give assignment only to IPEs only, RVEs. That's my understanding. And the only reason of forming one of the reasons would be, see, if I have MNC clients, if I'm targeting a big ticket clients, then it is better to work in a partnership firm, because MNCs don't get faith on an individual. They get shaken when you say Sumit Dhadda signing individually. But if I write SD value consultants, 3 partners, they get a comfort. Even though I am the only one who will doing the same work, it will always have a comfort on a firm. That's market perception. Rest individual call. There is nothing right or wrong. It's individual call. Clause 8, you need to remember few things, and this clause 8 will be very relevant for you once you become registered valuer. And why it is relevant? So first we need to understand, as per clause 8, valuation has to be done as per standards notified by central government. Just then, the moment central government forms a standard, that day ICI or any other RVO standards will be of no relevance. because in that case, it has to be only registered, only standards notified by central government. That why it is taking time? It is taking time because central government is waiting for the new committee to come in. Once the new committee comes in, they will ask, they will try to get standards approved from them. A director will be liable if there is a misfeasance, other liability limited director. So how transfers to other directors? So if the director is signing a report, so they say if the director is signing a report, in that case, all others will be held liable. That is the same logic for RV, LLP and this. If it is doing a fraud, then you cannot claim held other directors guilty. But if you are doing only valuation wrong, for valuation perspective, standards perspective, then other will come into fault. But if a director has done a fraud which is not under valuations, then you cannot call other directors guilty. But this clause they have made for certain reasons. Their logic for putting this clause is when they will be getting foreign firms in India, because in the new bill they are allowing foreign firms to set up investment and valuation arms in India, valuation services. In that case, they would like to put all people in into loop. That's what their logic is.
So my point was that if a director is held liable, the person who's signing it, so if there is a default and there is a monetary default, that will devolve on the company, if it is a company, and it will devolve on that person himself only if there is a fraud. So where does the other directors' liability come in? Because if it is a liability of the company, the personal liability of the other directors is anyway not there. And if it is a fraud, it is in any case not devolved on the other
So
directors.
if there is something wrong you have did in a valuation, suppose, and the penalty IBBI says as per section 247, your penalty is coming 1 crore, let's say. 1 crore will come from, first of all, whatever is your fees that's need to be returned. Second, how many people would have acted based on your report. So suppose 10 people say we acted on your report and invested 10 lakh rupees each. So my liability is 1 crore rupees. Now, if the individual director is not in a position to pay 1 crore penalty, that penalty will devolve on remaining directors. Is it sensible? My answer, no. It is, to me, it does not look sensible, but it is a law, so we have to go by it. So that is one of the reasons. Now, because of this clause, a lot of people have started taking, a lot of RVs are taking professional indemnity insurance to safeguard. And this is exactly what happened in PwC in Satyam, because I was a part of, I was working in PwC. Because of this clause that partners may be jointly and severally liable, a lot of directors of left the firm for a simple reason. They are scared that if one partner is not able to pay, other partners may be the liability may fall on. So that is a little bit harsh, but that's what the way they put in. And that is the reason you will see that from the numbers, only 22 entities in last 2 years, only 22, whereas we have been having 1160 individual practitioners. So number itself shows that there is a fear in the mind of a lot of professionals. Last 2 years I am also thinking, I am also in two minds. Should I go, should I not go, should I go? So I'm taking, at times it looks very lucrative, easy to capture MNCs, but once I go into little interpretation, looks tough. The only ray of hope we are having, the only thing which we are having, when the new law comes, new law is taking care of this. So new law says only the director who will be responsible will be taken care of. That should be taken care of. The liability of penalty will fall on the firm, but may not fall on the individual directors. So the
So
company will pay.
question again that if supposing in the current scenario also that penalties which you mentioned, if supposing it is a company entity which is issuing, that company is registered as a RV, and the company issues that report, the person may be signing it, Mr. A, who's a director.
Yes.
So in that case, if there is a default of that 1 lakh rupees, 25,000 or whatever amount, does that devolve on A personally, or it devolves on the company?
It will devolve on the company. If the company does not pay, it will devolve. First of all, it will devolve on the company if the report is issued by RVE. But if the company is not able to pay for any reason, I am hypothetical reasons, company is not paying, then it devolves on the A directly. The A is the signing person. If A is also not able to pay for any reason, then it will devolve to other partner, other directors or partners, whoever it may be. Because that's the catch of the word jointly and severally. So if one can pay, it's fine. one cannot pay, remaining has to bear. So that we need to take care of. Little bit challenge, but yeah, that is one of the reasons which last 2 years I'm thinking, do not do. And I've consulted a lot of people also. They say the law is very clear, it has to be devolved on all. Even though I had a thought of that, if it is a LLP, my liability is limited. They say then it does not remain limited. It goes till the amount of conviction of the court decides. So that is one of the few reasons which it is being challenged, and a lot of people have gone into against this IBBI, but they have not done anything. And in the new rules, a lot of people have given this suggestion to include, so that they say put jointly or severally. So that will safeguard people. I don't know how long.
At the time of entity registration, all partners or all directors would be giving something like a personal guarantee.
Yes, in that case, if you're falling under this law, we are giving a personal guarantee indirectly. Though we don't give officially, but indirectly it is devolving on us.
No, because all other directors personally should be signing it for it to devolve onto them.
No. That's what the rule is saying. The rule is similarly in case of partnership also, the firm here also, if one partner is signing and making a mistake, so they are saying all RVs. So what they are saying, suppose there is a firm of 5 partners, in 5 only 3 are RVs. So penalty will lie only on 3 RVs. One has signed, the 2 other will be also held responsible. The 2 non-RV partners will not be held responsible. That's what they have seen. If you go to the rule, if you see the rule again, so they are saying the directors who signs in respect of valuation assignments. So it should be a registered valuer and the person who signs. So anyone who's signing will be only registered valuer. Similarly, in case of partnership, who is responsible? The partner who signs along with other partners who are RVs. So that is a little bit open-ended for penalty.
No, I was not asking that. I was asking at the time of registration of the entity. So that means all the partners must be signing that particular form for them also to be binded.
Yeah. That form has to be signed by all partners. Form 8, yeah. That has to be signed by all partners. Form B, Form B, yeah, that is fine. Now, why this clause 8 is important for you, not for exam purpose, for your real life practical purpose. Clause 8, subsection 3. This tells you that whenever you issue a report, minimum these points have to be covered into the report. So why this is important? Every 6 months, IBBI asks RVU to monitor your reports. So let's say after 6 months, those who become registered valuers and you make a reports. So IBBI will say, Vijayji, take random sample of your members who has issued a report and check their report. So Vijayji will call your reports and say and check whether your report have been captured these point A to L. If you have captured the points, he will say it is fine. If you have not captured these points, he will say these are not compliant with the basic structure which IBBI has given. So this becomes your checklist that whenever you are issuing report, at least these points are covered some or the other way that we need to take care. That's for once you become a chartered account registered valuer. Now note clause 9, what is relevant? Temporary surrender. So I become a registered valuer today. Tomorrow I got an opportunity in Middle East of 10 crore rupees a year. I will say, let's go and take the opportunity, temporary surrender. Or somebody says, I'm giving you a franchisee of Geo glasses, which is coming new. So I'll say, let me take this franchisee, start into business for some time. So the section says, if a member wants to temporarily surrender, I can surrender. So a member, so as a RV, I will go to the IBBI, I will go to the RVU. As a registered valuer, I will go to my RVU and say, sir, I want to surrender my membership temporary. No, that is not there. We may start next with Rajivji before 15. So, Vijayji, I'm not able to understand what you want to convey. If you can convey me. Rajkumarji, your question is 70 rule has been abolished, removed in valuation, and I'll tell you for the reason. Vijayji, I'm not able to understand. We may start next section. It is 12:45. Before 15 minutes. I think I will skip Vijayji's. Vijayji, whenever the next faculty comes, I think we need to break for lunch also before next faculty comes. So I think we have time. There is no time period mentioned for temporary surrender. It can be for n number of periods. So I'll tell you how a lot of people are using this concept. And question of Rajkumarji, in IBBI, in insolvency, there is a rule that after 70 plus, you should not give assignments to IBBI insolvency professionals because it causes unnecessary stress or tension, or they may not able to handle. In valuation, it was also discussed, should we stop member after 70 to issue valuation reports? Then it was rejected at arm's length, that at a huge majority, the rejection was for a simple reason. They mentioned that the more a valuer goes old, the more knowledgeable he gets, and his intangible and IPR increases. So we should continue allowing people. So as of now, there is no limit. And in the new bill also, they have rejected this concept. They say we should not put any cap on age group on valuation, so that we don't need to worry, that we can continue to function. So as I mentioned, a people in job cannot do a cannot register as a registered valuer. So a lot of people, they are doing, they are into job, they pass the exam, and then they resign from their company for so those who are into small private companies is just like that. They resign from that company for a day, apply with IBBI, get registered, and then temporary surrender. Oh, very good to hear, Raghuranji. I salute the spirit, and good to see. And one of the experienced valuer and IP would be. So they say that I will register with IBBI, take the degree, and then I will get temporary suspension, because one of the reason of getting temporary suspension can be I want to do a job. So if you want to do a job, you can also register as temporary surrender. So there is no time limit, 1 year, 2 year, 10 years, it's up to you. But what the things we need to note in exam, the question comes in. So I went and told RVO today that I want to temporarily surrender. Within how many time RVO should inform? So RVO should inform within 7 days. So just note 7 days. Within 7 days, RVO need to inform. Clause 9 is only for that function. More than that, don't need to read. If you're making a notes, just note down clause 9, 7 days, maximum 7 days, temporary surrender. Within, you need to inform. That is one. Clause 10, clause 11, not relevant for you. Ignore this. Would they do this 3 years period within register? I did not get your question, Deepak ji. So when
job would resign for a day and register and then get suspended, this
yes,
would, because after passing the exam, there is only a 3-year period within which you can register. Is that so?
yes, that is the only reason they do. So if I pass today, within 3 years I can register. But if I know that, so you can do anytime this within 3 years. So maybe on the last day of 3rd year, you can also resign from the company for short, just for a day or two.
Right. Okay. Thank you.
That also you can be done. So clause 10, 11 not relevant for you. There is not obsolete for exam. Clause 12 also not relevant. Clause 12 only we need to understand now that now it has to be only section 8 companies. Earlier it was any section 25 company, any NGO, society, trust, that can be done. Clause 8 is now it is all ignored. It has to be only clause 8. So 12 is not relevant. Clause 13 also, we have covered clause 13 in the same sheet where form D and form E has to be taken. So this clause 13 only talks about form D and form E. So when we covered forms, it is covered. So if you have noted that slide, you can ignore this clause. It is long to read, not relevant. So you can ignore that. Clause 14 also not relevant for your exam purpose also. No need to go through clause 14. You can ignore. Clause 15 also not relevant. Clause 16 is most important. Any idea without reading on the screen? Just understand, listen to my question. To complain against RV or RVO, how much fees I need to deposit? 1,000 rupees, 2,000 rupees, 5,000 rupees, 10,000 rupees, without reading the screen. Any idea how much fees we need to deposit? So 1,000 is the answer. And in exam, this question comes because in IBBI, the answer is different. In IBBI, Rajkumarji, it is I think 2,000 or 2,500 in insolvency. I think it's 2,500 in IP cases. Yeah, so people get confused between IP. They think it is the same 2,500. In valuation, it is 1,000 rupees. So just remember, 1,000 rupees is the penalty amount, is the amount of application. So somebody can file a case against RV, any disgruntled valuer, disgruntled shareholder. So the question comes on amount. So amount is 1,000 rupees non-refundable. So just remember 1,000 rupees non-refundable. because in IP, it is refundable amount. So if I make a complaint and the complaint sounds valid in insolvency, they will refund me that amount. But in case of valuation, even if the complaint is genuine, the 1,000 rupees will not be refunded. Clause 17 not relevant. Ignore clause 17. Clause 18, you need to remember one thing in clause 18, valuation standards can be set only by central government. They only issue clause 18. Clause 19, you need to note down, you need to read clause 19. Question comes on clause 19. What is clause 19? It is a committee. So committee has been formed for suggesting valuation standards. So the question comes in, who are the mandatory members of the committee, who are optional members? So as per the clause 19, mandatory members are from MCA, IBBI, and Law Department. So SEBI, Income Tax Act are not mandatory members. RBI are not mandatory members. They can be optional members, but mandatory members nominated from these three. So at least remember these three. So there are a huge list. So you need to read clause 19 thoroughly. So then central government can nominate from registered valuers, from RVOs, from government. So just need to know. And all three members of ICAs, CACS, ICW are ex officio members. Question also comes on tenure of chairman. So chairperson tenure would be 3 years and maximum of 2 tenures. So maximum 6 years they can have a tenure. So tenure and committee, that we need to remember. So that you need to go through. This clause 2021, if you have read on the top line section 469 and 448, you don't need to read this. This talks about penalty provisions. So once on the, if you remember on the top of the first page of this rules, we have section written 469, 448. So if you need to read the rules, this is covered. This is penalty parts. This is in addition to what is section 247 talking, because section 247 talks about only the non-compliance of section 247. This rule talks about if you have non-compliance any of the rules. That is one. Now this annexure 1, and will take 10 more minutes. 10 is most important because this annexure 1 is code of conduct for registered values, and a lot of question comes from this. And whatever MCQs we have discussed, they all came from here. So this question you need to read once. Annexure 1 you need to read once line by line. That is mandatory before going for exam, and at least once also. There are certain points which mandatory you need to read, which I will just highlight for you now. If you can note it down, that for annexure, in annexure 1, what you need to read. So this one, clause 2, valuer shall maintain integrity by. So these words we need to read: honest, straightforward, forthright. So they might skip any of the 3 words. Out of these 3 words, any word they can skip and ask you an exam. So that you need to underline and read. Valuer should take care of client first or पब्लिक फर्स्ट? किसका इंटरेस्ट मुझे ध्यान देना चाहिए, क्लाइंट का या पब्लिक का?
पब्लिक।
पैसे कौन दे रहा है मुझे? पैसे कौन दे रहा है? फीस कौन दे रहा है? I know I'm confusing. Yeah, the rule says you need to keep public interest foremost, and that is the you need to take care of. That public interest has to be taken care of. So in exam they will remove the word public and ask client, public, government. So answer is public, because that is what written here. Valuer, clause 6, valuer shall render high standard of service. So he renders service, that we need to take care. Valuer, clause number 8, valuer shall continuously update professional knowledge. That is 8. Clause 10, this we need to take care, and this question comes in certain parts like this. Valuer shall not carry out instruction as they are incompatible with requirement of integrity, objectivity, independence. What it is saying, a client cannot tell a valuer that do only NAV method valuation, because choosing a method is a right of a valuer under Companies Act. If the statute says do only as per NAV method, then it is fine. Client cannot dictate which method you need to take. So that you need to take care. Clause 11 is of no relevance. 12 is of okay, ignore, no relevant. Clause 13 fine. 14, yeah, 14 is important. Valuer shall maintain complete independence, shall ensure the conduct independent of external influences. So highlight these 2 words. So clause 14 you need to read. Clause 18, valuer shall not charge success fee. So success fee is out. You don't need to charge success fee. Just need to remember one thing. This might cause a confusion. We discussed in 247, we cannot do an association, have a transaction 3 years before and 3 years after. That's accepted. But if I'm doing any valuation, a fairness opinion or a valuation report, if I have been connected with the company last 5 years, so I just need to disclose in the report. So suppose if there has to be, I was 5 years before I was a director of a company on the 5th year, but I am now doing a valuation today. So as per the rules, it is 3 years commitment. So now it has been passed, but I'm only 5 years. So I can do that. But I just need to give a disclosure in the report that I was associated with this company in what capacity. It is not saying you cannot do, they are saying just inform. Clause 21, you need to read. You should maintain written contemporaneous. What is written? That it's mentioned that you can read. Clause 22, you need to read. Appear, cooperate. So that and be available. That 3 words you need to read. Clause 24, you need to read. That is mandatory. Clause 23, read. 24, here there is a period of 3 years working paper. That is 3 years. Clause 20. Those who are chartered accountants, for them, for practical purpose, the answer is 8 years.
8
Why
years.
8 years? Because under the ICA evaluation standards, they have made 8 years as a benchmark. Under IBA, it is 3 years. So you can always make anything which is hard, which is more stricter. So that is fine. But IBA says only 3 years. If I am a non-CA, for me 3 years is fine. In real life, for exam purpose, answer purpose, it is only 3 years. But practically, it has to be 8 years for CA. Question on gift and hospitality. This is where it is coming. Shall not read 25 and 26 thoroughly. Gift, hospitality, which undermines. So in exams, these kind of words, questions, or he will not offer gift, hospitality, or a financial. So that is the word which incentive and all, which is not there. So word financial is there. So 25, 26 you need to read. 20 rest all is not relevant. Annexure 2, don't read at all. Annexure 2, it just talks about form A, B, C, D. You don't need to read forms. So leave the annexure 2, not relevant at all. So annexure 2 you can ignore. Annexure 3 is important. Annexure 3 talks about Vijayji, we have 15 more minutes, right? Schedule, as per schedule, it is 1:15 or 1. I am not able to. Did we prepone the schedule, or if 1:15 is the Vijayji hai kya bhi? 1:15, fine. Okay. So we have 15 minutes. So now we can cover 15 minutes in this clause 3, annexure 3. Now, annexure 1 was only related to individual as a RV or RVE entity. Annexure 3 talks about how a RVO should function. So annexure 3, the points you need to read and take care of notice. Clause number 3. Clause number 3 of annexure 3 says, if there is a bylaws, how the bylaws can be amended. So the bylaws can be amended by 3/4 of the majority of the board. So bylaws will not be amended by shareholders or by the registered valuers who are the members of RVO. It will be amended by the governing board. And in governing board, the majority would be 3/4. That is 1. Once the bylaws are the BOD decides we need to update bylaws. So tomorrow, let's say IOV, Vijayji's RVO decides to update the bylaws. The moment they update the bylaws, they need to inform within 7 days when the board approves. So if the board approves today that we want to make these changes, the board approves, the board will send to IBBI within 7 days for approval. Within how many days IBBI will approve? Any idea? Then within how many days IBBI should approve? No, there is no timeline given to IBBI. IBBI says we are regulator. We will decide when we want to approve. So there is no timeline. So IBBI can approve n number of whenever they want, whenever they have a free time. But the rule is whenever the IBBI approves, within 7 days of their approval, it will come into effect. So that is one thing we need to remember. So three things to remember in this section, four things technically. 3/4 majority required. Once you decide, within 7 days you need to send to IBBI. The day IBBI approves, within 7 days you need to get it impacted. Last, within 15 days, when you approve, so you approved, IBBI approved it, then within 15 days you need to send a printed hard copy to IBBI of those amendments, so that IBBI can check कि हमने जो आपको अप्रूवल दी थी आपने वही का वही चेंज करके हार्ड कॉपी में डाला है. So that's that we need to remember. In exam, the people get confused here. They miss 15 days and they say 7 days again. So for hard copy it is 15 days. So just note down for this difference, hard copy is 15 days. So for RVO there will be a board and a governing body separate. No, the same. Governing body itself is a board. So governing body itself is a board. So if you see clause 4, that talks about governing board, that is the same board. So we are just using one word, governing body and board synonym. You can have as many as number of directors you want. It is up to you. They don't fix it. But what the condition is, more than half should be resident in India. More than half should be independent directors. That is two. That is two conditions. One, we need to remember, more than half should be resident and more than half should be independent. Another condition is not more than 1/4 should be registered valuers. Any idea why this condition they have put? Not more than 1/4 should be registered valuers. Isn't it look little bit different कि हम RV हैं, RVO हैं और हमारे members board में नहीं रह सकते more than 1/4? Any idea why they would have put this condition? Don't take assignments. One more reason. They say if we put RVs on the board majorly, they will take care of only their interests. They will not take care of public interest. When we have majority of public figures who are not RVs, they will take care of industry as a whole comfort. So they will also take care of if the client is getting punished or not, or client is getting troubled or not. So they will take care of all pictures, not only RV. Because if we are RV, our vested interest would be there. Now, if there are, let's say, if there are 9 members in a board, how much can be, what can be the maximum number of registered valuers on that board? If there are 9 members, then anybody with 3? So in exam, if this question comes, it has to be the number will come somewhere around 2.5 or something, 2.3 or something, odd number or sub number. But why we are not taking 3 and why we are 2? Because the rule says wherever you have mentioned not more than, you will round off to the next lower number. And wherever the rule says more than half, you will round off to the next higher number. So that is the reason why 2.5 should not be go to more than, yeah. So that logic we need to apply. So just take care of this. The chairperson will always be independent director of the governing board, always. That is one. Now you don't need to go through this model bylaws part 2, clause 1, 2, you don't need to go through. What is relevant, you need to go through clause 7. You need to come from committees. That is relevant. So you need to, question comes on committees. What is mandatory, what is not mandatory? So one is committee, the advisory committee of members. By reading the word, the governing board may form an advisory committee. It's an optional committee or mandatory committee? It's an optional committee.
May.
Advisory is an optional committee because governing may. So may is karo to karo, nahi to mat karo. It's your choice, right? It's a poor drafting of the law. They have mentioned optional committee first and mandatory committees later. See, other committees of the organization, the governing board shall constitute. So shall is compulsory. So for me, in exam, the question comes advisory, like which is the optional committee? So advisory committee would be the optional committee. Which would be the mandatory committee? So mandatory committee would be these 4: membership, monitoring, GRC, and disciplinary committee. That we need to. So generally, for a regulator will always read may as may and shall as shall. But for a consultant and for a company, you need to always treat may as shall. That is undefined law. Exactly. But for exam purpose, Optional committees as advisory committee. Compulsory committees are these 4. And we need to also remember when we read, so just highlight 7 and 8. GRC will have minimum 3 members. In rest other committees, they have not mentioned how many minimum members, but GRC 3 members. And in disciplinary committee, there has to be 1 member nominated from IBBI mandatory. So just take care of these fine difference. So these 4 committees will be there. Their chairperson will be independent. Clause 9 not relevant, leave the clause 9. Now tell me, if you apply for a RVO membership and RVO rejects it, what we will do now? Where we will go? Quickly answer. So I applied for a RVO membership. After passing exam form A, RVO rejects it. Then what should I do? Where should I go? Quickly you need to answer. You need to tell me, where should I go? Complaint to RBI. Before that, you need to go to read clause 8. Clause 8. For 10th point clause 8, you need to go to membership committee. This is a very funny, that's why the common sense is missing in these regulations at so many times. Vijayji, don't record this. I'm saying this because then IB will take me along. What they are saying is, now you need to go to membership committee. My common sense always goes, it's the membership committee would have rejected me. Then why should I again go to them? But they say, no, how do you know membership committee has rejected it? That does not logic goes. So they say, and any applicant who's agreed for a decision rejecting his application may appeal to membership committee within 30 days. So you need to appeal to membership committee within 30 days. So just note 2 things. Once your application is rejected, you appeal to membership committee within 30 days of your rejection. And the membership committee will decide within 30 days that to do what to do or not to do with your application. So 30 days need to be remembered for exam purpose. Clause 12 is not relevant. Clause 13 is not relevant. 14 is not relevant. Don't read at all. It's waste of time. 15 is not relevant. 16 not relevant, but just for your practical purpose, why is 16 there? Every 6 months you need to submit a report to IBBI. All engagements which you are doing or assignments you have done, you need to give a report to IBBI, so that IBBI comes to know how much you are doing a work. Later on they will charge, it is assumed later on they will charge some TDS on your assignment fees also, just like they did in IBC. So every 6 months you submit a report of IBC and they charge 0.25% every annual on your revenue. That they will do in, expected they will do in IBC, assumed. So that is only for practical. So once you become RV, you need to maintain documents record in such a way that every 6 months you can submit data to IBBI quickly. So that data will be submitted. 17, 18 not relevant, 19, 20 not relevant. For now, what is most relevant for you to read? From clause 21 of this rule RVO to clause 26. This entire rule you need to read thoroughly, because question comes from at least 1 or 2 question comes from this rule. So 21 to 26 read thoroughly. If you have any, maybe you can read today or tomorrow. I'll be covering other sessions also. If we are not clear on any point, we can cover that. But you need to read that first for in detail. Clause 26 talks about when you can surrender. So now just note 2 things. We read that when a member wants to surrender, he will go to RVO and RVO need to inform is within 7 days. When should member tell RVO? Within 30 days, before 30 days, he takes up a job or he becomes a non-resident or he starts any business. So you cannot be a businessman, you cannot be into job, you cannot leave India. If you're leaving within 30 days, inform IBBI RVO. So you can do a temporary surrender. That is fine. 27, 20, 29 not relevant. 30, you just need to remember 30. If IBBA, if your RVO sends a notice, notice for paying a fees and you have not paid a fees, your application can be expelled. That is 1. So clause 31. That is the last clause. And last annexure 4. There is this annexure talks about if somebody wants to register under P&M, what qualification he should have, what experience he should have. If somebody wants to register under land and building, what qualification he should have and what experience he should have. Similarly, if somebody wants to register under SFA, what qualifications he should have and what experience he should have. should I read only for SFA or I need to read for land and building and plant and machinery also? What is your view? It does not sound logical, but you need to read all three. A lot of people ignore land and building and plant and machinery, saying why should I read them? But this annexure 4 is in your valuation rules, and it is not saying that SFA should not read. And at times in SFA exam, they ask a very simple question: out of all this 4, who is eligible to register under land and building? So these are certain absurd questions which we need to take care of it, and at least read once. If you read once, at least एक बार underline करके पढ़ लेंगे, at least it will struck you कि civil engineering होना चाहिए, architecture होना चाहिए, town planning होना चाहिए. That is sufficient for you to read. But if you ignore it, exam में समझ में भी नहीं आएगा कौन सा section होना, option होना चाहिए. That you should take care. I think it's your lunch time now, probably. So we'll break. It is for the same reason constitution review governance we have to read. No, why we don't need to read the governance? Because they don't have a question out of them. So they are just talking, you need to form this committee. So that is, we have read committee. So they will say you need to publish bylaws. So we know they need to publish bylaws. So we have covered. So ideally, if you can read all, that's much better.
There are a lot of questions which you said we should be knowing about the operations of RVO and how they're registered and other things. But as a practicing RV, why should I be concerned so much about the constitution and the board and other things of RVO, which IBBI would be doing?
Which is not actually relevant for us, absolutely. And that is the reason, sir. In the first slide I showed you the screen, the questions are absurd. So personally, if you ask me,
I was mentioning here, it is for the same reason that even though SFA is my class, I still need to know land building and all of others. What are the qualification and other things, even though it doesn't concern me.
Yeah, even though it does not concern you. And maybe when during the course tomorrow and after tomorrow, I will also tell you some certain things. You will say this is absurd, but yes, we need to do, because they're asking certain questions which you think, why should I know this? Like, for example, question, under which chapter of Companies Act it comes? What value it is giving to me to come under chapter 17, chapter 18, or does it matters to me as a professional? It does not matter. So you should not ask questions which are memory based. But unfortunately, that's a trend, and I'm sure Rajkumar ji will appreciate it, because since he has given IBBA exam, the kind of questions insolvency they are asking, nobody can even think of. So that's what.
So we can think of it because
Sometimes questions are such silly.
Question answer, because a bureaucrat must have designed that question paper.
Absolute. It is designed in a such a haphazard. Rajkumar ji को एक silly question बता दो आपके IBBI का थोड़ा सा.
याद तो नहीं है, लेकिन मैं I failed 2 times in IBBI. ठीक है, कई बार होता है ना, क्वेश्चन घुमा फिरा के आ रहे हैं, कुछ समझ में नहीं आता कि एक्चुअली में वो क्वेश्चन है क्या, उसका आंसर दे क्या. Then in third attempt I thought कि जो क्वेश्चन वेबसाइट में उसका आंसर दूंगा ही नहीं.
So in my evaluation exam, they asked such a illogical question. What was the Companies Act before 1956? And believe me, it took me for a toll, because I don't know. I only read of 2013 पता है, 1956 पता है. उससे पहले का तो none of my forefather or grandfather would have ever know about which section it is. अब मुझे, because I am not a law student or a company secretary much who knows much. So the CS practice उनको पता रहता होगा. So it was 1913. अब ऑप्शन में दिया था 1913, 1915, 1917. So I was thinking 1913 में तो वर्ल्ड वॉर चल रहा था, तो उस टाइम तो दिया नहीं होगा, 1930 या 20 में दे दिया होगा. तो मैंने वैसा लॉजिक लगा के आंसर दे दिया. That was a wrong answer and it costed me 0.25 marks heavily. So we need to be, that's a hard part of the profession. But again, to me, valuation, it took me 3 attempts to become insolvency professional and 2 attempts to valuation. So I can conclude on my part, it is still reasonable. We can still pass. Just little bit we need to take care of your laws. If we are that clear, we can easily clear. That's not an issue. So I think it's time to take goodbye for today. It's for time for your lunch. So next session will start at 2 o'clock. So we can all finish and wrap up your lunch. So Rajiv, Bhargava, Valor will take on valuation approaches. This is again a theoretical paper, and exam theory comes from this. So I think we can rush up now. If you have any questions parked, we can take it tomorrow. Thank you all. See you tomorrow on IBC and SurfaceC. We'll cover that tomorrow. And tomorrow राजकुमार जी आप थोड़ा और पढ़ के आओगे, because आप लोगे कल की क्लास मेरे साथ. ठीक है?
I will try, sir.
Take care. Good day.
Thank you so much.
Thank you, sir. Thank you. Take care. Good day.
नमस्कार राजीव जी।
Good afternoon, sir. Namaskar, sir.
सर कहाँ राजीव जी, घर पे ऑफिस में?
Today I am operating from my home.
मैं तो सर वेबिनारों के चक्कर में ऑफिस आता हूँ।
अच्छा मैं वेबिनार की वजह से ऑफिस नहीं गया बिकॉज हाफ डे का काम करना होता, तो जनरली आई एम गोइंग टू ऑफिसेज व्हेन सम मीटिंग्स आर प्लान्ड, अदरवाइज आई ट्राई टू अवॉइड।
राजकुमार जी एक बार ग्रुप में लिख दो, प्लीज ज्वाइन, व्हाट्सएप ग्रुप में लिख दो।
ओके सर, ओके।
सर हमारे इस ग्रुप में सभी एरियाज के मेंबर्स हैं, चेन्नई से भी जुड़े हुए हैं,
ओके,
चंडीगढ़ से हमारे दीपक जैन जी गुड़गांव से हैं, मनोज
Okay.
दलाल चंडीगढ़ से हैं,
uh-huh.
रघुराम सुब्रमण्यम जी चेन्नई से, विमल जी चेन्नई से।
ओके।
और सर आप कहाँ से?
सर माय ऑफिस इज इन ग्रेटर कैलाश।
ठीक है, आप तो
दिल्ली से। सर आप यहीं के ही हैं, दिल्ली के ही हैं। In fact, in February, I gave a training in CA Institute in Hyderabad. So I found that there were some candidates from North India as well. Somebody from Banaras was there.
Okay.
So although that batch,
बनारस तो सेंट्रल रीजन आ जाता ना, अपने सीएम तो 5 रीजन है ना।
हाँ, yes, yes, yes.
और सीएम में 5 हैं, तो अपना यूपी, एमपी, बिहार, राजस्थान सेंट्रल रीजन में आ जाता है।
हाँ, बिल्कुल। So आजकल तो and online scenarios में तो distances really do not matter at all.
और सर इससे वाकई में हम हर जगह के स्पीकर्स को हम एंजॉय कर पाते हैं।
But there are few disadvantages as well, because in case we are interacting with the audience live, then we can actually feel their mood very quickly, and we can be more interactive. Here with technology, there are few limitations as well. We can't see their faces, means eye contact is very limited most of the times. So there are few limitations, but there are many advantages as well, as you rightly mentioned.
ज्यादा है राजीव जी मेरे हिसाब से ना। क्योंकि एक तो मान लीजिए आपने किसी से सवाल पूछा, तो अगर सारे बोलने लगेंगे, तो वैसे तो आईबीपी करने की सारे बोलने लगेंगे, तो फिजिकल में भी दिक्कत रहती थी। यहाँ पे कम से कम टाइप करके आपको चैट में आंसर नजर आ रहे हैं कि राजकुमार जी ने कौन सा बोला, सर ने कौन सा बोला, विमल जी ने कौन सा बोला। और दूसरा ट्रैवलिंग टाइम आने का और जाने का।
Yes, that's a big advantage, and people from different regions can connect together. So that's a big advantage of this technology. And because of COVID, I think what we could have achieved in a year or two, that speed has been achieved in a 3 months period. Means now everybody is aware about so many online meeting platforms, and these platforms are flourishing day by day. That's
आज मैंने पहली दफा रिलायंस जियो मीट भी स्टार्ट मतलब आधे घंटे के लिए इस्तेमाल किया।
okay. That is quite similar to Zoom. They have not made much of the changes. They have just used the standard format. Google Meet doesn't give much of the controls to the speaker to mute the audience and all. That's why that is minimum used. That is not used for these kind of meetings.
हमारे साथ 8 पार्टिसिपेंट जुड़ गए हैं, हमारे टोटल 12 पार्टिसिपेंट्स हैं आज।
ओके सर।
राजकुमार जी आपने लिख दिया ना?
हाँ जी सर।
Sir, how many classes have already gone, and what they have done? Can you brief me a little so that I understand what is their what stage there?
क्योंकि जब मॉडरेटर बन जाता है तो दिमाग नहीं रहता कि क्या चीज चल रहा है। जब वो खुद है, मैं भी आरवी हूँ, वैसे रजिस्टर्ड वैल्यूअर हूँ, और आरवी भी बना दिया, सीए सीएस एलएलबी तो हूँ, लेकिन बीच बीच में दीपक सर आप थोड़ा सा सर को एक बार ब्रीफ करके बता देंगे कि क्या क्या मतलब 3 क्लासेस में हुआ है। मैं सर आपको सिलेबस का चार्ट तो भेज सकता हूँ कि लास्ट वीक में क्या हुआ था.
Okay, I guess you started from 10th of July, na?
Yes sir, yes sir.
And you are holding classes on weekends or every day you are holding?
Weekend मतलब आज चौथी क्लास है, 4th क्लास, 10th 11th 12th टुडे is
Okay,
फिर Friday
okay,
Saturday Sunday.
okay, okay.
Yes, we had was the last Friday, Saturday, Sunday, and so this is today's the 4th class, which is this Friday.
Okay, okay, okay. So I guess they have been explained about the DCF valuation method and equity valuation. Sumit was telling me that that was already briefed.
Yes, we have a brief of that.
Okay, okay. So should we wait for the other participants to join, sir?
नहीं राजीव जी, मेरे हिसाब से स्टार्ट कर देना चाहिए क्योंकि 9 पार्टिसिपेंट जुड़ चुके हैं. 3 पार्टिसिपेंट रहते हैं.
Okay. I hope I am easily audible to you all. Am I audible and clear to you all?
Yes, you are both audible and clear.
Okay, thank you.
वेलकम राजीव जी. बाकी प्रोफाइल आप अपना एक बार डिटेल में 2 मिनट का प्रोफाइल बताते हुए एक बार प्रोसीड करना.
Okay, sir. Okay. So, a very good afternoon to all of you. Myself, I am a chartered accountant in practice and registered valuer in securities and financial assets. By qualification, I am a FCA, I am FCS, LLB, and MCOM. And I have been into practice since 2013. And I started my career since 2002. So we do a lot of valuations under securities and financial asset category. So this batch is for SFA, and we would restrict our discussion and examples and all those things related to SFA category only. Try to be as interactive as possible. If you have any doubt, it is a small batch, so I'm hoping that it would be easy to means it would be feasible for me to answer your queries or your doubts. Whatever you have doubts, you can discuss after end of each session. Also, I will take out some time to answer your queries, and I will try to be as practical as possible. Today we have 2 sessions to cover. One is the overview of valuation, and second is valuation approaches. Overview of valuation is the starting point of understanding about valuation. Of course, you have understood many more detailed concepts also on the valuation. So you might feel at some point of time that these are very basic concepts and may appear to be very theoretical to you. I will try to make it practical, but you have to understand 2 points. One is that we have to complete and cover everything which is under IBBI syllabus. So from examination point of view also, it is important for you to understand that overview as well. Second is that the basic or the basis of the things appear to be very, very simple and very basic, but those are very important to have a strong foundation about any subject. And if we make mistakes in the fundamentals, then those mistakes are more costly. So with that intent in mind, let's start our topic for today. First is overview of valuations. I'll just open my presentation, then we'll start. So my presentation is visible to all. Yes. I will try to run fast, but in case you feel that I need to, slow down my pace, please let me know, and I'll adjust accordingly. I'll try to give my presentation mostly in English because I know that people from different regions are involved in this presentation. In case I say something in Hindi, I will repeat it in English so that everybody understands, right? So let's start today's topic, number one, which is overview of valuation. We'll cover these things in these topics in this presentation. First is a very basic understanding what is the meaning of value, then purpose and premise of valuation, then valuation standards. We'll understand a brief about valuation standards, valuation engagements, scope of work, valuation process, how the valuation process happens, valuation report, and documentation. This covers the topic number 6 in IPBI prescribed syllabus. So this particular presentation will cover your serial number 6. The first understanding about the valuation is that we need to understand what is the value. So value is defined in a different way at different dictionaries, but here I would start with the definition of value from the valuation standard, ICAI valuation standards, how they define. They define as value is an estimate of the value of a business. So first of all, first important thing is that it is an estimate. So what we are doing is estimating the value of business. We are not certifying that this is going to be the value of the business. Why it is an estimate? Because we are making certain professional judgments, we are making certain assumptions. So valuation is not a strict science that it will only give one particular figure. So if there are 12 people in this meeting, and all 12 assuming that they become a registered valuer and they do the valuation of a company, they all may come up with different figures and they all might be correct. So it is not like a certificate to be given by a CA. It is an estimate of the value. And in case of SFA, securities and financial asset, what is the value of a business or business ownership interest? Which means in case of a company, the value of shares or ownership interest, whatever instrument gives the part ownership of that business, arrived at by applying the valuation procedures. So we have to apply certain valuation procedures to arrive at the value estimate of value, and those valuation procedures should be appropriate for the valuation engagement. So our valuation procedures have to be appropriate for a valuation engagement. I just give you an example. Like for example, if you are given to you have an engagement to make a valuation report under Income Tax Act. So if there is a requirement under section 56(2)(10) of Income Tax Act and you are doing the valuation in accordance with that, then your valuation procedures would be different. Whereas if you have to do the valuation for the same company, same shares, same asset under section 62(1)(c) of Companies Act, so the purpose is different. So purpose is different, so valuation engagement is different, and your valuation procedures might also be different. So you derive an estimate of value, and for which business or business ownership interest, and you follow the procedures which are appropriate for a valuation engagement and using professional judgment. So valuation is not an exact science. It is not that you will not make any discretionary judgments or decisions. You will have to make certain professional judgments. Like for example, we need to decide which companies are comparable companies. We need to decide if there are some differences between the companies which are comparable companies and my company, what adjustments in value to be done. So there are various places where we have to use our professional judgment. What could be the long-term growth rate for the company? Likewise, so many decisions that we take. And then what we arrive at is the value or range of values. So it is also possible that you arrive at a range of value. So instead of saying that the price of shares of company XYZ is 22 rupees per share, we might say that it is between 20 rupees to 23 rupees or 20 rupees to 22 rupees. So might give a range of values also based on the procedures that we apply. Other definitions in dictionary definitions are more generic in nature, which covers all kind of valuations, means, and value is something which is calculated in money and which is for anything which can be exchanged in money or some other goods, that is called value. So that is the basic understanding of value. It is important to understand this definition because whatever we are doing, it is a basic foundation of our work. Any doubts so far? I'll keep checking the chat after some interval, but in case something urgently, somebody wants to understand some doubt, which will make him, difficult to understand the next concept, you may unmute yourself and speak up. Okay. So now the second topic is value versus price. So do you think that the price is equal to the value, or value and price are the same thing? No. So basically, the value of something could be more or less than the price we have to pay for it. Chetan says that price is less than value. Sir, it might not hold true all the time. Price could be more also, price could be less also. It depends on market condition and availability. But value is something that is a should be price for a for something. So for example, you might feel that the value or the fair value of Reliance Industries share is 1000 rupees only, but the price running in the market is in the exchange could be 1600, and you have to pay the price. If you want to buy, you have to pay the price. But since value is a should be price, so if your analysis is correct, then most likely the price under normal circumstances should move towards the value of the asset, but doesn't hold true all the time. So the term price indicates the amount at which a particular asset is bought or sold in an open market in a particular transaction. So price indicates what is the price in which the open market transactions are happening. But the value indicates the worth of that asset in normal circumstances, or the amount at which it should be exchanged. So it's a should be price. Value of an asset need not be the price of the asset, and many times the price is lower or higher than the value of asset. Value of an asset is actually a should be price of the asset. So that is a basic difference between price and value. Next topic is fair value and fair market value. Although they both of these terms are generally used interchangeably, because there is a very thin line difference between these two, otherwise they are used interchangeably. So most of the circumstances, fair value and fair market value is the same, but fair value considers the circumstances which are specific to the parties involved, whereas fair market value doesn't consider those specific circumstances or characteristics which are specific to the parties involved. So that is the only difference. So the valuation standards, how they define fair value as the price that would be received to sell an asset or paid to transfer a liability. So fair value could be for an asset, or it could be of a liability as well. So you might have to do the fair valuation of a liability as well. So that is also possible in an orderly transaction between market participants at the measurement date. So measurement date is the relevant date for in reference to which you are creating a valuation. So do you know that there is one date in reference to which the valuation is arrived at, and there is another date on which the valuation report is signed? So can they both be different, or they have to be the same? What is the measurement date and what is the date of signing of the report? Can be different, can differ, different. CIRP date, different. Okay. So basically, valuation date is the relevant date in reference to which you are deriving the value of an asset, and the date on which you are doing this analysis, or the date on which you are signing the report, is generally after the valuation date. So for example, today you get an engagement to do the valuation of a company as on 30th June 2020 or as on 31st March 2020. So the measurement date or the valuation date in that case would be 30th June 2020 or 31st March 2020, as the case may be. Which somebody mentioned CIRP commencement date. In case of insolvency cases, IBC matters, it is in case of a company under insolvency, it is a relevant date on which you have to derive the value is the CIRP commencement date. So in your engagement, you have to be clear as to what date in reference to which you are deriving the value. The report might be signed at a later date. So the report is signed today, but I am saying that the value of the share as on 30th June was this. So we calculate the value at the measurement date, right? So one is the date on which the engagement is signed or your appointment is done. Another date is the date in reference to which the valuation is being derived. And third one is the date on which you are signing the report. Relevant is the measurement date or the valuation date. So fair market value is the price at which the property would change hands between a willing buyer and willing seller. Means they are willing, but they are not compelled to sell. They are motivated to buy and sell. Neither being under any compulsion to buy or sell. They are having no compulsion. And both having reasonable knowledge of relevant facts. These situations might not be true in the real market, but we create a presumption, we create an assumption that these circumstances exist and we are deriving the value under these assumptions. So we have a question that if the date of report and signing date is different, if anything happens between them, would need to be considered. इसके लिए एक practical example लेकर के हम समझते हैं कि like for example this COVID situation happened and it has impacted a lot of businesses. So on 22nd March the lockdown was declared, and I think a day or 2 days before the WHO declared it as a global pandemic. So if you are doing the valuation of a company for a period which is prior to the declaration of COVID as a pandemic, that is, let's say 28th February, at that point of time, nothing, no information about COVID was available. But you are doing the valuation at a time when this information is available. So will you consider the impact of those circumstances to your valuation report, or will you not take into consideration those changes? So the rule here is that in case of any information which was known or knowable as on the valuation date means the measurement date, then we take that into consideration. Anything which is known or knowable after the valuation date, that is not to be considered for valuation of an asset as on the valuation date. I hope my answer is clear.
But sir, in the morning, hello?
Yes, sir.
The morning I was told, like, say in the same example, a fire has taken place and then they need not report it like.
A fire taken place after the valuation date.
After the valuation date.
Okay, and what was the answer? That
Answer this is they need not report it. It need not impact your reporting. I mean your valuation report.
So, sir, was the fire happening after the valuation date? Was that event known or knowable as on the valuation date?
No, after the valuation date.
So, sir, this is what I'm saying, that in case as on the valuation date, the measurement date in reference to which you are creating, you are doing your analysis. So, if as on the valuation date something was known or knowable, as on that date, I'm not talking about signing date. If on the valuation date some event or some information was known or knowable, then you take into consideration. If that has happened after the valuation date, so in my example I mentioned that if you are doing the valuation of a company today, but if the valuation date is 28 February, as on 28 February the impact of COVID was not known, it was not declared as a pandemic, so to this magnitude it will affect us was not known. So you will not consider the impact of COVID in your valuation report, because as on the valuation date that event was not known or knowable. But if you do the valuation on 31st March, so since the impact was known or knowable as on that date, the event has already happened, you might not be able to calculate at that point of time what the impact could be, but the impact already happened, so then you consider.
But why not the addendum be? Wait, sorry, sir. Why not the addendum be given even after reporting that something has taken place?
Sir, morning.
Because the going concern is an impacted.
Sir, morning. The discussion was based on the accident took place after the report was submitted, not as informed by our colleague.
Okay,
no,
sir.
I understood, sir, their point, because after the reporting date something has taken place. But my point is, why not the addendum be given? Because the whole purpose is initiated. The going concern is at stake.
Yes, sir. I'll just explain you further. The second scenario which he just mentioned is very different, in which you have given your report and something has happened thereafter. So obviously you are not supposed to give a follow-up report once you have given the report, something has happened.
I agree.
Now, second question is, I'll just come to the question. Second question is that in case something has happened to that, means some event has happened that affect the value, or some event might happen which actually destroy the whole asset, that asset is no more available. So or some event happens which actually impact the valuation of that asset. So in that case, generally the parties to the engagement, the parties who are doing the transaction, might not decide on the basis of a prior date. So if today I am doing a transaction of, like, I want to buy the shares of a company, I might not be interested in accepting the valuation for a date when the circumstances were materially different than the circumstances which are present. So in that case, your client will ask you to do the valuation of a relatively newer date, relatively latest date. Second is the scenario. Second is the scenario where the asset altogether has destroyed. So which means the asset completely doesn't exist at all. In the second scenario, when the asset actually doesn't exist at all, then it might be a scenario that the valuation becomes infructuous, means it's of no use, that you can't, there is no use of doing the valuation of that asset, it doesn't exist at all.
सर 20th Feb की अगर मैंने वैल्यूएशन डेट रखी और आज मैं उसको साइन कर रहा हूँ, ठीक है सर, अब बात आती है कि न्यू ईयर डेट की वैल्यूएशन होगी या नहीं होगी, वो इज अ सेपरेट टास्क. तो साइनिंग डेट की कोई रेलेवेंस है या नहीं है? मैं किसी भी डेट को साइनिंग करूं, कोई मतलब नहीं है उस पीरियड के बारे में मुझे देखने के लिए?
डेफिनेटली आपकी जो रिपोर्ट है दैट इज रेलेवेंट फॉर द पर्टिकुलर डेट व्हिच इज अ मेजरमेंट डेट.
ओनली वैल्यूएशन डेट इज मैटर ना.
Date of signing is the date on which you gave your opinion. You gave your opinion that the value of that company as on 20th February was that much. You are not saying that the valuation of company today is that much. You are saying that valuation of company as on 20th February was that much. So that is the reason that subsequent event which was not known or knowable as on that date is not considered. If the parties believe that that particular date is not relevant anymore, they will have to decide to take a valuation of a newer date. But your
logical.
opinion
That
goes
is
back.
Logical.
So that is the, I hope now it is clear, sir.
Yes, yes.
I'm happy that the discussion is happening even in the Zoom call, because I enjoy having contradictory views that also increase my knowledge also and my argumentative capabilities, because otherwise in online platforms it becomes very limited. So signing date is relevant for billing. Some
Yes.
Chetan has
or for UDI purpose also.
for UDI purpose, definitely it is relevant to avoid any, it serves multiple purposes. Those who are chartered accountants or company secretaries already aware that what it serves. So clear, Abhi tak? Everything is clear, sir? Your answer is, your query is answered, sir?
Yes, sir.
Okay,
Please.
thank you. Thank you.
Most welcome.
So let's move. Next point is intrinsic value. Intrinsic value. Intrinsic value is a way of describing the perceived or true value of an asset. So basically, it is the true value or the perceived value of an asset. So for example, in that Reliance example, you might assume, you might calculate based on your estimation, the intrinsic value of the share would be much more or much lesser than what is the current price of the share. So based on the market participants' perceived value could be different, but the true value of that asset might be plus or minus than the actual running price. Intrinsic value is not always identical to the current market price, because asset can be over or undervalued. So always the market participants or the traders try to identify the assets which are undervalued or which are getting traded at less than the intrinsic value. Investment value is the value of an asset to a particular owner or prospective owner for individual assessment or operational objectives. So for example, there is an asset, there is a machine, and I want to acquire that machine. So it might not have any market and it might not be saleable at all or saleable at a fraction of cost. But to me, the operational objective is to run this machine for 15 years and to produce, to manufacture something. So for me, the investment value of that asset could be 1 CR, 2 CR, or whatever the calculation derives the value. So it is a value to a particular owner or prospective owner instead of the value in general. So investment value is an entity specific value, basis of value, though the value of an asset to the owner may be the same as the amount that could be realized from the sale to another party. So it could be the same. So most of the assets are having the same value, which its market value could be. But in case of certain assets, the investment value could be different than the resale value of the asset. So this basis of value reflects the benefits received by an entity from holding the asset and therefore does not involve a presumed exchange. Investment value reflects the circumstances and financial objectives of the entity for which the valuation is being produced. It is often used for measuring investment performance. So that is one concept of value in investment value. So most of the times these concepts might not come handy in a practical experience, but after this presentation I will discuss some of the question answers which are available in which I could gather from a public domain, and we would understand how these questions might come in examinations and might affect your performance in examinations. If you have a better understanding of these concepts, you might score well. This is an interesting concept, synergistic value. So what happens that, for example, company X is having a fair value of let's say 1 CR, and company Y is having a value of again 1 CR. Can the combined value of those companies be different than 2 CR, or it could be more than 2 CR? I have one answer, yes. More. Maybe more than 2 CR. So why it is getting more than 1 CR is because of the synergy. So for example, Zomato acquired Uber Eats. So Zomato would have synergized the operations and taken advantage out of the bigger structure, or Vodafone and Idea merged. So might be the standalone value of Vodafone and standalone value of Idea, when they merged, their combined value could be bigger than the standalone value. So when the marriage happens, the marriage value could be higher than the standalone values. So that is what is called a synergistic value. That happens because of multiple reasons. Those two entities might take advantage of a bigger size. Those two entities might take advantage because of a better competitive strength. Those two entities might reduce some of their common expenses, and they might take the benefit of the common research and development, and so many other factors come into play to create a synergistic value. So synergistic value is the result of a combination of two or more assets or interests where the combined value is more than the sum of the separate values. So it can happen that synergies could be only available to one specific buyer, or it could be could happen that synergy is available to a number of buyers, number of prospective buyers. So there is a readily available market. So for example, if there is a land which is adjoining to a person's factory, and he is seeing as a synergistic value in that particular land which is adjoining, but nobody else is seeing that kind of a synergistic value. Or if the company is into a business in which there are very few players in the market, and there is only one company which is of a size and scale which can be interested in that synergistic value. So there could be scenarios where the synergies are available to one specific buyer, or there could be synergies which are available to a number of buyers. Clear? Next is a special value. A special value is what a particular investor or group of investors believe the asset to be worth due to some unique advantage to be realized from that asset acquisition. So which means that the asset has a special value to someone which is not available to any other person. So that special value is available to only one particular person or one particular group of investor only. Next important concept is purpose of valuation. So whenever we get into any valuation engagement, we have to be very clear that what is the purpose of the valuation and assignment. So we have to be very clear what is the asset that we are going to value, what is the purpose of the valuation, and what are the responsibilities of the parties. These are the important terms of engagement. We should be very clear before getting into any valuation engagement. So why the purpose is important? Any thoughts? I'll just tell you, the purpose is a basis. The purpose is the foundation on which your further decisions will come into play. So without knowing the purpose of valuation, you will not be able to decide what is the valuation premise and what is the valuation approaches which could be relevant in this particular case, and what methods we need to use. So purpose is important for us to be able to take further decisions which will help us to complete the valuation exercise. So without knowing the purpose of valuation, we cannot decide. Without considering the purpose of valuation, we cannot decide which valuation approach to be used and which valuation methodologies to be used. So it is a requirement under valuation standards of ICAI as well as international valuation standards that purpose of valuation need to be considered while deciding which valuation approach or methodologies need to be used. So purpose could be, for example, the purpose could be that minority stake transfer is happening. The purpose could be a complete acquisition of the asset. The purpose could be merger and amalgamation. The purpose could be allotment of shares, or it could be financial reporting. So we will understand in the next slide what could be the possible purpose of a valuation assignment, and that is important for us to understand before we start our assignment. The type of value being provided must be appropriate to the purpose of valuation and communicated as a part of scope of the engagement. That means we have to, International Valuation Standard 101 says that we have to communicate this as part of scope of engagement. So we have to be sure that in our engagement letter, the purpose is specifically mentioned. These are few examples of purpose of valuations. It could be for transaction purpose. So somebody wants to know the valuation for the purpose of entering into a merger or acquisition, acquiring some company or acquiring some asset, fresh issue of shares. They want to know what could be the at what price they should sell the shares, transfer of shares, investments, ESOPs, fundraising, sale of business, any kind of dispute resolution, voluntary assessment. So they may try to, assess voluntarily themselves. There could be regulatory purpose also, that under Companies Act, preferential allotment, it has to be valued under section 62(1)(c), mergers and demergers. So that is also the share entitlement ratio or share exchange ratio is to be determined based on a valuation report. In FEMA, under FTI guidelines, the fair valuation is to be done so that the shares cannot be allotted at a price to a non-resident at a price which is less than the fair value. That is a guidelines. Under income tax, under 56(2), most of the valuation happens under section 52(7)(b) and 56(2)(10). Under SEBI, various situations the valuation happens, and under IBC, insolvency and bankruptcy code, the valuation is done. So whenever we are doing the valuation for any particular regulatory purpose, then we have to understand the regulatory requirement and we have to apply the valuation process, procedures, approaches which are in compliant with that particular section. So for example, under section 56(2)(10) of Income Tax Act, they only prescribe one particular method which is quite similar to the net asset value of a company. So we are not allowed to use the DCF or any other valuation method. So we will have to restrict ourselves to the prescription of that particular law. Another purpose of valuation could be the financial reporting. That could be purchase price allocation. When you buy a combined as a combined deal like a slump sale, where you don't know the individual prices of a bundle of assets that you have bought in a particular price. So you have to do the purchase price allocation for the books of accounts. Impairment, diminution in value, we have to identify the valuation. Fair value reporting as per IND AS. So IND AS, there are multiple IND AS which require fair valuation. IND AS 113, IND AS 109, 107, 32 for financial instruments. IND AS 102 is share-based payments. Basically, ESOPs schemes gets covered under this. Ind AS 103 business combinations, Ind AS 38 intangible assets, Ind AS 16 property, plant and equipment, and Ind AS 36 for impairment of assets. So these are broadly certain purpose of valuations. It's not an exhaustive list. There could be more purpose of valuations as well. It is just an illustrative list prepared for different purpose of valuations. Any question till now? Any doubt? Or should we go further? Okay. I hope I am not going fast because I understand that this first topic is more of a theoretical in nature. I'm trying to, cover up the practical aspects. The next topic is more practical in nature. So anything which is more relevant from examination point of view only, I'm trying to cover that first. So next, that is very important. This premise of valuation is very important because we have to, first of all, after identifying the purpose valuation, which we determine and we mention in our scope of work, in our engagement letter, second important point we need to understand is what is the premise of valuation. Premise of valuation is basically the conditions and circumstances how an asset is deployed. So based on the premise of valuation and purpose of valuation, we would be able to determine the process of valuation. So there are multiple premise of valuations. One is the going concern value or a liquidation value. So in a going concern value, we presume that the business or that asset is going to be utilized or going to be run in the way it is getting run. So the organization is going to be a going concern. It is not going to get closed down. In case of liquidation, we have to identify the liquidation value, assuming that the organization is not a going concern. So liquidation value could be orderly or it could be forced. Orderly means you have sufficient time to do the marketing, the necessary activities to be able to realize those assets. And forced means you have little time and it has to be done in a forceful manner. Second important valuation premise is that it could be as is where is basis, or it could be highest and best use. Highest and best use is in short form called HABU. Highest and best use, HABU. So I'll just give you an example. Like for example, there is a factory at a posh area in Mumbai that was established 100 years back. So that factory is working with a very minimal efforts and the profitability is very low. And you understand that it is a going concern company. So going concern company, you do the discounted cash flow method, and based on the future projections and business case of the company, you arrive at the value of the company. Let's say you say that, okay, this company seems to be worth 20 crore rupees. Whereas you realize that the value of land which it is using is actually worth, could be 500 crore, because the company is not effectively using its assets. Its value of land is much more than the value of the company as a whole. So you might assume that a prospective buyer will just demolish this factory and might create a commercial complex, a multi-story commercial complex for and the value that could be fetched is much higher. So under highest and best use, we presume what could be the best use of that asset. So for example, a land and building valuer is doing a valuation of a house in Delhi, and that is an old house. So if you use that house as it is and the monthly rental that could be fetched out of that house the value of that property would come very low. But if somebody would buy that asset, they would try to use it in a maximum potential manner, in which what they will do, they might actually make a 4-story building, and then they will sell the individual units separately, and they might be able to fetch a much higher price. So under highest and best use premise, we try to see what could be the alternate use of that asset and how the value could be maximized. Whereas under as is where is basis premise, we do the valuation based on the current use, how it is being used currently. So these are different premises of value, and depending on the premise of value, your valuation process and valuation approach might be different. You have to consider these premises before taking the decision on which approach or which valuation method to be used. So
Rajiv,
any question?
Also gives a reference to that point which you raised, that why we would put the purpose of valuation in our report, because the premise will change the valuation drastically.
Yes. So the conditions which under which you have to do the valuation, those conditions need to be documented, and those conditions need to be documented in the engagement as well. Okay. Any further question on this? Next topic is valuation standards. So as we know that valuation is not an exact science, it is not very scientific in nature. Although one part of it is very scientific, but some part of it involves a lot of discretion, judgment, and assumptions to be made by a valuer. So in these circumstances, how do we ensure that valuers do not depart from some consistent and uniform practices? So for that purpose, valuation standards are devised. So valuation standards are necessary. They help to have a consistent, uniform, and transparent valuation policies and harmonize the diverse practices in use. So there might be many diverse practices in use. For those practices to get standardized, and we create a uniform and consistent practices, so that the valuation reports do not divert beyond a certain level. But even after we have valuation standards, the professional judgment or assumption is not completely eliminated. I'll just give you an example that in those valuation standards, you will not find anywhere that you will have to use certain, they don't mention any figures anywhere or percentage anywhere. They will not say that liquidity discount has to be taken as 20% only or something like that. That you will not find in any valuation standards. But at the same time, they standardize the process in a manner that the procedures are at least same. So for example, the valuation standard says that for using the valuation approaches, you have to consider all the approaches and understand, try to take a decision which single or multiple approaches are relevant for the purpose and premise of valuation. So although the valuation standards does not mandate that you only do the valuation under DCF method, or you only do the valuation under a certain particular method or particular approach, they force us to analyze and document that we have considered, we have reviewed, we have analyzed all different approaches available, and then we took the call. So even though it does not standardize to a minute level, a micro level, it standardizes many of the practices and procedures that we follow in a valuation assignment. So where does it get the regulatory force? It gets the regulatory force through our Rule 8 of Companies Registered Valuers and Valuation Rules 2017, which provides that registered valuer shall, while conducting a valuation, comply with the valuation standards as notified or modified under Rule 18. So under Rule 18, the central government has got the power to notify valuation standards, and every registered valuer is required to comply with the valuation standards, which will be notified by the central government. But so far, the central government has not notified the valuation standards. So Rule 8 resolves that situation as well, because it says that till the time the valuation standards are notified by the central government, a valuer shall make valuation as per internationally accepted valuation standards or valuation standards adopted by any registered valuers organization. So as of now, only ICAI RVO has notified adopted valuation standards, which are called ICAI valuation standards. And there are a few internationally accepted valuation standards, which are these. So International Valuation Standard, IVS, which we call International Valuation Standards, are issued by International Valuation Standards Council, which is the most widely recognized valuation standards globally. And at present, the IVS 2020, which is applicable from 31st January 2020, is in force. So as a valuer, we have to comply with the valuation standards IVS 2020, which are available in single PDF file. In case you are not having them, I can share with you all on WhatsApp, but it is easily available, and that covers all the international valuation standards which we have to comply while doing the valuation. I will give some reference to international valuation standards pertaining to the topics that we are going to discuss today. But since international valuation standards itself is a big topic, recently our RBO has conducted 5-day session on international valuation standards only. So I'll try to capture some of it. Okay. Chetan is saying voice is breaking. Are others also facing a voice issue? My voice is clear to all? Okay. Some are facing, some are not facing. Then I guess it could be an internet problem at your side, because most of the participants, it is clear. So asking for sharing of valuation standards, IVS, I will share that you can go through, and whatever would be possible to get covered in this session, I will cover in respect of the topics that we are discussing. So there are other institutes like Royal Institute of Chartered Surveyors and American Society of Appraisers or European Group of Valuers Association. They also issue valuation standards, but we can just follow international valuation standards, IVS, and that should be sufficient. ICAI has also constituted a valuation standard board, which has formulated valuation standards which have been made mandatory for its members. The central government has not prescribed any valuation standards as of now. So ICAI valuation standards are a little bit more clear on few aspects. It is more or less similar to the international valuation standards, only there are very minor differences at some points, which you can download from ICAI RBO, and that you can also follow in your valuation assignments. ICAI also make some publications of like valuation professional insights and some question and answers, which might be useful to you as a valuer. So what are the benefits of valuation standards? We'll understand it quickly because it's more of a theoretical in nature. So there are many positives for valuers. They ensure consistency, reduce discretionary judgment calls taken by the valuers. They increase comparability between different valuers and valuation firms by promoting use of consistent valuation methodologies. So if all are using the consistent methodologies, then comparability increases. The standards ensures that best practices of valuation are followed and there is fairness in valuation services. They promote credibility, relevancy, transparency of valuation information. The standards cover valuation of all assets, liabilities, and businesses. Accordingly, there is more guidance available on valuation of complex financial instruments as well as unusual items. The standards specify usage and give direction on various items such as discount rates to be used, illiquidity discounts, discount for lack of control, etc. The standards help valuer in preparing information checklist, choosing valuation methods, and finalizing the valuation reports. So it will act as a good guidance to the valuer on different aspects of valuation. So the next topic is valuation engagement. So in the valuation engagement, and a very important portion is the scope of work. So scope of work describe the work to be performed. So what work you are going to do? Your work is to do the valuation of a company under for the purpose of allotment of further shares under section 62(1)(c), or your purpose, your scope of work is to do the valuation of a company for a for the internal use of the company or for the purpose of transaction that the company is willing to enter into, or your purpose is for valuation under insolvency or bankruptcy code, or your valuation is to be done for a purpose of a particular section under Income Tax Act. So I'll just share with you some practical experience that I had, that I was sitting with the commissioner and he was looking at a valuation report signed by a fellow chartered accountant, some chartered accountant, and he was reviewing that report saying that, look, this is all rubbish, and I would ask this guy to come to me and explain what he has done. So I looked at the report and I found that that report was issued under the FEMA. So that chartered accountant has clearly specified what is the nature of work that he performed and what is the purpose of valuation. So that is specifically mentioned that it is prepared for the purpose of FEMA. So I told him that, look, sir, you should not look at this report and you have no right to actually ask this, trouble this guy, because he has not prepared this report for you. This report is prepared for RBI and it is not prepared Income Tax Act. So he was not supposed to look into what is there in section 56 of Income Tax Act because the scope of work was limited. So that point I want to highlight to you guys is that we have to describe the scope of work clearly in our engagement letter as well as in our valuation report as to why you have done the analysis and what is the purpose and what are the limitations. So it should not be used for a contrary or a different purpose, and then you are made responsible to certain circumstances which were not contemplated. So responsibilities, what are your responsibilities and what are the client's responsibilities? What are confidentiality obligations that you have, and what is the limitation of valuation engagement? So limitations also need to be mentioned in the scope of work. Any question till now? Any question, or should we go ahead? I guess no question on this, so I'll just move further. There are some minimum contents of the engagement letter. There are no maximum contents. You can add further details as you may consider necessary, but these are the minimum contents that should be there in the engagement letter. Details of the client. So you have to identify who is your client. Details of any other user of the valuation report apart from the client. So if you know that there is a particular user for valuation report apart from your client, that is to be mentioned in the engagement letter. So will the client be the same company for which you are doing the valuation, or it could be different as well? My question is, will the client be the company that you are doing the valuation, or it could be it could be different as well? Can be different. Yes, like banks. Bimal saying has to be different. It is not has to be different. It might be different in some cases. Like for example, the company is engaging me to do the valuation of the same company for its internal use or for the allotment of shares. So the subject company means the company for which the asset that for which the valuation is to be done is the same, but it could be different also. Like the bank is asking you to do the valuation of a company, or if a company is asking you to do the valuation of another company which they are contemplating to acquire. So the subject company, the company for which the valuation is to be done, is different, and the client is different. Details of the valuer. So in our engagement letter, we have to identify ourselves. We have to also mention our registration number with IBBI, so as to make sure that we are properly authorized or competent to take up the job. Purpose of valuation that we just discussed, that purpose of valuation is very important, and we have to specify in our engagement letter what is the purpose of the valuation. Identification of the subject matter valuation. So in under clause A, we are identifying the details of the client. Under clause E, we are identifying the subject matter of valuation. So subject matter could be the same company which is the client, or it could be different as well. Then the valuation date. We have to identify the date in reference to which the valuation is to be done. And it has to be very clear in our report as well as to which particular date we have derived the valuation. Basis and premise of valuation, that means ki going concern valuation or liquidation value that we have to determine. Like for example, in insolvency cases, we have to determine the fair value and liquidation value. So we write in our engagement letter that we have to determine these value, which is for the purpose of IBC under section so and so, and then we determine and we mention the purpose, basis, and premise of valuation. Responsibilities of the client and the valuer, as to what are your responsibilities and what are client's responsibilities. For example, providing you the business plan of the company or the projections of the company or the last audited balance sheet or last financials of the company is the responsibility of the client. And what is your responsibility is to select appropriate approaches and do the valuation exercise and provide them with a detailed report and all those things. Is valuation report a certificate? What is our responsibility? Are we issuing a certificate? Deepak Jain, no. Rajkumar, no. Iti Jain, no. What is others' view? Certificate is for facts, opinion only. Certificate is certifying. I am expressing an opinion. No. So all are clear on this point that it is not a certificate. In the beginning, we have understood that it is an estimate. So we are estimating, that means we are giving our opinion of a particular estimate. So it cannot be accurate. It need not be accurate. That is our best estimate, our professional judgment. So it is not a certificate, it is an opinion. Confidentiality obligations of the client and the valuer. What are your confidentiality obligations? Acha, is your confidentiality obligations only towards the client or towards the subject means the subject company as well? That you will maintain the confidentiality of your client, or you will maintain the confidentiality of your subject company as well? Because company X ask you to do the valuation of company Y because they want to acquire shares in company Y, and they share you the details of company Y. So it is not just that you will maintain the confidentiality of your client. Maybe that you are not getting any information of your client. You are getting, all you are getting is of that subject company only, because the client is not getting valued. So you have the confidentiality obligation towards that company as well, right? Scope, and what are the scope limitations? We have to mention the fees. Fees is important because if you do not mention the fees, you means as per the ethical guidelines, you are not allowed to charge extra than the fees which was mentioned in their engagement, in your engagement. So if in my engagement I have mentioned a fee of 50,000 rupees for an assignment, and later on after the engagement is completed, I charge 70,000 or 80,000 rupees, that is not allowed unless my scope of work mentions, my scope engagement letter mentions that in case of certain changes in certain factors, the fees could be determined in a different way. Like for example, I'm doing the insolvency valuation, and at the time when I gave the engagement letter, the insolvency professional could provide me the last available balance sheet as on 31st March 2019. When I started doing the work and they provided me the balance sheet as on the insolvency commencement date, I understood that the assets have materially changed, and there are a lot more assets than the assets that were given to me at the time of signing of engagement. So those kind of flexibilities can be built in your engagement, but make sure that you are charging as per the engagement only. Otherwise, the regulator might feel that you have charged extra by accommodating the client for a particular value. Details of any third party expert, if any, and their scope of work, scope, limitations, and responsibilities. So for example, in this particular example that I gave you about a factory to be valued, and you have understood that, look, I don't feel that the asset, that the factory is getting utilized in a most efficient way, and I want to get a valuation done from a land and building valuer also to understand what could be an alternative usage value for this factory. Or for example, if you are doing the valuation of a company and you come across a situation that the company has some surplus assets, non-operational assets, which are land and building, an empty plot of land which is not being used currently for the business of the company. So then you would want to get the valuation done for that plot of land as well, and for that you might need a third party expert. So if you are going to use a third party expert for any particular purpose, so we have to identify them, we have to provide the details of their scope of work, scope limitations, and their responsibilities. So these are some essential conditions of scope of work. Any doubt in this? I hope it is clear as of up to this point. Take silence as it is clear. Okay, some responses. Yes. So let's proceed further. So next topic is valuation process. How would you follow your valuation exercise? What steps you will follow? So basically, we can divide the valuation process steps into 3 categories. First of all, and these are the chronological order we have to proceed as a valuer for doing the valuation of that asset. Number 1 step, what we will do first, we'll get a better understanding of the business. How we will do that? We will get an information collected from the management of the company. We might ask them to provide us the past balance sheets of the company to get an understanding about their level of operations. We might ask the management to provide their business plan. We might ask the management to provide details about the management. We might ask the management about the companies which they feel that are competitive under competition to them. If they have some material or brochure about their products and services, we might collect a lot of information from the management of the company, and we might do a data research as well. So we do a lot of analysis by way of the data that we have received from the management or we have received from independent sources as well. Then we will do the industry and economy analysis. So if we find that we are doing the valuation of a company into the tourism industry, and we are not sure as to what will happen to this industry in the current COVID scenario, and we are looking at certain industry performance or industry outlook reports, or what is the economy outlook, what is the industry outlook that we can use in our valuation report. We do the business analysis, we do the historical analysis, what they have done in the past, what history they have, and how they have performed in the past. We might do some ratio analysis for the client to derive some key ratios of the client. We might do some trend analysis. While doing the trend analysis, we have to be clear that our company should not be a cyclical company. In case it is a cyclical company, we have to take into consideration the cycle in which the company operates and do the trend analysis accordingly. Because what we might do is that we might be sitting at the peak of that trend and we do the extrapolation of the next 5 to 10 years based on that peak figures for the current year. Cash flow analysis we will do. A strategy analysis, we can do the analysis of their strategy or risk associated with the company. So all these analysis will give us a better understanding of the business of the company. So getting the understanding of the business is an important part. That is the first step. Many of the times we feel that we give too much focus on the tools of valuation, like how the formula to be made for DCF, how the discount rate to be calculated, or how the cash flow to be charted out in the Excel sheet, and we give too much attention to those Excel sheets and all, that we sometimes ignore the very basics of the business, and the ultimate result is actually garbage in, garbage out. Because our basic understanding of the company was completely incorrect, our valuation result might be completely different. Next is forecasting the company performance. So are you all aware of the discounted cash flow method and various other methods for valuation? Are you aware of the practicalities of those methods? Have you done that, or that is to be done? Have you all done the discounted cash flow method? You understand that method? Okay. Yes, for DCF. Any other method that you have understood for valuation of company? NAV. Okay, so I will presume that you understand discounted cash flow method while discussing. Otherwise, I would have avoided those terms that are generally used in discounted cash flow method. So as you would have done the discounted cash flow method, you understand that first of all, we have to do the forecasting. We do the forecasting of income, balance sheet, and then we arrive at the forecasting of cash flows, because these cash flows are an important input under the discounted cash flow method. Based on these cash flows, we calculate the present value of probable cash flows in the future, and then we are able to discount them to the current value and arrive at the enterprise or equity value of the company. So that is the second step. Now third step is in which you get the valuation. So what you do is, based on the purpose and premise of value, we select and use the appropriate valuation models. So there are broadly three approaches of valuation, which is income approach, market approach, and cost approach. They are primarily three approaches of valuation, and under these approaches there are multiple methods. So you will have to select and use the appropriate valuation models. So my question is, do you need to use more than one approaches, all approaches, or you can only use one approach? How would you do the valuation? My question is, as a valuer, do you have to use all these three approaches? You have to use all these three approaches, or you have to use only one approach? How would you do? One answer I got is most appropriate. If possible, three, or combination if deemed, otherwise most appropriate. Anyone depending on scope of work. That is interesting. Income depends upon the purpose. Okay. Can your client say that, look, I want a particular approach to be used, and they write it in your scope of work, and then you apply that particular scope and then you do the valuation? That is possible? No. So इसका आंसर तो क्लियर है सभी को कि क्लाइंट कैन नॉट force you a particular approach. It might force in case it happens that valuation report cannot qualify to be compliant of international valuation standards or ICAI valuation standards. So in order to be compliant with valuation standards, it has to be means the scope of engagement cannot restrict the choice of approach that to be used. So I'll just explain you. As per the international valuation standards and ICAI valuation standards, you have to consider, mark these words, consider all the three approaches. So you have to at least give a due consideration to all these approaches in reference to the purpose and premise of valuation, but you might rule out one or more of such approaches, and you might be of a professional judgment that only one approach will give me a definitive and more reliable value, and I might neglect or I might reject all the other approaches. So for example, I might say that cost approach I am not using because it doesn't consider the value of intangibles in the company and it is a running company. it is a profitable company with a past. And market approach, I am not able to apply because of insufficiency of data. I cannot find comparable companies in the market through which we can derive the value. And then hence I am of the opinion, professional opinion, that income approach is best suitable because reliable data is available and I can apply the DCF easily, and I am disregarding all those approaches because of these reasons. So we have to reason out other approaches. Or I might say that, look, I am feeling that income and market approach both are relevant in my case, and I want to apply these two. But if I apply one, then the position is very easy. I apply only one approach, and whatever is the value comes is the final answer. But if I apply 2 or 3 approaches, then the question comes, how do I come at the final figure? So for example, you feel that in this particular case, I want to use income approach and market approach. Can you use the average of these two approaches as the final value? Give weightage to each. Average if equal weightage, that is the answer coming. Anybody else? Any thoughts? What you feel could be the answer? I repeat my question. It might happen that you feel that more than one approach is possible and you want to use 2 or 3 approaches to your valuation, and all these different approaches might give you different result. So after that, what would you do? या तो आप एक काम करोगे कि उनका सबका you will do the average of all these different valuation, or you will do the weighted average. Somebody is saying lower of those values, or somebody is saying that I guess these are the only answers that we received. Lower of the nearest. So I'll just take your answer and I'll explain you. So for example, if there is a company, the income approach says that the company is worth 10 crore rupees. And market approach also says that it is worth, let's say, 11 crore rupees. And asset based approach says that it is worth 1 CR. So are we going to take the lowest figure, that is 1 CR? So answer coming that ignore asset based. So I may ignore the asset based and then take the average of or weighted average of the other two. Yes. So I'll just explain you. The standard clearly says that you have to reason out and reconcile those values. Averaging is not permitted, which means a simple averaging of 3 values or 2 values is something that you cannot do. You cannot say that as per the DCF, value is 10 crore, as per market approach, it is 5 crores, as per asset based approach, it is 1 CR. I have done the average of all 3 and then I have come up with a figure. That is not allowed. That is not allowed. Once you arrive at the figures, you will have to reason out. So for example, you might say to yourself that, look, this 1 CR value is not actually the correct value, because looking at the nature of the company is not deriving its value from the assets. It is deriving the value from intangible, the goodwill. And that is the reason the company earning capabilities derive much higher value. Then you come up with a scenario that you say that, okay, I have used discounted cash flow method and a market approach also. But on market approach, I'm getting less reliance because the transactions in the companies, those companies are not actually comparable companies. That is a 800 crore turnover company, mine is only 10 crore turnover company. So I actually had to make a lot of adjustments to arrive at a value. So that is much lesser reliable, whereas the discounted cash flow method value is much more reliable, and both the valuation are giving much different figures. So I might ignore one of the approach and then come to the one approach only, or I might use some weights by saying that I'm relying more on a particular approach, and then based on that weighted average of those two approaches, I might do the valuation. So although the standards allow you to use a weighted averaging of two or more methods, I generally advise on a means on a personal note to avoid doing the averaging, because here the regulators generally feel that you use the different weights just to arrive at the figure, the target figure, and it is very difficult to actually justify why you have taken a particular weight. So it is always the best strategy to reason out the approaches which are less reliable and use the approach which is most reliable. And if that is not possible, some kind of a weighted averaging of most appropriate approaches. It might be two approaches only out of three, it might be three, all three as well, and do the valuation. And if the value coming from different approaches are materially different, then we have to make an effort to reconcile or to reason out or find out if there are some outliers in our decision. Means might be that there are some wrong assumptions, and the market approach valuation, why it is coming to different than the other approach. So we should try to apply. Question coming, how to consider weights? Actually, unfortunately, or fortunately, the standards do not prescribe any percentages or any figures at all. So the standards doesn't say that you will apply 75% weight to the DCF or 25% to the market approach. They don't say it. They leave it to the professional judgment of the valuer. And that is why the problem comes. Although legally you are allowed to use your professional judgment and weights, but practically it might be difficult on certain scenarios to justify. Making assumptions, you have to make certain assumptions, determining the cost of capital, discounting rate. So I guess when you have done the discounted cash flow method, you would have also understood the cost of capital or discount rate. I will cover it up in the second session, a brief of it. So then we will understand how the cost of capital or discount rate is to be determined. Then we arrive at the final value, and then applying the analytical results in the form of recommendation, and then we come up the conclusion. So that recommendation is that how much is the value of that you are arriving at. That conclusion, does it need to be in a specific figure, or it can be a range of figures as well? Can you sign a report saying that the value is in the range of 250 to 260 rupees? Yes. Deepak saying no. Rajkumar saying no. Raghunathan Subramaniam saying yes. Technically, it is possible to give a range of values. In fact, I believe that the valuation should always be a range of values, because it is not so specific or accurate that that one can give a specific value. But under certain engagements or legal requirements, a range of values are often not preferred or not accepted by the relevant parties or authorities. So we are many a times compelled to actually give a value, a specific value. but range of values should be fine in most of the cases. It should be allowed. Okay. Next topic is valuation reports. A valuation report is a communication to the client. So how you communicate to the client is through the valuation report, containing the conclusion of value or the calculated value of the subject interest. It should include a thorough assessment of the company by the valuer. So the following are the main characteristics of valuation report. It should be understandable, it should be relevant, it should have materiality, reliability, faithful representation, substance over neutrality, prudence, completeness. So these should be the qualities of a valuation report, and what we need to communicate to the client in reference to that engagement. What are our limitations, what we have done, what are the approaches that we have used, whatever we want to communicate, we communicate through our valuation report only. So there are certain minimum content of valuation report. Earlier we have understood the minimum content of engagement letter. Now we are talking about the valuation report. So valuation report should mention the scope of work performed. So what is the scope of work that you have performed? What is the intended use of your report? The approach or approaches that you have adopted, the method or methods applied, the key inputs that we have used, the assumptions that we have made, the conclusion of value and the principal reasons for any conclusions reached, and the date of report, which may differ from the valuation date, which means that valuation date is 31st March 2020, but the date of report means the date on which I am signing is today. Next is documentation. Any question till now? Are we good to go? A valuer shall ensure that documentation is maintained in a form that is sufficient to enable another professional having no connection with the engagement or reviewer appointed by any relevant professional body to review the valuation process and conclusions. So it should be in a way, our documentation should be very important, and it should be in a way that if any peer reviewer is appointed by our institute or our RBO, or any if IBBI wants to conduct some investigation or something, somebody wants to check, an independent professional, they should be able to review what we have done. The information received and relied upon as well as analysis thereon differ for every valuation engagement. However, the following documents, information, analysis shall at the minimum be documented. So these are the minimum documents that we need to maintain. One is engagement or appointment letter, which appoints the valuer to undertake the valuation. So we have to document the engagement or appointment letter. Number two, tabulation of data obtained during the course of valuation. So whatever data client has provided us during the course of valuation, that we need to maintain. Workings undertaken to arrive at the value. So what all working that we have done, that working file we need to maintain. Copies of relevant circulars, extracts of legal provisions. So if we have followed certain legal provisions, so we have to maintain a copy of those relevant circulars, etc. The basis, the approaches, the methods, or a combination thereof used to arrive at the value. So whatever we have used, we have to document what basis, what approaches, what methods, and what combination of methods we have used, and why we have used or why we have relied on those methods, and why we have not considered other methods, why we have ruled out certain other methods. Assumptions, a change in which may materially affect the value. A copy of signed valuation report issued, and a management client representation letter or such communication received at, if any. So at what point of time we should get the management representation letter? When should we get it? start, before start, during as per requirement. Deepak Jain, before signing. So at the start, we get the signed engagement letter, but management representation we might not take at the start of the assignment because we are not even aware of what information they are going to provide us. And after they have provided all the information, then we are asking them to certify that, look, you have provided all necessary information to me. In your knowledge, there is nothing, no important information you have left to provide to me, and you have provided all information is true and correct to your belief and all those things. So before starting, it might be difficult for you to get management sign all those things because they are yet to start giving you information and clarifications. But before signing of report, we should get the management representation letter, because once you sign the report, then you will not be able to catch your client, and then it is of no use. Once you sign the report, then engagement letter is of no use. It has to be prior to signing of report. Next is, so these are the topics for the first session, and here I will cover some of the questions. I hope you all have already received the material. So let's try to don't look at the material that you already have, and let's try to solve these questions together. So some of the questions you will find that is a very different way that they have framed, but these are all questions that we have identified that that has come in the past or have been taken from public sources. So these are the actual questions of IBBI. So first question is, valuation is a concept based on economics aligned to legal, accounting aligned to finance, science aligned to art, one's mindset. What's the answer? Most of the answers are coming B. Accounting aligned to finance. This is the wrong answer because valuation is very different than accounting. Answer is A. Economics aligned to legal. Accounting, under accounting, we have to be very strictly following certain rules, and adjustments are bad in accounting, whereas in valuation, adjustments are many a times required to arrive at the fair value. In determination of value, which of the following are key element? Preciseness with the static figure. So valuation is always precise to a particular value. Is that correct? Or fundamentals are the key, means fundamentals are very important. Value should be price, both B and C. The answer is D, both B and C. Value should be price, and fundamentals are the key. Yet both of these statements are correct. Preciseness is not possible in valuation. It has to be basically an estimate only. So preciseness in valuation is not achievable. So look at these questions. Even though you understand the concept thoroughly, these questions, the way they are framed, might still confuse you. So it is important to use, practice some of the sample question paper as well, sample questions also. I will try to send you the questions, whatever I have, which will help you in your exams. Which of the following option is appropriate in expression of following statements of standard of value? The going concern value of ABC Bank is rupees 5,000 crores. The fair market value of ABC Bank as a going concern is rupees 5,000 crores. There is no difference between the above two statements, as difference is only a minor semantic difference. Going concern value is not a misnomer and a standard of value. Oh, I accidentally clicked the answer only. So the fair market value of ABC Bank as a going concern is rupees 5,000 crores. In determining the amount of fair value, the parties which are at arm's length transaction are classified as willing, knowledgeable, or willing and knowledgeable both. See, here I think there is no confusion. All are saying Ashutosh Rai A. No, it is answer is C, willing and knowledgeable. The parties are willing and knowledgeable also. They know the relevant facts. That is an assumption that we create. Which of the following date is appropriate relating to valuation? The date report is signed, the date analysis is finished, the effective date of valuation, the date the report is sent to the client. C, effective date. The divergence between book value and market value is due to the reason because book value are generally lower and actually the market value is higher. So why there is a difference? Market rewards more. The conventional balance sheet does not reflect the value of intangible assets. Book value is historical, all of the above. The answer is Deepak Jain B, Manoneet Dalal C, Bimal Malani C. The answer is B. Basically what happens, the conventional balance sheet only value the assets, whereas the business derives a lot of value because of the goodwill that it generates, and its capacity to generate higher cash flows is because of the intangibles that it has. So those intangibles are not valued in a conventional balance sheet, and that is why the book value is generally comes as lower. So answer is B. To mitigate the bias in valuation, a valuer should adopt which of the following suggestion? Do not take any prior position. Means before starting the valuation, you have a particular notion that look, this company could be worth this much. Now, second is increase self-awareness. Your knowledge and understanding about the company, market, etc. increase. We have to increase. De-link valuation from reward punishment, which means if I do the higher valuation, the client will pay me more, and if I do the valuation at a lower place, the client will pay me less. Sorry. So I guess answers already came. D.
In this, I would be thinking, how will B be a reason for my bias? B may be giving me more professionalism in my work which I'm doing, but it doesn't give me bias if I'm not aware of whatever. So all of above is also including B. By increasing my self-awareness, I cannot mitigate my bias. What my point is that if I'm aware or I'm not aware, that does not increase my bias is based on the reward or the punishment.
Actually, you are right to some extent, but the more aware we are, the more we will be able to factor in a lot of factors, and we will not be influenced by one or two more factors and create a bias towards the company. So if we are more aware about the business, about the company, about the valuation processes to be conducted, so our bias will also reduce to some extent, although I agree to your point that it doesn't affect the bias to a, it increases the quality of my report. Definitely.
I agree with that.
If I'm, yes, but
basis of the facts, but bias is a frame of mind. Frame of mind will be because of awareness.
Yes, but sir, somehow I agree to your point. I'm not contradicting you, but somehow it also happens that the more knowledgeable we become, the bias also goes little down. Means if institute also means the regulators trying to uh, 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 make sure that we valuers are more ethical, and we actually do the assignments in a we do not indulge into any wrong practices. So I believe that the more competent we become, these situations or these instances of getting biased or getting agreeing to what the client says, those instances goes down. So on a practical note, I'm saying, but I agree that it has no direct relevance. But sir, from examination point of view, you have to select D because the computer doesn't understand the logic, and you will not have any space to give your logic as well. So the computer will only mark D as the correct answer.
Okay.
Yes, sir. Habu stands for, I think ye to, you must all be aware because we already discussed. Highest and best use, higher and better use, high and below use. So this is how they confuse you by giving you similar words. So Habu stands for highest and best use. So my asset might not be getting used in the best manner. I will try to find out what could be the highest and best use for my asset, and then value my asset accordingly. Management representation letter should be taken after the issuance of final report, prior to issuance of final report, at the time of issuance of final report, none of the above. All answers B, prior to issuance of final report. B is the correct answer. If the market value of security is above its intrinsic value, it is good for auction, buy, for sell. None of the above. Deepak Jain, C, sell. Raghunathan, C. Sujit, C. Rajiv Jain, A, for auction. Auction is actually not an option here. They have just given it for confusing you. Actually, the option should have been buy and sell only. So normally what happens if the intrinsic value is, for example, for a share is 100 rupees and the market value is 120 rupees. So which means that the true value, the share is although 100 rupees, but it is getting traded in the market for 120 rupees. So our expectation is that share is getting overpriced actually. So overvalued. So in that case, if I have those shares, I should sell it. In case it would have been the market value would have been lower than the intrinsic value, which means that the share is available cheaper in the market, I would have gone for buying the share. So the answer is C, sell. So this is the end of the first session on valuation overview. Any question, please ask your questions, and then we'll move to the other session. Rajkumar saying let's have a break. I don't know what they have scheduled, how they have scheduled the break. So since it is your fourth or fifth session, you can guide me. 5 minutes should be okay. Okay. Is there any question, or should we take a break for 5 minutes before we start to the next session? Okay. So let's take a break of 5 minutes, and it is 3:52. So please try to assemble again before 4 o'clock so that we start the next session. Right? Thank you. I'll just take a break. We'll take a break of 5 minutes, and then I'll start the next session. Okay. Can we start the next session? Okay. So let's start our next session, which is on valuation approaches and methodologies. We are going to understand the valuation approaches, which are cost approach, market approach, and income approach in this session. So basically, there are three valuation approaches. One is a market approach, second is income approach, third is a cost approach. A valuer shall be responsible to select the appropriate valuation approaches and methods, as there may not be a single approach method that is best suited for valuation in every situation. So what we need to do as a valuer is we have to consider all different approaches of valuation, all these three different approaches of valuation, and we have to choose one or more approaches which are best suited for particular valuation assignment, looking at the purpose, nature of asset, and the nature of engagement. A valuer can make use of one or more of the processes or methods available for each approach that we have already understood and detailed. We have discussed in detail. So the appropriateness of a valuation approach for determining the value of an asset would depend on valuation basis and premises. In addition, some of the key factors that a valuer shall consider while determining the appropriateness of a specific valuation approach and method are. So first of all, we will see what is the basis, what is the premises of valuation, and then we have to decide, we have to see nature of asset to be valued. So for example, for certain nature of asset, you might find that a particular approach is more suitable. So if I am valuing a listed company for which the comparable companies are available easily, there are a lot of comparable data available, I might give more reliance on a market approach. Whereas if I am valuing a small companies, then I might be relying more on an income based approach. Whereas in a company which is not yet started its operations, or the company which is into losses and no viable business plan is available, then I might use a cost approach. So the nature of asset is influencing my decision of which approach is to be used and which approach is more suitable in that particular case. So that is to be considered. Availability of adequate inputs and information and its reliability. So for example, if comparable companies are not available, market transactions are not available for analysis, then that might affect my decision to use another approach as an alternate approach, which gives me more reliance as a valuer on a particular approach. So availability of adequate information is also a relevant factor. Strength and weaknesses of each valuation approach and method. So every valuation approach has some advantages and disadvantages. So the strength should be more and the disadvantages should be less for that particular valuation approach in that particular situation, and we have to use that accordingly. So for example, in many of the cases, the asset-based approach might not give a correct valuation, whereas in some of the cases, it might give a correct valuation. So for example, if I am developing a software and that software is not yet in the market, so there is no goodwill, but I want to get the fair valuation of this software. So if there are no proprietary element in that software and that could be generated easily with a short span of time, so might be the cost of creating a replica of the software could be an indicator of a value. So cost based approach gives us a reliable estimate, whereas in a different scenario and a different circumstances, we might decide that cost based approach is totally to be disregarded. So we have, because it has certain strength and certain weaknesses. So depending on the relative strength and weaknesses of each valuation approach, we have to decide which approach to be used or not to be used. Valuation approach methods considered by the market participants. So that is important, that how the market participants in that particular asset, they consider which valuation approach or method. So that is also relevant. So first of all, we understand the cost approach, which is the probably the simplest one out of these three, and which was historically used more of the cases where financial reporting, we use cost approach to value the assets under historical cost convention, and comparatively simple approach and less bias possible in this. So cost approach is a valuation approach that reflect the amount that would be required currently to replace the service capacity of an asset, often referred to as current replacement cost. In certain situations, historical cost of the asset may be considered by the valuer where it has been prescribed by the applicable regulations, law, guidelines, or is appropriate considering the nature of the asset. Example of situations where a valuer applies the cost approach are, here are few examples, like an asset that can be quickly recreated with substantially the same utility as the asset to be valued. So I just gave you an example of a software. So I just created a software which is not yet launched, and a similar software can be quickly recreated with substantially the same utility. So in that case, I can just understand what could be the cost of creation of this substitute asset, and that could be the fair value of that asset, because anybody who would be interested in buying that software might see how much it takes to recreate the software, and if it takes X amount to recreate the software, he might not be willing to pay 2x or 3x of the amount as a premium to acquire that asset. In case where liquidation value is to be determined, then also cost approach might be appropriate in some cases. Income approach and or market approach cannot be used. There are certain situations where we are finding it difficult to use the income approach. So for example, in case the company is recently shut down its operations, the plant is there, not into operation, and no feasible business plan is there, losses, currently into losses. So income approach is difficult because you cannot discount the losses. Market approach is also very difficult in those situations, and we might come into opinion that cost-based approach might be fit in that particular scenario. So the asset has not yet started generating income cash flows. So for example, we just created a company, and that company has not yet started its operations, and the company is in the initial establishment phase. The asset was recently created. So these are few situations where cost approach might be more suitable.
So Rajiv ji, in this case,
yes,
like cost would not be the historical cost, is it? Like just
no, sir.
Supposing there is a DG set which is maybe 10 years
yes.
old and depreciated, so I would be taking, if I need to replace it, the cost.
Yes, yes, sir. So my next slide will answer your question. This question that look, this is not the historical cost. This is the these kind of cost. So broadly, these two costs are considered for valuation purpose. One is the replacement cost, and one is the reproduction cost. So what we do is replacement cost method, also known as depreciated cost replacement cost method, involves valuing an asset based on the cost that a market participant shall have to incur to recreate an asset with substantially the same utility, means comparable utility as that of the asset to be valued adjusted for obsolescence. So for example, if I have to value an asset, I will see what could be the cost of a substantially the same utility, means the asset which I am contemplating or I am thinking of creating might not be the same asset, but its utility is substantially the same. So it might be that the asset, I'm valuing a machine which is an old machine, and I'm trying to buy a different machine, but it will also manufacture the same product. It might work in a different way also, but its utility is similar. So what is the cost of that new machine? And then we adjust the cost of this machine as for any obsolescence, because if we are checking the new asset and this is an old asset, then we provide for the obsolescence or depreciation. So reproduction cost method is again another method which involves valuing an asset based on the cost that a market participant shall have to incur to create a replica of the asset. So in replacement cost, we are creating an asset which is substantially the same utility, comparable. It might be different, but in reproduction, we are creating a just replica of the asset to be valued, and then it is also adjusted for obsolescence. So I guess this answers your question, sir.
Yeah, more or less. But then the terminology also that you used, I think it will be explained later, because reproduction cost, creating a replica of the asset, I was not very sure what exactly it means.
Sir, for example, I am using a machine of 5 years old, right? So I have to use that, value that asset. So in reproduction cost, I am assuming that how much would be the cost of having just a replica of this asset. Or if I am valuing a software, so I will assume what would be the cost to create just a replica of this software. It might suffer from certain limitations. It might have been created with a technology which is which takes more efforts and more manpower to create it, whereas a new technology or a better technology can create the same utility software at a much lesser cost. So in the under reproduction cost, I am assuming that no, I want to create the same, exactly the same. What would be the cost? So now the software developer will say that, look sir, if you want the same technology to be used, the same kind of software to be prepared, it will cost you 1 crore rupees, for example. Whereas he says that, look sir, I can give you the same utility, same functionality with a different technology, and that would be that can be created much easily by our team, and that would cost you 50 lakh rupees. So under reproduction cost, you want to create an exact replica. Under replacement cost, you would want to, your focus is on the utility. What does it achieve? If I can achieve the same thing with a different asset, then I would prefer a different asset.
Second would come under replacement cost method.
Second would come under
the replacement cost method, where he gives me a comparable utility for 50 lakh.
Yes, yes, sir. That is a replacement cost. So why would I want to, incur 1 crore rupees for an asset when a similar utility can be achieved for 50 lakh rupees, which might be a different asset, but which gives me the same utility? So I might prefer a replacement cost method. Reproduction means even if it is it was not, created in the most efficient manner, you just create another replica of the same asset. So these are methods used in the cost approach. Am I clear to all, or you need more explanation on this? Chetan is asking, in case of liquidation, market approach will be more suitable or cost approach? Chetan, actually, there is no such prescription in the standards that in case of certain situation, only a particular approach would be suitable. I give you an example that a company is under liquidation or under insolvency, and it is having a running factory. It is having a running factory, and it is possible to sell that factory as a running unit, and that running unit can be sold based on the valuation it can derive as a running unit, with all those employees, with all those systems in place, all those vendors, all those customers it has. So in that case, you might use a income based approach, or you might be, when you are selling that as that particular factory or that particular unit, you might decide that a comparable transaction in the market for a similar kind of a business might be suitable. So even under liquidation, it might be possible that the cost approach is not used, some other approach is used. But most of the times, many of the times, cost approach is frequently used when the asset is not actually under the going concern situation, and there are reasonable doubts that the asset cannot be sold as a going concern. Right? Any other doubt? Right? Next is a market approach. Market approach is a valuation approach that uses prices and other relevant information generated by market transactions involving identical or comparable asset, liabilities, or group of assets and liabilities such as business. So what is the difference between identical or comparable? And do we find identical or we find comparable? So although our wish is to find the identical company, identical asset. When we say asset, if we are valuing the company or a business, we are trying to find an identical business. But in the real life scenario, it is so much difficult, in fact, almost impossible to find an identical asset. So even if I want to value my car and I want to, find identical car to do the valuation, then I would not be able to find out. I might find I suppose I have a BMW, I might find a BMW of the same year also, but the other BMW might have run for a different kilometer, its condition might be different, its color might be different. So if it is so difficult to find an identical car, then how difficult it would be to find a identical business, because every business has very different scenarios. So we try to find a similar business, similar asset, and which we can say that they are comparable to us. And if there are some dissimilarities, there are some differences, we try to make adjustments and then make them comparable. So we say that even though they are not comparable per se, we are making those adjustments and then making them comparable. So how the market approach works is that suppose my company has an EBITDA of 1 crore rupees and there is a comparable company which has an EBITDA of 2 crore rupees. That company is priced 10 times of EBITDA, that is 20 crore rupees. So I might say that, look, my company is similar, my company is comparable, everything, we do the same business, similar kind of clientele, similar kind of work that we do. So my EBITDA is 1 crore, so my valuation could be 10 times of EBITDA. They are having their valuation, so 10 times of EBITDA, my valuation should be 10 crores. I'm just giving a very, very simple example of how we can use the market approach for valuing a company. So have you taken any session on some examples or some detailed understanding of market approach? Do you all already have an understanding of how to do the valuation of market approach? Raghunathan says no. Okay. So then I will try to be give more attention to this. a difference between reproduction cost method and market approach. Okay. Deepak Jain, you are finding difficulty, voice cracking. Are others also facing this problem? Okay. So difference between reproduction cost method and market approach, basically though these two methods fall into two different approaches. So reproduction cost, we try to find out the cost of creating that asset. Under market approach, we are not looking into the cost of that asset. We are looking at some factor which we can compare with a comparable company and try to derive our value. So I just give you an example. Like for example, if my company is having an EBITDA of 1 CR and another company with EBITDA of 2 CR is getting valued at 20 crores, which is 10 times. So I also apply the same ratio to my EBITDA and I derive my value to be 10 CR. So in that process, what I have done, first of all, I try to find out comparable assets, which means in my case, in this example, comparable companies in the market, which I can say that they are comparable to my company. So I try to find out the companies which are in the same industry, in the similar products, in the similar size, in the similar geographic areas they are working, or we try to filter out all those companies in the market and try to find out companies which could be called as comparable companies in the market. It might be possible that we find many companies in the comparable range, or it might be possible that we don't find many comparable companies, or we don't find a single comparable company. So in case we are able to find out many comparable companies, we try to filter out those companies by eliminating the companies which are having less similarities, and ultimately find a reasonable size of sample, let's say 5, 7, 10 companies. And then the next step is to identify some comparable. So for example, I could say that I will compare their value, the ratio of their value to their sales, or I would want to find out their value to their EBITDA. So first of all, the companies that we have chosen as a comparable companies, we try to find the companies where the prices of those companies are easily available. That means we try to find out the companies in listed domain. So those are listed companies. So I could easily find what is the market price of those companies. So based on the market price, or number of shares, I could understand that what is the total value of those companies. And we find out some factor, some financial factor, or sometimes non-financial factor also, but most of the times financial factor, and we derive a ratio of their valuation of the company with that particular financial factor. So it could be sales, it could be EBITDA, it could be profit after tax, but most of the times EBITDA is used. Most of the times EBITDA is used as a comparable, and based on the ratio that I get, maybe I get 8 times of EBITDA, 10 times of EBITDA, 12 times of EBITDA, the average ratio that I get, I can apply that ratio to my subject company, and then we can derive at the value of that company. If there are some dissimilarities, some minor dissimilarities, then we might put a discount or premium because of those similarities, because I can say that, look, all those companies are into the similar business, but their size is bigger than me. So there should be some discount for a smaller size. So I put some discount, and after making those adjustments, we are able to find out the value of our asset. So abhi tak means, is it clear so far? I guess you might have a basic understanding of how the market approach works. If you want more explanation, please let me know, or if I should I proceed further on this. Okay. So first of all, we try to understand when do we prefer this approach. Means first of all, we have to decide whether we should use this approach at all in a particular scenario or not. So number one, where the asset to be valued or a comparable or identical asset is traded in the active market. So for example, if my company that I need to value, that is also actively traded in active market. So what I will do, I will try to, you know, find out what is the traded price of my company, and that would be a strong indicator of the value of my company, because that is actively traded in the market, or if a comparable or identical asset is traded in the market. So I could find some companies which are comparable and those are traded in the active market. So I can use them as a benchmark and try to find out the value of my company based on the market approach. There is a recent orderly transaction in the asset to be valued. So for example, if I have to value some company which is similar to Flipkart, and there is a transaction in Flipkart that has happened in the recently, so that transaction, that comparable transaction might give me an indication of value of my company as well. So some orderly transaction can give an indication. There are recent comparable orderly transaction in identical or comparable assets, and information for the same is available and reliable. So that is also then also we try to use the market approach. In fact, many of the cases when we are doing the valuation of a startup company where there are no profits, the estimate of their future cash flows is also not very reliable. And in those situations, if we can find that there are some transactions in the market, recent transactions, then based on those transactions deriving, those are good indicator of value of subject company. And the comparable means the criteria on which we try to compare the value. It could be financial, as we discussed. It could be earning before interest, depreciation, tax, EBITDA, or it could be sales, or it could be non-financial also. So for example, it's a 3-star hotel and it has 20 rooms, and there is another hotel which has 20 rooms in the similar same area, and whatever transaction price was there for that hotel, or if that hotel was having 25 rooms, so we can, you know, make those adjustments for number of rooms, and we can find out the value of that subject asset. So under market approach, we use these methods: market price method, comparable companies multiple method, comparable transaction multiple method. Under market price method, what we do is that in case my company is getting traded at a certain price, so that average of few days or average for it is actively traded, so those prices can be taken as an indicator of the value of the subject company. Comparable company multiple method, I just explained that we find some comparable company, we try to find out an indicator like a multiple to EBITDA, or multiple to sales, or multiple to another financial or non-financial indicator, which could be most suitable and most widely used by market participants in that particular industry or that particular domain. So we use that as an indicator, and then we apply the same multiple to that particular criteria of our company, and we then find out the value of our company. Comparable transaction multiple method, because in B we have done the comparison based on some financial indicator of subject company. In case of comparable transaction multiple method, we try to find out a comparable transaction in the market. So that is most widely used in case of unlisted small companies or startup companies. So for example, if the company is into e-commerce sphere and there is no listed company in that sphere, so we will find what are the similar companies in that business, and is there any recent transactions in that in those companies, and what was the transaction value of those companies, and how much was the valuation in those transactions, and what are the similarities with my company, and based on those transactions, taking them as a benchmark, we try to derive the value of our company. So let's understand it more details. Market price method: a valuer shall consider the traded price observed over a reasonable period while valuing assets which are traded in active market. A valuer shall also consider the market where trading volume of asset is the highest when such asset is traded in more than one active market. So if the company is getting traded in, suppose I have to do the valuation of a company which is listed in multiple stock exchange. So the stock exchange where the company is getting more active trading, that prices of that exchange need to be considered. A valuer shall use average price of the asset over a reasonable period. The valuer should consider using weighted average or volume weighted average to reduce the impact of volatility or any one-time event in the asset. So it is not necessary that if I am doing the valuation of the company as on 31st March, so I only take the value as on 31st March. We can take a average pricing of a reasonable period. So it might happen that on 31st March, the volume was 2 lakh shares. On 30th March, the volume was only 20,000 shares. So at certain price, the volume could be different. So weighted average we prefer instead of a simple average. In case we do the simple averaging, it might be possible that at a certain price when the transactions were very negligible, we have that has influenced the price, the final value of the asset. So that will reduce the impact of volatility on the valuation. So is it clear? Market price method is clear? Since market approach was not done before, so I'm trying to be more elaborative on this. Should I go ahead then? Okay. Second is comparable companies multiple method, also known as guideline public company method, involves valuing an asset based on market multiples derived from prices of market comparables traded in on active market. The following are the major steps in deriving a value using the comparable company method. First of all, we identify the market comparable. Second, we select and calculate the market multiple of identified market comparable. Then compare the asset to be valued with the market comparable to understand the material differences and make necessary adjustments to the market multiple to account for such differences. So for example, I identified company X to be a comparable company to my subject company. Then I calculated that the value of company X is 10 times of its EBITDA. So we have calculated the market multiple. Now I find that, look, my company is different. Need to make certain adjustments. Those could be premium. So for example, there could be some discounting factors, because my company might be not so popular in the market, might be working with a lesser turnover, my company might be working in limited geographical areas, blah blah. So whatever is the whatever are the factors which necessitates a discount or premium, we make those adjustments. Apply the adjusted market multiple to the relevant parameter of the asset to be valued. So then I find that, look, in my asset, it should be multiple should be taken as 9. So then we try to find out the relevant parameter of the subject asset. So what is the EBITDA of my company? Then we calculate the EBITDA of my subject company and then multiply with that particular market multiple to arrive at the value of such asset, and then we just divide by number of shares and we can find out the value of each share. If the value of asset is derived by using market multiples based on different metrics parameters, the valuer shall consider the reasonableness of the range of values. So if we find different parameters, so for example, I have done the valuation based on the EBITDA multiple. I have also calculated based on sales multiple. I've also calculated based on some other multiples, and I get different results. Then we have to consider the reasonableness. Might be that we might rule out that based on the sales multiple, I will not consider, because the profit percentage of those two companies are very different, and my company is having a different capital structure and a different profitability. So EBITDA multiple is a better criteria, or in some cases the sales multiple could be used as a criteria, but reasonableness need to be checked. Under market approach, the second is the comparable transaction method. Comparable transaction multiple method, also known as guideline transaction multiple method, involves valuing an asset based on transaction multiple derived from prices paid in transaction of assets to be valued market comparable transactions. So following are the major steps in deriving a value using the comparable transaction multiple method. Identify comparable transaction appropriate to the asset to be valued. So here we are trying to identify comparable transaction in the market. Select and calculate the transaction multiples from the identified comparable transaction. So then from that identified comparable transaction, we try to calculate the transaction multiple. So for example, in case of e-commerce company, we are trying to find out what is the ratio of the value to the gross merchandise value. Whereas in a manufacturing company, we might compare based on the EBITDA, or in other company, it could be a different parameter, whatever is the most appropriate parameter which is used by the market participant. So compare the asset to be valued with the market comparable and make necessary adjustments to the transaction multiple to account where differences, if any, existed. So my company might be having some differences to that company for which the transaction has happened. So for those differences, discount or premium need to be added or deducted. Apply the adjusted transaction multiple to the relevant parameters of the asset to be valued to arrive at the value of such asset. And if the valuation of asset is derived by using transaction multiples based on different metrics or parameters, the valuer shall consider the reasonableness of the range of values and exercise judgment in determining a final value. So for example, I have calculated a multiple of sales, I have calculated a multiple of EBITDA, I have calculated a multiple of various factors, and I get very different results. So we cannot just do the averaging of all. We need to consider the reasonableness as to which parameter is actually giving me a more appropriate indication of value. Last approach is income approach, which I guess you all are having a fairly good idea, will understand this, because that is most widely used approach in valuation. Income approach is a valuation approach that converts maintainable or future amounts, cash flows, to a single current amount. So for example, what we are saying is that the present value of an organization is the discounted value of all the expected future cash flows that this organization is able to earn in the future. So what I am paying for today for the shares of this company is based on the expectation of getting the cash flows in future. So if I can project the cash flows that might come in future and then discount them based on my risk understanding of the company, how much is risk involved based on the discount rate, then I might receive the present value of the company. The fair value measurement is determined on the basis of value indicated by current market expectations about those future amounts. So whatever is market expectation, we have to consider that. Where do we use this? Where the asset does not have any market comparable or comparable transactions, so market approach cannot be used. Where the asset has fewer relevant market comparables, or where the asset is an income producing asset for which the future cash flows are available and can reasonably be projected. So if the company is generating cash flows and then that can be reasonably projected, then we were using the income approach. And under income approach, discounted cash flow is a very widely used method of valuation. Any questions so far? Have you all understood the market approach completely? How comfortable you are in market approach? So let's understand some of the methods under the income approach. Some of the common valuation methods under income approach are as follows. Number one is discounted cash flow method that you have already understood. Relief from royalty method. Have you, do you understand about this method? Relief from royalty, meme, W, with or without method? No. So intangible asset valuation, have you covered that or not? Okay, so I will only touch base this because this gets covered under intangible valuation, but I'll just give you a brief idea about these methods so that you understand the base. So discounted cash flow method, we all understand. You have understood the method and how the value is derived. Relief from royalty method is basically a method which is generally used for valuing the like for example some trademark or some intangible which is like a license or a software. So in case suppose for example I am using a brand name as a franchisee and then I'm making I'm running my business and I have to pay to a certain company for the brand that I am using because I have to pay a royalty. Or if I am using a mine and I am extracting some material from that mine and I have to pay a royalty for using that mine. Or if I am using some goodwill of somebody and then I'm paying royalty for using that goodwill. So if I want to buy that brand, how much I should be willing to pay for that brand is actually the relief of royalty. Means whatever royalty that I have to pay today, I will not have to pay that royalty tomorrow once I buy that brand. So that will increase my cash flows. So just I calculate the royalty amount which I will not have to pay, and I will just treat that royalty amount as the potential cash flows in future, and I just discount those potential cash flows, future cash flows, to the present value, and whatever present value I get is the value of that brand. So this is called relief from royalty. So capitalize royalty price at IRR by royalty payments. So yes, any royalty payment that you have to pay, you have to estimate the future royalty payments, and then discount the potential payments that you will now not be required to pay, and then the discounted present value is actually the value of that asset, and the method is called relief from royalty method. Likewise, multi-period excess earning methods. What if I don't actually pay any royalty, but I'm still using a brand, and I want to use I want to value my brand? What could be the value of my brand? So it could be that what is my earning with that brand, what is the excess earning that I am able to make because of this brand. uh, I just calculate that excess earning, that extra earning. Like for example, an unbranded pen similar pen could have been sold at 10 rupees, but since my brand is good, I am able to sell it for 14 rupees. So what is the extra earning that I am able to earn because of this brand is that 4 rupees. So based on that, whatever actual annual cash flows I am able to create for multiple period, I just project those cash flows, and the present value of those cash flows is the value of that brand. With and without method is also similar, in which we just project our cash flows with that asset, whether it is goodwill license, or any patent or anything, or without that particular asset. And what is the difference? Whatever is the difference is the value of that particular intangible asset. And there are some option pricing models like Black-Scholes, etc. These are used for valuing the options. Options means you have a right but no obligation to exercise, buy or sell of a particular asset. So employees stock options are also an option where the employees have a right to subscribe to the shares of the company at a predetermined discounted price. So these itself is a big session, so cannot cover in today's session because it is time is running short. But you would use these models for valuation of ESOPs or any options. For options valuation, Black-Scholes or Black-Scholes Merton formula or binomial, these methods are used. DCF method. It values the assets by discounting the cash flows expected to be generated by the asset for the explicit forecast period, and also the perpetuity value or terminal value in case of asset with indefinite life. So what is explicit forecast period and what is the perpetuity value? I can ask this question because you have already covered DCF. 3, 5, 7 years. How would you decide 5 is appropriate or 3 is appropriate or 7 is appropriate? Or are there any circumstances where you will do the projections for 10 years, 15 years, 25 years? Any answer? If very erratic, yes, makes sense. I guess there is some confusion, so I'll just clear your confusion in this area. First of all, most of the businesses we assume that they have an indefinite life, which means that we are assuming that the business will continue to run forever. It will not die. However, there are some businesses which have a definite life. They have a defined life, that after this life, this business will discontinue. Like, for example, if there is a company which has constructed a flyover, and the government has given the right to that company that, look, you have constructed this flyover, for the next 30 years, you can collect the toll. So can you assume that this company is going to be having an indefinite life if you are doing the valuation of that company? So the answer is no, because that company, you know that it has a definite life. It doesn't have an indefinite life. So for that company, if the life is 20 years, we have to do the vision for projections for 20 years only. But in other companies where the company is having an indefinite life, we are assuming that the company is having indefinite life. But it is difficult to, means how long you can project your cash flows? 5 year, 10 year, 15 years, it's very difficult. And beyond 5 years, generally it is very difficult to cast. You don't know what the economic or other scenario would be after 5 years. So to avoid this complications or to avoid this problem, what the valuers do, they do the forecasting for some explicit period, which is generally 3, 5, 7, 10 years. Why there is a difference is because depending on this, age of the company and nature of operations, we try to find out the forecast for a period after which the company will be stable in its operations and no major changes in operations are expected. So if it is a startup company, after 5-6 years it will start earning profits, I might do the projections for 10 years. But in case it is a established company with a stable cash flows, I might be satisfied with 3 years also. So depending on that, we decide the explicit forecast period. So what do we do for the cash flows to be generated after that 3 or 5 years till perpetuity? So for that, we try to find out a terminal value after 5 years. In case of asset with indefinite life, we try to find out a terminal value. In case of assets with a definite life, we project the cash flows for the entire definite life of the asset. Is it clear now? Is this point clear to all? I guess we have time till 5:30, right? Your class goes up till 5:30, na?
सर एज पर शेड्यूल आई थिंक 2 to 5 था, बाकी जैसा भी ऑडियंस कहें।
अच्छा अच्छा,
मतलब शायद 3 घंटे का था ना।
ओके ओके, so I'll have to rush fast then. Carry on. Yes, okay, thank you all for continuing with me, bearing me. I understand that for the whole day you are having a heavy session, so we'll try to, and if we'll be running short of time, I'll leave the question answers, because those question answers are there in the presentation shared with you also, so you can do it yourself as well. So I'll cover the whole topic itself. So in income approach, we calculate either free cash flow to the firm or we calculate free cash flow to the equity. In case we calculate the free cash flow to the firm, then we get the enterprise value. We have to reduce the value of debt and then we get the equity value. In case we discount the free cash flows to the equity, what we get is the equity value. It's both the methods are good. Both the methods could be used. In few cases, cash flow to equity is preferred, but in most of the cases, both will give you the similar results. I hope you all are having clarity about this because DCF has already been done. If any confusion, I can explain or I can move further. So terminal value, as we discussed, that since we are doing the valuation for a explicit period, like we are doing the discounting for 3 years or 5 years, what do we do about the terminal value? Means since we are assuming that the business is going to run forever, so what could be the terminal value? What could be the value that we can add for the period after that explicit period? So for that purpose, we have multiple models, but the most important model is a Gordon growth model, which is most widely used for estimating the value of terminal. Means after 3 or 5 years explicit period, what would be the value of the company? Here one point is very important to note, that in case you are doing the valuation of a company with a definite life, then please don't use the Gordon growth model, because this model assumes that the company is going to run for indefinite period. In case of a definite life project, after the end of the project, the assets are sold as a scrap or whatever way, and liabilities are discharged, and hence the business the terminal value is not calculated based on the Gordon growth model or any of these models. We actually use the salvage or liquidation value as a terminal value. So this is the formula. We use the basically future maintainable cash flows. We divide it by the capitalization rate. And how do we find the capitalization rate? Is by reducing the discount rate minus perpetuity growth rate. So if the discount rate for my company, the expected risk adjusted rate is let's say 15%, and the perpetuity growth rate is 4%, so my capitalization rate would be 11%. And based on that capitalization rate, we will discount the future maintainable cash flows. And what is the future maintainable cash flow? Is the last year free cash flow multiplied by 1 plus terminal growth rate. So if the terminal growth rate is 6%, then last year free cash flow multiplied by 1.06, then divided by the capitalization rate will give you the terminal value. So as we understand that in discounted cash flow model, we discount the cash flows. So since we are taking cash flows as an important input for our valuation exercise, it is important to understand the cash flow. So for that purpose, we do the cash flow analysis. We do the cash flow analysis of cash flow from operations, cash flow from investments, and cash flow from financing. Since most of you are from finance background, you already understand that how the cash flow works and how the cash flow from operations or investing or financing is getting calculated. I can move on to the next. Second important point is appropriate cost of capital rate of return. That is the discount rate at which we have to discount the future maintainable cash flows to arrive at the present value of the company. So cost of capital refers to the opportunity cost of making a specific investment. So if I have to make the investment, I will expect a certain return from that investment. If I am investing in a secured investment, I might be expecting a lesser return. But if I am taking a risk of investing in equity, I am expecting a higher return. And higher is the risk involved in that particular company, the higher would be the return expectation. So for the purpose of business valuation, we generally use weighted average cost of capital, which is basically cost of debt and cost of equity based on their respective contribution in the capital structure of the company. We derive the weight, and accordingly we find out the weighted average cost of capital. If there is any question somebody has, I can take up. Otherwise, I am assuming that since discounted cash flow method already covered, so you are aware of the weighted average cost of capital, cost of equity, cost of debt. Any question, please tell me. Or any doubt you have in respect of cost of capital, weighted average cost of capital, or cost of debt? Do you want me to explain it further, or should I move on? Explained in earlier class? Okay. Okay. So this is how the cost of equity is calculated, that you already covered. Beta is a factor which is used in determining the cost of equity. I guess that is also covered. If you want me to cover anything of anything that we just skipped, let me know. Cost of debt is basically simple interest rate multiplied by 1 minus tax rate. So tax adjusted cost of debt. So here are some questions. We are about 5 o'clock now. Let's quickly do these questions. Oh shit. Which of the following statement is true? All valuation approaches must be considered. All valuation approaches must be applied. All valuation approaches must, all valuation methods must be applied. Indications of value should be averaged. So A is the answer. You have to consider all valuation approaches. You need not apply all the valuation approaches or all the valuation methods. You will consider, and whichever approach or methods you consider to be more appropriate, you will have to apply those methods and then derive at your valuation. In measuring value, which of the following approach would you use? Cost, market, income, all of the above. So all of the above, that's the right answer. Which of the following statement concerning the asset approach is true? The asset approach is more commonly applied in valuing operating companies that sell products and or services. The asset approach is more commonly used in valuation for financial reporting purpose. The book value of real estate is usually pretty close to fair market value. When valuing a business, valuing intangible assets in an operating company is common and provides increased accuracy for the valuation conclusions. Sujit Kumar D, Bimal Malani D, Deepak Jain B. The answer is B, because asset approach is more commonly used in valuation of financial reporting purpose, because when we do the financial reporting normally in the historical cost convention, the asset approach is generally used. Intangible assets are generally not used under the cost approach. They are generally used under income approach. So the answer D is not correct. Which of the following is an approach to value? Discounted cash flow, capitalized cash flow, excess cash flow, income. This I guess is very easy for all. D, income approach. Income is one approach. Income, cost and market approach we have discussed. The mathematical comparison between the discount rate and the capitalization rate is illustrated with what type of following equation? Discount rate is equal to risk-free rate returns plus risk premium. Capitalization rate is discount rate minus annual growth rate, which is the Itijan A, Bimal Malani A. Answer is A. Risk-free returns plus risk premium, we get the discount rate, and capitalization rate as per the Gordon's growth model, discount rate minus annual growth rate. Which of the following factors is used in capital asset pricing model? Risk-free rate, market risk premium, beta, all of the above. So what do you use in CAPM? Atul Kumar, D. Sujit, all are saying D. So that's pretty much clear. So this is the end of my presentation. If you have any questions, please let me know. I'll be happy to take up. Okay, so I guess no more questions. So with this, I end my presentation. Thank you all for participating and attending to this session. I hope I could have added value to your these two topics, and you would have enjoyed my sessions. Thank you all. Thank you. Thank you, Deepak. Thank you, Uti. Thank you, Chetan. Thank you. I appreciate your kind words. Thank you all. Vijay, should we end this session or? Vijay, are you connected, sir?
Rajiv ji, if you don't mind, can I ask you a slightly unrelated question?
Yes, sir. Of course, sir.
Actually, my daughter is, doing a dissertation, and one of the things is that, say a share like Microsoft, how the percentage returns it has given vis-a-vis the Nasdaq returns. So, it's actually plotting the share prices over a period of time and the Nasdaq index over a period of time and the percentage change. Now, if she wants to
sorry, I didn't get you in between. Can you just repeat, sir? So what she's doing, she's charting.
Preparing a dissertation for her master's.
Okay.
The basic thing was that one of the things that she's comparing is the performance of Microsoft shares against the Nasdaq index.
Okay.
So of course, what she's plotted is 15-year Microsoft share pricing and 15-year Nasdaq indexes. And
okay.
The percentage change, over the 15 years of the Microsoft share and 15-year difference of the Nasdaq percentage change. If she wants to compare this as to what the return of Microsoft has been in comparison to Nasdaq, should she just be reducing the two percentages, or there is some different basis that she should be using to compare?
Sir, basically, those returns can be taken from the Nasdaq website, and after those returns are taken into Excel, I guess both the returns could be calculated independently. Annualized returns can be calculated independently in Excel by using a formula. And after you are you arrived at return for both of the means the index and the particular share separately, you can find out the difference, the delta.
That is what exactly. So you think the percentage of all the 15 years returns for the company and for the Nasdaq index that has been taken out. Now, how to compare that delta or beta or whatever?
You just calculate the annualized return from both separately, and then you can find out the difference. That could be the simple and explainable, because when when she will show that this is the difference, the next question might come that what is the return of Microsoft and what is the return of Nasdaq. So if we can calculate the return of those two index, means index and share first, and then deduct and determine the delta, that is more easily explainable.
So Rajiv, in one exact case, it is minus 8.4 for Microsoft in 1 year, and Nasdaq has returned 16% positive. What would we do? What, minus 14 plus 16, 30, or what do we do?
Yes, that is the difference actually.
And so forth for the 15 years.
But for the last 15 years, it might not be minus, na?
No. Then every year, of course, it is different.
Yes. So you have to calculate the annualized return for the entire period. There is a formula for that. You can connect me after this. You can send that Excel sheet to me, and I will put in that formula for you.
Now, I think session is over.
Yes, sir. Yes, the session is done. So participants are asking for tomorrow's class at what time it will start, sir.
तो सर I request all the participants कि भाई आप एक बार decide करें, because the plan is of 9:30 it will be feasible for all, तो फिर हम इसको 9:30 पे कर लेंगे, otherwise जैसा suggest करें. अभी इतनी जैन जी ने लिख दिया है 9:30 is okay, क्योंकि उससे क्या होगा कि टाइम में ही आधा घंटा बचेगा और डिस्कशन आराम से कर पाएंगे, कंफर्टेबली आदमी फ्री होगा. सुबह जितनी जल्दी स्टार्ट कर लूंगा उतना बढ़िया. दीपक जी ने तो लिखा है कि तो सर तो 9 बजे भी ओके है. सो फिर 9:30 कर रहे हैं. किसी को कोई ऑब्जेक्शन हो तो प्लीज बताएं, क्योंकि आप ही की एडवाइस पे होना है. ठीक है, तो 9:30 पे हमारा कल का सेशन हो रहा है. जो आपको ईमेल्स आएंगे उन सब पे 9 बजे लिखा होगा, बट 9:30 हमारा सेशन स्टार्ट होगा. थैंक यू राजीव जी, एंड थैंक यू पार्टिसिपेंट्स. सर एक अपनी पीपीटी प्लीज पार्टिसिपेंट्स को एक बार शेयर कर दीजिएगा.
Sir, it was already shared yesterday, and you also shared with the.
अच्छा ठीक है, याद आ गया. Yes.
WhatsApp. Sir, you were very quick. Means the moment I shared with you, 10 minutes later I checked on the WhatsApp. You already shared. So you are very active, sir.
नॉलेज है ना पार्टिसिपेंट्स के साथ शेयर हो गई, तो मैं तो गूगल ड्राइव में भी ओपन लिंक रखता हूँ ताकि शेयर रखें. हाँ.
Yes, sir.
So
That's good. Thank you, sir.
We will take the support in future as well for this RVO regularly.
Thank you, sir. Thank you. I appreciate, sir. Okay. Thank you, participants. Thank you all.